Yes. Welcome to CA Inter paper number 6 Auditing and Assurance revision classes. Okay. First of all, let me introduce myself. I am CA Ravikiran Balla. I qualified in 2018. So since then I am into teaching various subjects of CA Inter and CA Final. And even recently I started with CA Foundation BCK also. Okay. So this is my brief introduction, and let us now talk something related to this revision classes. For which attempt is it applicable, and okay, and what are the insights, what will you get after you watch these classes? Okay, this is the thing. First of all, I just want to discuss, and for first 5 minutes it will be there. After that I will be directly jumping into revision classes for CA Inter auditing chapter wise, and to some extent I will relate different chapters also at the same time. Okay, done. So these classes will be around 15 hours. These classes will be around 15 hours. It covers all the topics. It covers almost 100% of the syllabus. Okay, so my focus will be mainly on the chapters. It is an examination oriented revision. Okay, along with that, conceptual clarity will be 100% there. So it is a blend of conceptual clarity along with exam oriented revision. Okay, both the things you will be getting, and I hope it will be very helpful for you for your examination. Okay, for anything. Okay, it will be May 2022 or thereafter. Okay, so it is the first time I'm recording this session. I'm into teaching from last 4 years this particular subject. So I taught many students, and this is for the first time I'm recording the revision lectures, which will be made available on my YouTube channel. Okay, it may be helpful for you. Okay, I hope 100% it will be helpful for you for your examination to get more than 50, at least to get more than 50. If your target is more than 50 in this subject, then okay, safely you can watch this video 15 hours. Regularly I will be uploading. Okay, I will be uploading regularly around 2 hours. Within 6 to 7 days I will be completing an entire subject of auditing. Okay, in detail, though it may be called as revision lecture, so mostly the concepts will be discussed in detail. Along with that, okay, some examples will be given to you, and conceptual clarity will be 100%, which okay, for you it will be available, it will be made. Okay, 100% conceptual clarity will be there for you at the end of 15 hours. Okay, patiently you need to watch for first 2 to 3 hours, and then you will come to know the importance of this lecture. Okay, before examination. Done. So with this basic introduction, I just want to start with chapter number 1. Sir, is this class relevant for the first timers? This is the first time I am writing the examination. This is the first time I am listening to the classes. Okay, is this relevant for me? Is this video relevant for me? Yes, it is 100% relevant. Okay, if you are the first attempt student for the first time listening to the audit subject, okay, then it is 100% relevant for you. You can get minimum of pass marks just by viewing this 15 hours lecture. Okay, done. So my focus will be mostly on examination point of view. Okay, chapter wise revisions will be there. And as and when required, this chapter, when I will discuss chapter number 1, if it is relevant to discuss chapter number 4, I'll include those concepts also in chapter number 1. So primarily, prima facie, my focus will be on chapter wise revision. Whenever it is required, I'll get some concepts from other areas also, which will be included in the previous chapters. Okay, done. Primarily my focus will be on chapter wise revision will be there. Okay, point number 2, in which language it will be there? It will be 100% English 100%. Okay, 100% English will be there. And are the examples more given? Okay, are the examples given more in number? Okay, so since the conceptual clarity is required, conceptual clarity you must get. For that purpose, sufficient number of examples will be discussed. Number of examples will be discussed to cover up, to get this conceptual clarity. More number of examples may not be there, but to get this conceptual clarity, sufficient number of examples will be given. Okay, and after watching this class you will be able to get 40 to 50 at least. Carefully you need to observe everything, and observe everything. After 2 to 3 hours revision, after 2 to 3 hours of this class, you will come to know the importance of this lecture. Done. So patiently you need to listen at least 2 to 3 hours. Done. Then you will come to know the content what I cover. So to what extent it will be useful for your examination. Then for that purpose you need to watch at least 2 to 3 hours lecture. Patient listening is required for at least how many hours? For 2 to 3 hours. Then you decide whether to watch this lecture or not, whether to continue this lecture or not. Done. These are the 5 things I just want to give it to you before I start the session. So with this introduction, I just want to start chapter number 1. Chapter number 1. Let us go to the material also given to you. I'll be discussing material also. So the chapter number 1, name of the chapter is nature, objective and scope of the audit. Nature, objective and scope of the audit. So we'll start with meaning of the audit first of all. Meaning of the audit. So it is better to discuss the need for the audit first of all. Need for the audit. In that process, I'll be discussing the meaning of the audit also. Done. So there are many organizations which will run for profit or there may be non-profit organizations also. For them, there may be huge financial transactions. And these financial transactions are to be formed as information which will be used by the intended users. Say for example, take an example of a company where the investors of the company is the shareholders, and shareholders, they give the money to the company, and board of directors on behalf of the company, they will utilize the money. They'll incur some expenditure, they'll get some income on behalf of the company, and it will be see who will spend the money? Board of directors will spend the money. Whose money is that? It is the money of the shareholders. In that process, there will be many transactions, financial or non-financial transactions. Generally we talk about financial transactions, and those financial transactions are to be converted into information which will be used by the intended users. These transactions will be converted into information in what way, sir? Initially we start with journal entries. So that after that we'll be forming ledger posting. We'll be going to ledger posting, and then we'll form a trial balance. Say for example, financial transactions may contain sales. So all the sales will be all the sale transaction entries will pass, and then we'll take the ledger, and then it will be shown in the trial balance. After that you'll get the information called as sales. That sale information is to be shown in a document called as financial statement, Now these financial statements are prepared by the management for the purpose of intended users. Who will prepare these financial statements? This will be prepared by management. MGMT, management. Prepared by whom? Prepared by management. Under the control of board of directors, because these are the persons who are the highest authorities in governing the entity. Board of directors will approve the financial statements. Financial statements are to be prepared by the management, and then those are to be sent to board of directors, who will ultimately approve the financial statements. And these financial statements are prepared for the purpose of intended users, because it is their money. They invested in the company. They have that right to verify whether that money is being utilized properly or not by the board of directors. For that purpose, they need to prepare the financial statements, which will have the details of summary of all the financial transactions happened during the year. For the purpose of preparing these financial statements, management needs to apply certain framework. framework. Okay, they need to apply certain framework. This framework is called as financial reporting framework. Financial reporting framework. Financial reporting framework. What is this called as? What is this financial reporting framework? Okay, when the financial transactions are to be reported in the financial statements, then we need to follow certain framework. For example, there are certain transactions. Okay, purchase of inventory, and there is some closing stock of inventory. Okay, how to show this closing stock in the balance sheet? Then we need to follow certain standard called as AS2, where they ask you to show the inventory at lower of cost or NRV. So we are trying to show the inventory which is there on the balance sheet date at what rate? Cost or inventory, whichever is lower. Who said this? This is said by Accounting Standard 2. Now you tell me, so with this example, can we say one thing? To report the financial transactions happened during the year, we need to comply with certain framework. Who gives that framework? It is nothing but what? It is the accounting standard what you follow to report the financial transactions. Okay, so this framework is nothing but the standard we follow. Along with that, you tell me one thing. To prepare the financial statements of company, we need to follow with schedule number 3 or not? Okay, we need to follow schedule number 3. It says, okay, schedule number 3 says the presentation of the financial statement. Okay, the disclosures which are required for that financial transactions. Everything will be there in schedule number 3 of Companies Act 2013. Okay, 2013. So this framework includes either it can be accounting standards. Some cases there will be Indian accounting standards, or the law which we need to comply. Okay, example, schedule 3 to Companies Act 2013. Okay, all these things put together, it is called as what? Framework, which the management needs to comply with to prepare the financial statements, which will be approved by whom? The ultimate responsibility is there with whom? Board of Directors only. Okay, this preparation will be under the control of Board of Directors. Hence, they need to approve the same, and that financial statement shall be given to intended users. Now you tell me, intended users called as shareholders, they have given the money to Board of Directors. On behalf of the company, they utilize the money. If they are given with the chance to prepare the financial statements, okay, then will there be any true and fair view that will be achieved? Okay, if there is no one who is verifying independently the financial statements which are prepared by the Board of Directors. No, there won't be any true and fair view when there is no one verifying the same, which is prepared by the Board of Directors, which is approved by Board of Directors. Okay, now there arises the need of some person to be engaged. That person is called as professional. Who needs to be engaged for that entity to verify the financial statements which are being approved by the Board of Directors. Now, what is the work of professional? Okay, a professional is being engaged now. Okay, it is called as an engagement. Okay, and his work is to verify. Or examine whether these financial statements are in compliance with the framework. Okay, because as and when the financial statements are prepared in compliance with framework, then only the true and fair view, okay, the exact position of the company will be known to intended users. For that purpose, these frameworks are developed by various organizations. We'll have that discussion in this session itself. Okay, this framework is given by whom, etc. We'll be discussing that. Why this framework? It gives the standard, okay, to report the financial transactions of an organization through the financial statements. Then these people will get that assurance. Intended users will get that assurance. To get that assurance, first of all, it must be verified by whom? It must be verified by professional. After being verified by this professional, okay, this professional will be able to form an opinion whether these financial statements are in compliance with framework or not. Okay, and this opinion shall be given to the to the intended users through the report. Through the report. Through this report, this intended users will get, the shareholders will get the assurance. Okay, I guess you're all getting the point. They'll get the assurance. Who will get the assurance? Intended users will get the assurance only after the report is given by the professional, after conducting the engagement work independently. Independently. Later we will discuss about this independent concept also. First of all, let us focus on what? Assurance. Okay, now we'll have some discussion on this engagement. Okay, this engagement. There is some work to be performed by the professional or not? Yes. What is that work he is going to perform? And what is the scope of his work? Okay, what is his authority, where he can go and verify, what he can go and verify, everything we need to check up. Before going into that, first of all, I'll make you understand one thing called as this assurance. There are different types of assurances, different levels of assurance, in fact, different levels. There are 4 levels of assurances. Point number 1, it is absolute assurance. Point number 2, it is reasonable level of assurance. Point number 3, it is moderate level of assurance. And last one, it is low level of assurance. This discussion is so much important, for you to understand the concepts of auditing. Before going into that, let us now discuss this levels of assurances. Absolute level of assurance, reasonable level of assurance, moderate level of assurance, and last one is low level of assurance. So after the work is being performed by the professional, he will be now able to give some assurance. What level of assurance is he giving? Is it 100% assurance? Is it 100% absolute assurance is he giving? Or is it the high level of assurance, which is less than the absolute but more than average? More than average. And last one is, anyway, it is low. So after doing work, what level of assurance is he giving? This is what my next discussion is on. This last level of assurance, low level of assurance, it is not so significant, because auditor is expected not to give the low level of assurance after his performance of these duties. Now there are 3 pending level of assurances. First one, it is absolute level of assurance. Now you remember one thing, auditor can never give, that professional can never give this 100% assurance, because of existence of certain inherent limitations. We'll make some discussion on this inherent limitations of audit. First of all, you remember one thing, absolute assurance, that professional cannot give. He can only give the reasonable level of assurance. He can say, after detailed verification, he can say it is right or wrong, whether the financial statements are showing true and fair view or not. That is what he can say, but he can give the reasonable level of assurance, which is also called as high level of assurance, but it is not high as absolute. And he can also give the average level of assurance, called as moderate level of assurance also. Depending upon the level of assurance he provides, that engagement, here what we discussed, this engagement can be divided into 2 types. These engagements can be divided into 2 types. The professional is engaged. This professional is, who is this professional? He is a CA in practice. A CA holding certificate of practice. What kind of engagements are there? There are 2 kinds of engagements are there. One is assurance engagement, other one is non-assurance engagements. Assurance engagements. What is this assurance engagement? Now the auditor is appointed for the purpose of giving assurance. On what he is going to give the assurance? He is going to give the assurance on historical financial statements. Write it detailed. In full form you can write historical financial statements. And second one is, other than historical financial statements. What is historical financial statements? Those financial statements which were already prepared by the management. Okay, on that if he is going to give the assurance, and that too, okay, this historical financial statements shall also be divided into two types. If the practitioner is going to give the assurance which is reasonable level, after detailed verification, okay, if he gives the reasonable level of assurance, okay, then that engagement is called as audit engagement. That engagement is called as audit engagement. If he is going to give only moderate level of assurance, he is just reviewing, he is not finalizing anything, he is just reviewing, then it is called as review engagement. Example for that is interim financial statements audit. Okay, it is not the financial statements, it is just a review of interim financial statements. This engagement is called as what? Review engagement. Okay, moderate level of assurance. Coming to third point, it is what? Other than historical financial statements. What is this? It may be the example may be projected financial statements. The assurance level is what? Moderate only. High level of assurance he cannot give because those transactions are not yet happened. Okay, those financial statements are projected financial statements, future oriented. On that you cannot give reasonable level of assurance. You can only give what? Moderate level of assurance. If he gives the moderate level of assurance on other than historical financial statements, then it is called as what? Assurance engagement. Then that engagement is called as assurance engagement. Okay, and coming to last point, it is non-assurance engagement. What is non-assurance engagement? It is just a representational service provided by the professional before any income tax authorities or something like that. Okay, he is just representing his client before someone. Okay, there is nothing called as assurance which has been given by him. He is just representing someone. Okay, representing someone before someone. It is called as non-assurance engagement. Example is representational services. Okay, it is called as related service. Okay, the main service what he provides is assurance service. Okay, anything other than assurance service is called as related services. Okay, these are the kinds of engagements what he is having. Okay, kinds of engagements, and for every engagement, okay, there is certain framework to be followed by the auditor also for the purpose of doing that engagement. Okay, so what is that framework? Those are called as standards. Those are called as standards. Standards on auditing, standards on review engagement, standards on assurance engagement, standards on related service. See, standards on auditing, standards on review engagement. Okay, next one, standards on assurance engagement. Last one is standards on related services, SRS. What is this standard? Okay, this standard contains the best practices to perform the engagement, to perform the work. Best practices. Okay, it sets the guidelines how to perform the work, what to do, what not to do. Everything will be discussed in this standards. Okay, now okay, in this revision we are going to learn who sets this particular standards in India. That is also the work we need to do in this current session itself. Okay, these are the standards, and along with that there is one more standard called as standard for maintaining the quality. So whenever he performs the work has to be performed with quality. Okay, quality. So how to achieve that quality, how to maintain that quality and all, it is discussed in another separate standard. So on top of all the standards, there is one more standard called as SQC. Okay, standards on quality control. There is only one standard in it, SQC, and which is to be applicable for all the above standards called as SA, SRE, SAE and SRS. Okay, now all these five put together, it is called as engagement and quality control standards. Okay, engagement and quality control standards. Okay, in this session I am going little slow for the purpose of making you understand the terminologies of this particular subject. Okay, engagement and quality control standards. Okay, if you are aware of all these things, you can just keep 1.5 or 1.75 speed to watch this lecture. Okay, or if it is for the first time you are listening all this, then there is no problem, you can watch at 1.25. Okay, done. These all put together, it is called as engagement and quality control standards. What are the engagements? What are the engagement standards? SA, SRE, SAE, SRS. Okay, what is this quality control standard? Quality control standard is SQC1. All this put together, it is called as engagement and quality control standards. Now, in this discussion of this subject, okay, what is relevant out of these 5? This SA is relevant and this SQC is relevant. These both are there in the syllabus. Remaining 3, they are not there in the syllabus. Okay, so though there are 5 types, we are only going to focus on SA and SQC1. So there are almost 35 SAs. Out of 35, almost 9 standards are not applicable for you. So we are going to focus upon 25 standards. Each standard will take around 10 to 15 minutes for me to complete. Okay, so this standard SAs and along with that SQC I am going to discuss. On an average, there are 26 standards which I am going to discuss in these sessions. Okay, some standards are very, very small. Those may be given for you as homework. Okay, so most I'll cover all the topics. I'll try to keep as simple as possible. I'll try to complete within very less time, in fact. Okay, covering all the areas. Done. Then I guess you're all getting the point clear. You understood engagement and quality control standards. Now, okay. In the above discussion, I stated one thing called as a professional will be engaged. A professional will be engaged for the purpose of forming an opinion on the financial statements, which is to be reported to the intended users. Okay. Now, what will he do in this engagement? This is what my next concept is. Okay. What will he do in this engagement? Okay. Now, let us jump into the material which talks about the determination of scope of the audit. What he needs to do, what is his authority to do, okay, what areas he needs to verify. Okay, now we need to determine the scope of his audit. Now you tell me, okay, what is his work actually? Okay, his work is to verify whether the financial statements showing true and fair view or not. Are they misleading in nature? Okay, are they misleading in nature? When can you call a financial statement as misleading in nature? As misleading in nature. Okay, for that there is one question for us to discuss. Okay, let us go to points to be ensured that financial statements are not misleading anybody. Okay, if these conditions are there, then we cannot call that financial statements as misleading. Those are achieving true and fair view. That is what we can call in simple way. Okay, so these conditions are to be satisfied. Sir, what are to be satisfied? Point number 1. Now you tell me one thing. To prepare the financial statements, first of all, okay, books of accounts must be there. Okay, using that books of accounts, okay, using that supporting documents, we'll have, okay, journal entries. Based on that, we'll post ledger postings. Okay, based on that, we'll prepare the trial balance. In that trial balance, what will be there? All the ledger balances will be there. Now you tell me one thing. Whatever the, okay, ledger balance we have, for that, do the company needs to have a supporting document or not? Yes. Okay, say example. In the trial balance, there is a sales account. Okay, for that, do we need to have, okay, supporting evidence or not? What is the supporting evidence for sale transactions? It is sale invoice, and all the sale invoice shall be there for the purpose of bringing the sale balance here in this trial balance. Now you tell me one thing. This trial balance, okay, ledger balances which are shown in the trial balance shall be forwarded to financial statements or not? Yes. Okay, there are 3 things to be matched now. Now, there are 3 things to be matched. What are those 3 things? Financial statement balances will be matching with what? Ledger balances. Financial statement balances will be matching with what? Ledger balances. So, whatever it is there in the ledger, okay, that shall have the supporting evidence. For example, in our example, what is it? It is sale invoice. So, supporting evidence must be there. If the supporting evidence is there, then the trial balance will be correct. Then the ledger balance will be correct. And if it is absolutely carried forward to, okay, financial statements, then we can say all this is correct. Okay, this is not misleading in nature. Okay, these financial statements are not misleading anyone because everything is fair now. There is a supporting evidence which is carried forward to ledger balance which is carried forward to financial statements. If everything is matching, then we cannot say those financial statements are misleading in nature. Okay, now I am going to the material back again. Okay, see what is to be matched. Ledger balance shall match with books of accounts. Okay, and sufficient appropriate evidences must be there. What is this evidence? Supporting evidence, supporting documents. Example, sale invoice. Point number 2 is clear. Okay, and whatever the transaction we incur in the financial year, all those transactions must be reported in the financial statements or not? Yes, those are to be accounted for. First of all the transactions are being recorded in the books of accounts. If you fail to record all the transactions in the books of accounts, then how can you call that financial statement as not misleading? Okay, you cannot call it as no misleading nature. Okay, to call it as no misleading nature, then we must record all the transactions in the books of accounts. I guess you're all getting the point. Next one. Okay, so the financial statements, whatever we write, it must be clear and unambiguous. There shall not be any confusion. There shall not be any confusion. Unambiguous means confusion, no confusion. Okay, and whatever the balances we take in the financial statements in the books of accounts, in the ledger balances, okay, those must be properly classified. If some expenditure is revenue expenditure, take that in P&L account. If some expenditure is capital expenditure, take that in the balance sheet. Okay, that is what we need to check. If the financial statements are properly classified, see, the amounts shown in the financial statements are properly classified, then there won't be misleading nature for that financial statements. And the preparation of the financial statements shall be in accordance with applicable accounting standards. If they are not matching with applicable accounting standards, then those are to be called as financial statements which are prepared in misleading nature, and those financial statements shall reflect the true and fair view. Okay, this is the first question we discussed. Okay, when can you call financial statements as not misleading? All these points must be satisfied. And now the second question, okay, scope of the audit. What he can do in the progress of audit? He can do what? He shall cover, okay, all the aspects which are relevant for financial statements. It may be assets, it may be liabilities, it may be incomes or expenditures. Everything he needs to cover which is relevant for the financial statements. Point number 1, he should cover the examination of all aspects. First point, what is to be highlighted? Examination of all aspects of the entity, okay, which is relevant for financial statements. Point number 2, he needs to assess the sufficiency and appropriateness, quality and quantity, okay, quality and quantity of the accounting records, supporting evidences, quality and quantity of the supporting evidences. Okay, see, you need to check up one more thing. All this ledger posting, journal entries, trial balance, everything is now, okay, it is made using accounting systems which work on the basis of information technology through computers. Now as an auditor, you need to have the knowledge of systems also, accounting systems, and when it is carried by the accounting system, there must be proper internal controls which are put in place, okay, so that accounting system can be prevented by unauthorized access. See, for example, there is one software called as Tally, which takes care of all this ledger posting, etc. Okay, this balance sheet, finance statements are prepared by whom? Tally itself. Once we enter the journal entry, Tally will automatically prepare the balance sheet. Okay, now you tell me, to say the financial statements which are prepared by the Tally software, okay, is it true and fair view? This is what you are trying to say. Okay, for that purpose, auditor shall have the knowledge of this Tally, okay, the accounting system, what they follow, and along with that, the internal controls which are put in place by the organization. Why this internal controls, sir? Because this is the system. If it is, okay, prone for unauthorized access, if someone comes to the entity, someone accesses this Tally, if they passes some unauthorized entries, then how can you say the financial statements as not misleading? Okay, okay, if it is not protected by the organization, because all those are unauthorized entries which are passed by unauthorized persons, which may lead to misleaded financial statements. Now, as an auditor, you need to determine whether the financial statements are misleading in nature or not. For that purpose, you need to have a look into what? You need to have a look into accounting system and how it is protected by the internal controls. For that purpose, they'll implement the password system so that no one from outside they can come into the organization to pass unauthorized entries. That is what we need to check on. So this shall form part of scope of the audit. This is the second point. See. Evaluate the accounting system and internal controls. So what is the use of internal controls? That is what I am discussing now. Okay, done. Perform necessary tests and inquiries and other verification procedures of accounting transactions and the accounting balances. We need to check up. This is actually called as, okay, work to be performed by the auditor. He is performing some tests, inquiries and other verification procedures. Okay, and he needs to determine, okay, see next point, to determine whether the information is properly disclosed in the financial statements. Okay, as per the applicable accounting financial reporting framework, whether it is disclosed or not. And auditor may involve comparing the financial statements with underlying records. I already told you previously, underlying records must be there. These records must support the financial entries, that journal entries, ledger postings and financial statements. That is what he is verifying, comparing the financial statements with underlying records. Okay, there may be sometimes the judgments by the management is required in preparation of the financial statements. Judgments, very, very important point. Judgments, say for example, provision for doubtful debts. Okay, is it a finalized figure? No, it is just an estimation where the management judgment is required. Okay, so financial statement preparation is based on what? Judgments by management. Now, as an auditor, you need to consider the judgments which are made by the management is appropriate or not in the circumstance. Okay, and auditor is not expected to perform those duties which fall outside the scope of the competence, scope of his work. Okay, with this, okay, this fifth point you will leave as of now. Later we will come back to it. Okay, you will be able to understand after I discuss, okay, standard number 210. So let us now wind up this, okay, question called as determination of scope of audit. Coming to the next question, okay, aspects to be covered. So you went to an audit. So what you are required to do? First point, you need to examine accounting system and internal control. This is what we discussed just now. Okay, you need to you need to examine the accounting system and internal controls. Okay, because the management may use the different types of, okay, softwares, and they can implement different types of internal controls for the purpose of securing the best financial statements to achieve the true and fair view. Okay, this is point number 1. Come to point number 2. Auditor needs to review the system and procedures what they follow. Okay, auditor needs to vouch the transactions. What is vouching? Vouching is nothing but examination of figures of balance, figures of P&L accounts. Okay, either incomes or expenditures. When the auditor verifies, it is called as what? Vouching. Okay, let me write here. P&L items. Okay, P&L items, also called as class of transactions. Also called as class of transactions. When the auditor verifies the class of transactions or P&L items, it is called as vouching. When the auditor verifies balance sheet items or okay, account balances, also called as what? Account balances. Balance sheet items are also called as what? Account balances. Then it is called as verification. Then one more important beautiful point, that is what? When the organization is formed, it is registered, it needs to comply with many statutory laws, many laws which are applicable for the organization. They need to comply with that or not, and the financial statement shall be prepared in compliance with that laws. Okay, now as an auditor, you need to check whether the organization is complying with the statutory compliances, organization is complying with various laws which are applicable or not. This is what we need to verify. Okay, next important point is statutory compliance verification. Okay, and last one, what he needs to do? He needs to express the opinion whether the financial statement shows true and fair view or not. What is true and fair view? Wait an hour. Okay, we'll be having the detailed discussion on true and fair view. Okay, done. These are the things he needs to do. Let us go to next aspect. So what is the work for you now? Okay, this is work given as homework. Okay, this is the question given as homework. Advantages of audited financial statements. Okay, so simply I can say one thing. It helps the intended users to know whether the funds which are provided by them are properly utilized by the company or not. This is the first advantage, basic advantage. Okay, and audit works as moral check on employees. Now you tell me one thing, there are some employees who are working for the organization. Okay, they'll work so well if someone comes and verifies them. If no one is coming, okay, to verify them, then there won't be any proper, okay, proper exercise of their work. Okay, that is called as moral check on employees. If someone is coming to verify them, they'll work very well. That happens only when there is an audit, which is performed by a chartered accountant. Okay, it will be helpful for settlement of trade disputes. Okay, it detects the wastage. Okay, this is the work which is given to you. Okay, now you need to read this at home. Basic question which will not come in the examination. Homework. Okay, it may not come in the examination. It is just for your understanding. Okay, just for your knowledge. You can read 4 or 5 points. Okay, in any case, when it comes in the examination, I cannot do anything. At that particular point of time, you need to at least write 4 or 5 points to get some good marks. Okay, this is given as homework. Okay, next one. So we are done with types of engagements and levels of assurances. Now the last area, okay, before I give a break for you. Okay, so intensely I am going. Okay, slowly we need to understand everything. Okay, I am covering all the aspects of this chapter. Now let us go to this question. Let us go to this question called as relationship of auditing with other disciplines, other areas, other subjects in fact. So while a professional is performing his work, is he required to have the knowledge of other areas other than auditing? Yes, he has to have the knowledge of accounting, because auditing starts only when accounting ends. Okay, whenever there is an accounting done, okay, that has to be verified, right? So he has to have the knowledge of accounting also. If not, how can he say whether the accounting is proper or not without having the knowledge? Okay, that is the first point. He has to have the knowledge of accounting, and he is an expert in fact. So the auditor in India is an expert of accounting. Okay, point number 1. And point number 2, he has to have the knowledge of law also, because let me take one small example. Okay, Schedule 3 we need to comply with while preparation of the financial statements of a company. Okay, now as an auditor you are checking whether the finance statements are in compliance with law or not. Okay, now is he required to have the knowledge of Schedule 3 or not? Yes, without knowing Schedule 3, how can he say whether the financial statements are prepared as per Schedule 3 or not? So he has to have the knowledge of various laws. Example, Companies Act 2013, and along with that various other laws, Income Tax Act, ESI, PF, everything he needs to have the knowledge of. Next, auditing and behavioral sciences. Okay, what is behavioral sciences? Okay, during the process of okay, doing the work, he has to talk to many people who are there in the organization. Either it can be board of directors or employees of the organization. Okay, each person will behave in their own individual way. Okay, now as an auditor, before you talk to someone, you need to have that knowledge of behavioral sciences. Who behaves in what way, that he needs to have a basic knowledge. Okay, before he interacts with someone. Okay, that is called as auditing and behavioral sciences. Point number 4, it is auditing and statistics and mathematics. Okay, so there may be huge transactions in a financial year. Okay, for that matter, he may not verify all the transactions. It may not be possible for him to verify all the transactions because of time constraints. For that reason, he needs to select some good samples out of total population. Okay, out of total number of transactions, he needs to pick up some beautiful samples and needs to apply the procedures on those samples itself. How to select that samples and all, it is there in statistics subject called as probabilities, etc. He needs to have the knowledge of. Okay, this is called as statistics and mathematics. And data processing we all know, because there are many organizations like banks and insurance companies where they mostly depend upon computers. The knowledge of the same is now required for auditor who is auditing the okay, banks and insurance companies in particular. There may be other, okay, companies also which are, okay, mostly dependent upon the systems, computers. For that reason, auditor is expected to have the knowledge of data processing systems also. Use of computers also you can write. Use of computers. Okay. Next one, auditing and financial management. We know, okay, auditor is required to, okay, have the knowledge of budgets and all. Later we will get some knowledge of this point when I discuss standard number 520. Then we'll get the knowledge of the same. And this auditing and production also. Okay. So you can just quickly read this too. Okay, auditing and production also. Production related knowledge also is required to have. Okay, because he has to have the knowledge of inventories, excess inventory, shortage of inventory, okay, EOQs, etc., which is there in costing subject. For that reason, he needs to have the knowledge of production related also. With this, I am done with relationship of auditing with other disciplines. Okay, let me go to next area. 3 questions I am going to discuss, and after that I am going to give you the break. 3 questions. Okay. Now you all got to know engagement and quality control standards. Okay. Now, who gives these standards? Okay, these standards are applicable at 2 levels: international level and, okay, national level. Okay, because each nation will have their own laws. Okay, to comply with those laws, they have their own standards which are matching with their national standards, national level customs, national level laws. For that reason, I divided entire standards into 2 levels: international level, national level. Okay, at international level, who set the standards? Okay, there is a supreme authority for accountants. This is called as IFAC. International Federation of Accountants. It is an organization, okay, which is the supreme organization for, okay, entire world for accountants. Okay, this organization is having various wings to perform different duties. Okay, out of that, one of the wing is IAASB. Okay, IAASB, International, okay, Auditing and Assurance Standard Board. International Auditing and Assurance Standard Board. You need to write the full form: International Auditing and Assurance Standards Board. What is IFAC? IFAC is International Federation of Accountants. Now, these people will establish, okay, the standards. What are the various standards we have? You know that. Okay, we have auditing standards. Okay, we have other assurance standards also, like SRE, okay, REAE. These are called as what? Other assurance standards. And we have the standards for related service. We have the standards for quality control. Okay, at international level, these standards are set by whom? IAASB. That question we are going to cover now. See. Okay, what is the role of International Auditing and Assurance Standards Board, IAASB? Okay, IAASB is a part of IFAC. Okay, what they do? They establish high quality auditing standards. Okay, and also they give the guidance for the same, how to comply with the standards and all. They'll give some guidance. Okay, we'll have the discussion on guidance also now. Okay, establishing high quality auditing standards. Okay, which are nothing but what? ISA. What is ISA? International Standards on Auditing. Okay, now point number 2. They establish high quality standards and guidance for other type of assurances. What are other types of assurances? Okay, assurance services. What are other types of assurance services? It may be ISRE, ISAE. Okay, these are other types of assurance services. Okay, and then high quality and guidance for other related services. What are those? ISRS. ISRS. Next one, high quality. Next one, high quality standards for quality control. High quality standards for quality control. Can I write like this? International standards on quality control, ISQC. Okay, these are established by whom? These are established by, okay, IAASB. This is the role of IAASB. Okay, when we know that chart, this question is so simple. And along with that, okay, they can publish any other pronouncements and auditing matters, okay, which may help the public to understand the responsibility of the professional. To what extent this professional is responsible for public, okay, that they can establish. Publish other pronouncement on auditing and assurance matters, thereby advancing the public understanding on the roles and responsibilities of professional auditors. Okay, I guess this question is over for you now. Okay, let us go to this side. Okay, second side. At national level, who forms this, okay, standards? At national level, who form these standards? Like how we have IFAC for international level, for India we have ICAI, our beautiful body, okay, respectable body, where we are getting our membership. Okay, I got my membership in 2018. Okay, and now you are in a competition, or you are in a way to get your membership from ICAI. This is the supreme authority in India relating to accounting and auditing, that is ICAI. Okay, like how we have different wings for IFAC, in the similar way ICAI is also having different wings. Out of that, Board of Studies is one of the wings, okay, where you are applying your you are getting your study materials, etc. Okay, in the similar way, this ICAI is having Auditing and Assurance Standards Board. Auditing and Assurance Standards Board. Okay, this is one of the wings of ICAI, where they will look after the process of setting up this, okay, standards in India. Okay, standards in India. Okay, they will prepare. Okay, under AASB there will be some study groups. Okay, these people, these study groups, okay, will investigate everything, and they will form a draft. They will form what? Draft auditing standards. Draft audit standards they will keep. Draft audit standards, and those standards are given to all the members of ICAI. Okay, even I do get this draft, okay, to recommend something more, okay, to comment on the same draft audit standards. Okay, on this draft audit standard, who needs to report? Who needs to make any, okay, comments or suggestions? This draft will be given to members of ICAI, where they can suggest something, or they can comment on the same. Okay, then after taking the suggestions from these members, okay, this AASB, okay, will issue the final draft. This is the sequence of, okay, setting up the standards in India. This final draft will be now given to council. Okay, like how we have board of directors for a company, for ICAI also there is some council. Okay, there is some council. This final draft will be given to council, and council, okay, it may issue this as it is to, okay, to public, or this council may change the final draft after talking to AASB. Okay, what this council will do now? This council may release the standards, to central government. In fact, central government will notify the same. Okay, release the standards. As of now, it is directly by ICAI to central government. Now, if there is NFRA which is to be implemented completely, NFRA, National Financial Reporting Authority, for them this council needs to report, and they'll report to central government, and central government will, okay, notify the same. So as of now, what I am trying to say, release the standard to whom? Central government. Central government, by notification it will issue. Okay, so now what is the standard setting process in India? Under ICAI there is one wing called as AASB. Under AASB there are some certain study groups. They'll create a draft on any particular standard. Okay, that draft will be given to all the remaining members, and they'll comment on the same. and that draft will be now finalized by AASB, and that final draft is now given to council, and council may it may release the standard as it is, or it may make some changes after talking to AASB, and that will be given to central government, and the central government will notify the same, and it will come into applicability. Okay, this is the next second question. What is this? Okay, standard setting process in India. Let us go to the material. This is standard setting process in India. Everything is detailedly discussed. Okay, all these points are now covered by me. Okay, now last point, objectives and functions of AASB. What AASB will do? We know one thing, they formulate the standards in India. That is one of the functions of AASB. So that I need to just highlight. To formulate engagement standards and quality control. Okay, engagement and quality controls, and that standards will be formed by whom? AASB. This is what we discussed till now. And remaining roles we need to just see. Okay, this AASB, they will look into the world standards, international standards. Okay, and they always try to evaluate whether those international standards are required for national level also. Okay, this is the check they make every time. See, to review the existing emerging auditing practices worldwide, international level practices they look into, and they'll identify those some of the areas which require to be developed in India. Okay, this is the first function. Second function we know, 1, 2 are done. And point number 3, they look into existing auditing standards in India. Okay, they check whether those are enough or not for present situation. See, they review the existing standards and statements on auditing, to assess their relevance in changed conditions. Okay, because day by day new practices are coming into picture, and emerging like the certain new conditions are into picture. Previously we used to have 1956 Companies Act Companies Act. Now after that we have Companies Act 2013. All the acts are getting changed now. For that reason, the existing auditing practices, auditing standards, are they required to be changed to match with the revised conditions? That is what it is to be reviewed by whom? AASB. Third condition, it is so simple. Okay, along with that, this AASB is also required to issue certain guidance notes. So what is this guidance note? When there is any certain area relating to audit, so AASB will give guidance to the members how to implement that particular standard, how to do the work related to that particular area. Okay, say for example, so there is some tax audit under 44 AB of Income Tax Act. Okay, how to conduct this audit? Okay, there is a guidance note which is released by AASB, which needs to be complied by whom? Auditor while doing that work. Okay, it is just a guidance for the member to do certain work. Okay, those guidance notes are to be issued by whom? AASB. Okay, and also they look into the existing guidance note. They check the relevance of the existing guidance note in the changed conditions. We all know that. This point is also clear. So these 2 points are talking about guidance notes only, and to formulate general clarifications, etc. on the issues of standards. Okay, on applicability of the standards, etc. Okay, they'll release some general clarifications, because the auditors may get the doubt relating to audit standards. For that reason, AASB will release general clarifications on how to implement the standards, how to do the work as per standards, etc. It will be clarified by whom? AASB. Along with that, AASB may give the guides, practice manuals, and other papers, which can guide the professional accountants. Okay, with this I am done with what? AASB. So AASB will look into what? AASB will look into industry world standards, and they will try to implement at national level also. Okay, if it is required. Okay, they'll look into the existing standards, and are they matching with the revised conditions or not? They check. Okay, point number 3. Okay, they identify some new areas where the standards are required. This is point number 2. See, they formulate engagement standards. This is the role for them to do. Okay, this is objectives and functions of AASB. In detail, we have completed the first part of chapter number 1. The first part of chapter number 1. Okay, let us take some small break now. We'll complete the second chapter, second part of chapter number 1 also within no time. Around 30 to 35 minutes we'll be completing the second part of chapter number 1. Okay, done. Thank you. We'll meet after the break. Welcome back. So after the break we are going to continue with chapter number 1 part B. Okay, it is the last part of chapter number 1, and unfortunately we need to go to chapter number 4 also, okay, to complete this chapter number 1. So to some extent I will go to chapter number 4, here and there I will pick up some topics and keep in chapter number 1. Okay, so I cannot help you in this, okay, because those all topics are interrelated. I need to go to chapter number 4 before I complete chapter number 1. So let us now continue with this. Okay, done. So next topic is inherent limitations of audit. As you all know, there are 4 levels of assurances, and first level of assurance is absolute level of assurance. It is 100% assurance no one can give, okay, because of the reason of existence of inherent limitations. Okay, okay, why one cannot give absolute assurance? Because of existence of inherent limitations. Okay, what are the inherent limitations which are there? This is what we are going to learn now. See, inherent limitations, it is point number 1, nature of the financial reporting. So when we do, okay, when we check the financial reporting, when we check the financial statements, the preparation of the financial statement itself, okay, includes some judgments, some estimations. Okay, estimations and judgments, those are actually not actual figures, finalized figures. Okay, those are just an estimates. It depends on the judgments which are made by the management. So as an auditor you cannot say 100% whether it is right or wrong, whether the estimates are correct or wrong. Okay, so that is the reason why nature of the financial statement financial reporting includes, okay, the preparation of the financial statement includes what? Includes estimates. It includes estimates. It includes judgments. Okay, judgments by management. For that reason you cannot give absolute assurance, because those are not finalized figures. Coming to second point, nature of the audit procedures. So there are different kinds of audit procedures which are available for the auditor to check the financial statements. Okay, let me take few of them. Okay, later after 5 or 10 minutes I will be writing all the, okay, audit procedures which are available for the auditor. For the time being, okay, let us take one small example. Auditor is now willing to inquire the management. He decided to inquire with the management, and now management is not providing the exact information what the auditor is requiring. Okay, for that reason the selected audit procedure is inquiry, and based on which, okay, the auditor is not getting the audit evidence whatever he is expecting. Okay, so here the inquiry is the procedure which is not working for auditor. Okay, there may be some instances where the other audit procedures are also may not be suitable for the, okay, suitable as the selected audit procedure. Okay, for that reason it is called as nature of audit procedures. Sometimes you remember one thing, so how well the audit is being conducted, it depends on the, okay, the auditor has selected the right procedures, but in fact the existence of fraud which is carefully concealed by the management, okay, which may affect the audit procedure go waste. Okay, the audit process may be, okay, it may be gone wasted. Okay, irrespective of whether the audit processes are appropriately chosen by the auditor or not. Okay, this is the second point, nature of the audit processes. How well the audit processes are applied by the management, applied by the auditor, it is not relevant when the fraud is in existence. Okay, this may be the example for what? Nature of the audit processes. And one more thing you can write, in some circumstances few audit processes may not be suitable. Okay, that example and all we will discuss later. For the time being, nature of the audit process is the second inherent limitation for the audit. Coming to third point, okay, timeliness of financial reporting and balance between, okay, benefit and the cost. Now accounting is being done by the management for entire year, but those financial statements after it is been prepared by the management, okay, those financial statements are to be given to the auditor, and auditor now gets only limited time to complete the audit. He cannot verify all the transactions happened during the year within the given limited time to the auditor. Okay, so entire 12 months transactions we need to verify, we may need to verify within 1 month, which may not be sufficient time for us to complete. That may be the reason where we go, okay, on a sample basis, irrespective of, okay, in place of verifying all the transactions, we may go, okay, on sampling basis. That is the reason for, okay, not giving absolute assurance, because if you can verify all the transactions, then it may be possible for you to give absolute assurance. But if there is time constraint and cost constraint, then you cannot verify all the transactions, and hence you cannot give, okay, what you cannot give absolute assurance. This is okay, this is third point, timeliness and, okay, balance between benefit and cost. Okay, sometimes, okay, doing the audit may be a costly affair. So the advantage what we get from the audit, okay, it is less when compared to the cost we incur to conduct the audit. So there is no point of conducting the audit at all in that case. So limited audit will do rather than verifying everything. Okay, for that reason it is called as inherent limitation of audit. Okay, and coming to last point, it is an important question. Okay, it may come in the examination in this attempt. Okay, there are some instances, okay, and we all know that how well the audit is being conducted by the auditor, you cannot give absolute assurance. Okay, there may be always, okay, some limitation in the auditor. Okay, there may be always some limitation in audit. Okay, he can only give a reasonable assurance, then, okay, he cannot give what? Absolute assurance. Okay, however, there may be some instances where the effect of this limitation is huge. Okay, what are those areas where the impact of this limitation of audit, okay, inherent limitations of audit is huge? Okay, following are the areas where the inherent limitations will affect the audit, okay, at high level. Okay, point number 1, fraud. Okay, fraud, particularly fraud involving senior management, because identifying the fraud when it is done by the senior management is difficult than identifying the fraud which is done by the lower level management. Okay, this is significant to the audit. Okay, how the question will be asked in the examination? In the examination they will give like, okay, what are the areas where, okay, it will potentially affect the audit if there is any, okay, if there is any limitation which is in existence for the audit. Okay, potentially affect the audit. These are the areas where the inherent limitations will potentially affect when happened in these areas. Okay, then point number 2, existence and completeness of related party relationships and transactions. The transactions with related parties is the second area. Point number 1, fraud. Point number 2, related party transactions. Point number 3, non-compliance of laws and regulations. Third point, non-compliance of laws and regulations. And fourth point, future events or conditions that may cause the entity to cease to continue as a going concern. So first one, fraud. Second one, related party relationships and transactions. Point number 3, non-compliance of law. Point number 4, going concern. These are the 4 areas where it will show the potential effect in case if it is affected by, okay, if it is affected by inherent limitations of the audit. Okay, these are the 4 things you need to write. It is given for 4 marks in the recent attempt for CA final. It may be there in your examination also at any point of time. So these are the 4 areas which are very, very significant for the examination point of view. Okay, it may come in the examination this attempt, I guess. Okay, done. These are the inherent limitations of the audit. So with this I can go to standard number 200. Let us write the standard numbers first of all. Okay, standard numbers here are divided into various series: 200 series, 300 series, 400 series, 500 series, 600 series, 700 series. Even though 800 series is there, but it is not there in the syllabus. Okay, done. 200, 210, 220, 230, 240, 250, 260, okay, 265, 299, 300, 315, 320, 330, 400 it is not there. Okay, 402, 450, 500, 501, 505, okay, 510, 520, 530, 540, 550, 560, 570, 600, 610, 620, 700, 701, 705, okay, 706, 710, 720. Okay, these are the standards which are there in the syllabus. Okay, however, out of this 9 were excluded. 9 standards were excluded, and in our discussion I will be leaving this 9 standards. In fact, standard number 330 they have eliminated. Okay, but still without standard number 330 we cannot proceed. For that reason, okay, though it may not be there, may not, okay, be there in the syllabus, but still I just need to discuss this 330 also. Okay, I can't help it now. Done. So these are the standards we are going to discuss. Out of that I am going to start with standard number 200. Okay, in its entirety standard number 200 cannot be discussed at a time. However, after starting standard number 200, I may go to chapter number 4 and come back to standard number 200. Okay, so standard number 200 it is there in chapter number 1, but still I may go to chapter number 4 sometimes, get some details from there and come back to standard number 200. So let us now start with standard number 200. Okay, let us read the heading for the same. Let us read heading for the same. So it is overall objectives of independent auditor. Overall objectives of independent auditor. Overall objectives of independent auditor, and second part of this standard is conduct of audit in accordance with SAS. Overall objective. What is called as objective? Okay, overall objective. Objective is nothing but purpose for which the auditor is doing this work. Okay, auditor is doing the audit. Okay, so overall objectives of independent auditor, and second aspect of this standard is conduct of an audit in accordance with standards on auditing. So see how to conduct the audit. Okay, it shall be conducted in accordance with SAS. It shall be conducted in accordance with SAS. So two parts. In two parts it got divided into. Part number 1, it talks about overall objectives of independent auditor. Very, very important question. From this only we can derive all the areas of audit, all the aspects of audit in detail. So point number 1, okay, first objective. In conduct of an audit, the overall objectives of the auditor are, okay, to obtain reasonable assurance. What is reasonable assurance? It is high level of assurance. How can you get the high level of assurance? Only when the auditor is able to verify more number of transactions. Okay, to obtain reasonable level of assurance, high level of assurance he needs to get about whether the financial statements as a whole are free from material misstatements, whether due to fraud or error, and thereby enabling the auditor to express an opinion, okay, on whether the financial statements are prepared in all material respects in accordance with applicable FRF. This is the first objective. Let me write in detail. Okay, first we are done with inherent limitations. What are the 4 points? Nature of financial reporting, nature of audit procedures. Point number 3, timeliness and cost effectiveness. And point number 4, other areas. Okay, now let me write overall objectives of independent auditor. Objectives of independent auditor. Okay, point number 1, to obtain reasonable assurance that financial statements are, okay, point number 3, free from material misstatements. Okay, material misstatements. Let me write in detail. It is so significant. Material misstatements. Financial statements are free from. Financial statements, okay, do not contain material misstatements. First time we are listening to the word called material misstatements. First of all, let us talk about misstatement and then we'll come back to materiality. Okay, so what is misstatement? Misstatement is nothing but the difference between, okay, it is the difference between what it should be and what it is. Okay, what it should be as per FRF. See, when you do accounting, when you prepare the financial statements, something you need to follow, that is called as what? Financial reporting framework. Example, I told you that, okay, accounting standards or Indian accounting standards, okay, or okay, and in case of company it is schedule 3 also. All these things we need to follow while we prepare the financial statements. Okay, so there is something you need to follow and you need to report in the financial statements. Okay, you need to, what you need to do? You need to present the financial statements. Okay, you need to disclose something in the financial statements. you need to record the transactions, you need to value the accounts, you need to value the fixed assets, okay, you need to do everything, okay. When it is not done properly, okay, what is to be presented if it is not presented as per FRF? What is to be disclosed? Okay, as per AS18 you need to disclose the related party relationships, but you fail to disclose. This is also called as misstatement only, okay. Not disclosed, okay, not recorded, okay. The company failed to record the transactions, the management failed to record the transactions in the books of accounts, okay, but they recorded, okay, there may be another case, they recorded but incorrectly recorded. See, incorrectly recorded, okay, not valued properly. Some of the assets are not valued properly, some of the assets are valued without taking depreciation at all, okay. Some of the expenditures are not properly classified, okay. It must be classified as capital expenditure, but you fail to treat it as capital expenditure, you have taken into P&L account. All these put together, it results in what? It results in misstatement. What it should be there and what it is. Misstatements, okay. Is what? Misstatements, okay. And these misstatements, when they are significant in nature, say for example, there should be 1 lakh rupees asset value, okay, but in the books of accounts it is taken, in the financial statements it is taken as 1,01,000, okay. It may not be that huge misstatement, it is called as insignificant, okay. Insignificant. When in place of 1 lakh, if it is taken as 10 lakh, it may be significant misstatement, okay. That gives you the materiality, that is called as materiality, okay. The amount, okay, where it is considered as significant, okay, where it is considered as significant is called as material misstatements. We'll have a detailed discussion on this materiality in standard number 320 in the second chapter, okay. As of now, for the purpose of understanding, I'm defining materiality as significant, but there is different, okay, meaning for that, different definition for that. For the time being, it is called as what? It is called as only significant, okay. So the auditor has to get the reasonable assurance that financial statements are free from material misstatements. What he needs to verify, okay, to come to this conclusion? He needs to apply, okay, many procedures and get the audit evidence, so that he'll get the reasonable assurance that financial statements are free from material misstatements, okay. How can he get to that opinion? Only after, okay, applying some procedures, okay. He can get the reasonable assurance only after the audit procedures, proper audit procedures are applied. When the proper audit procedures are applied, okay, he'll get audit evidence, whether the financial statements contain misstatement or not, material misstatement or not, that evidence he'll get, okay. He'll get the audit evidence only when the audit procedures are applied. What are the audit procedures is going to apply? Okay, there are 7 audit procedures as per standard number 500. 7 audit procedures. Inspection, point number 2. Inquiry, okay, point number 3. Observation, point number 4. External confirmation, point number 5. Analytical procedures, point number 6. Reperformance, okay, point number 7. Recalculation, okay. These are the procedures what the auditor will apply to get the audit evidence. What is inspection? Inspection is nothing but checking the books of accounts, checking the invoices, sale invoices, purchase invoices, checking the documents, checking the records will form part of what? Inspection. Checking the physical existence of inventory, checking the physical existence of, okay, fixed assets. Say imagine in this room there is AC, this is asset of, okay, this institute, okay. Now as an auditor, I need to, if I need to get the audit evidence for the same, I need to go and check whether this AC is physically there or not. This is called physical verification. It comes under inspection. What is inquiry? Okay, inquiry is nothing but getting the information from various persons within the organization. Either it can be employees, or it can be management, or it can be BOD, or it can be internal auditors, or it can be lawyers of the organization. Okay, this is inquiry part. Point number 3. Okay, point number 3, it is observation. When an auditor is observing the work which has been performed by others. Okay, someone is verifying the assets physically. Now as an auditor, you are observing whether he is correctly verifying or not. This is called as observation. Point number 4, okay, it is external confirmation. It is external confirmation. What is external confirmation? Say for example, in case of debtors, okay, how can we create the debtors? Okay, when we sell the goods to someone, and if the credit period is given to them, then they will become the debtors in our books of accounts. They are required to pay us the money. Okay, now in our books of accounts, in the balance sheet, debtors are showing 1 crore rupees. Now as an auditor, you want to confirm whether this 1 crore rupees is right or wrong. For that reason, you just want to confirm it with debtors. These are the third persons, right? It is not the company, it is not the management. They are the outsiders of the company. And as an auditor, you want to consult with whom? You want to get the confirmation from debtors, outsiders of the entity. Okay, outsiders of the entity. This is called external confirmation. And recently, previously we discussed one point called as inherent limitations, nature of audit procedures. Now say one thing, to get the confirmation from debtors. Okay, as an auditor, you want to get the confirmation from debtors to verify debtor value whether it is 1 crore or not. Okay, you have sent a request to the debtor, and debtor is not responding. How can you get the audit evidence? Okay, you may be using the audit procedure called as external confirmation well, but you may not be getting the right audit evidence from the same. Okay, that is called nature of the audit process. Sometimes the debtor may not be responding to you. In that case, you cannot do anything. Okay, that is the inherent limitation what we have. That is the example for nature of the audit procedures. In fact, these are the 7 procedures. After applying these procedures, these procedures are applied on at various aspects of the audit. In order to verify the fixed assets, you will apply what? Inspection. In order to get the information from the management, you will use what? Inquiry. In order to check the debtors, you will use what? External confirmations. In order to compare your performance with other organizations, you just want to compare the gross profit of your organization, your client, with gross profit of industry, then that is called as analytical procedures. Study of relationship between different items of the financial statements. It is called as analytical procedures. After you try to apply all these things, then the auditor will end up with getting the audit evidence. That audit evidence shall be sufficient. And it must be appropriate. It shall be appropriate. What is sufficiency? Sufficiency is nothing but quantity of the audit evidence. And appropriateness is nothing but quality of the audit evidence. So auditor needs to evaluate whether the audit evidence is sufficient and appropriate. After the audit evidence is sufficient and appropriate, he will be able to form an opinion on the financial statements, whether in all material respects financial statements are prepared as per FRF. That is what we are trying to understand. See, when it is not as per FRF, it is called as material misstatement. As per FRF, you need to present, disclose, record, value, classify properly. Everything you need to do as per FRF. If the company fails to do the accounting, prepare the financial statements as per this FRF, then obviously it will be called as misstatement, and if it is significant, it is called as material misstatement. Then now the first objective of the auditor is to get the reasonable assurance that financial statements are free from material misstatement. If there is any material misstatement, go and report to the intended users. Who are the intended users? Shareholders of the company. Now as an auditor, you need to form an opinion whether the financial statements contain misstatement or not, material misstatements or not. That opinion you need to form. This is the first requirement, the first objective of the auditor. Once the opinion is formed, the second one is, to report on the financial statements and communicate to the intended users as required by Yes. This is the second point. Okay, to report. After the opinion is formed, what is the next step? It is to report to the intended users and communicate the opinion. So for what purpose is this report is for? Communicate the opinion. Communicate the opinion. Okay, as per the standards, because to communicate the report will have certain structure. Okay, the structure we need to follow. Okay, while we report to the intended users. That standard is 700 and 705. The standard number is 700 and 705. Okay, let us now talk about this opinion first of all. Okay, now we all know that there is an opinion that shall be formed by whom? Opinion shall be formed by auditor. Okay, what kind of opinions he can form? There are two kinds of opinions. There are two kinds of very important discussion. Okay, all this what I am teaching now for the first 4 or 5 hours, with that itself you can pass the examination. First 4 or 5 hours, I bet now. Okay, 5 hours. Okay, this revision lecture you will be able to pass. Okay, getting 40 it is so easy. Okay, you can be able to answer the MCQs also. First 4 hours you will be able to pass. So it doesn't mean that okay I am compelling you to watch only 4 hours. Okay, you shall watch all the 10 to 15 hours. Okay, you will be able to get more than 50 marks. So don't just play with IC8 whether to check whether you get 40 or not. Okay, for that reason you shall watch all the lectures. Okay, almost 10 to 15 hours lectures are there. Okay, that you shall watch. Okay, you shall not play a game with ICA. You shall not test yourself whether you get 40 or not. Okay, don't play that risky games. Okay, opinion. There are two different kinds of opinions what he can form, what an auditor will form. Okay, point number 1. First one, unmodified opinion. It is unmodified opinion. Unmodified opinion. Point number 2, modified opinion. Point number 2, modified opinion. Okay, done. So these are the two kinds of opinions he can form. So unmodified opinion, when this opinion will be called as, or when this opinion will be issued. Okay, this is to say the financial statements are clean without having any material misstatements. The financial statements are not containing any material misstatement. This is what the auditor is trying to say. Okay, his opinion is, okay, the financial statements contain no misstatements, no material misstatements. Okay, then he needs to issue unmodified opinion. To say this, to say whether the financial statements are clean, okay, he needs to have sufficient and appropriate audit evidence in the hands. Without having evidence, can he conclude? No. To give unmodified opinion, mandatorily he needs to have SAAE. Okay, coming to the second side, modified opinion. Modified opinion is divided into two parts. Okay, modified opinion is divided into two parts. One part when he has that SAAE. Okay, other part when he is not having SAAE. When he is not having SAAE. Okay, and the auditor, after getting SAAE, okay, he came to a conclusion that financial statements contain material misstatements. Financial statements contain material misstatements. Okay, but not, okay, plus, but not, okay, pervasive. What is this pervasiveness? Pervasiveness is nothing but deep into the account. Okay, now what auditor is trying to conclude? Financial statements contain misstatement. He has some audit evidence, but it is not pervasive in nature. It is not affecting many areas of the financial statements. It is limited. These misstatements are limited to only few areas. Remaining everything is true and fair view. It is giving true and fair view, but only 2 or 3 areas where the misstatements are still in existence, and those are material in nature. This is what he concluded. To express his opinion now, okay, he needs to give qualified opinion. When is he required to give qualified opinion? When he concludes, after getting the sufficient appropriate audit evidence, when he concludes the material misstatement is there, but it is not pervasive in nature. What is pervasive? It is deep into the account. It is affecting many areas of the many areas of the financial statements. Coming to point number 2. He concluded there are some material misstatements. Okay, again the material misstatements are there, and they are pervasive in nature. What is pervasive in nature? Deep into the account. This material misstatement is affecting many areas of the organization. Okay, many areas of the financial statements. Okay, it is not restricted to few areas. It is spreading over many areas of the financial statements. Okay, then financial statements in its aggregate, it is showing material misstatements. Then he needs to give adverse opinion. I guess you're all getting the point clear. Qualified opinion, adverse opinion. Okay, so sometimes there may be one misstatement, there may be only one misstatement, but it can be treated as pervasive in nature. Say, imagine there is a balance sheet. In the fixed assets, there is a misstatement. The total of the balance sheet is 10 crore rupees. Okay, and fixed assets it is 9 crore, and other assets it is only 1 crore. Okay, it is only 1 crore, and there is only one misstatement happened in fixed assets. Okay, that is this 9 crore rupees is misstated. Only one area, but it occupies the majority portion of the balance sheet. Hence, it can be treated as what? Pervasive in nature only. So all the times you cannot take the number of misstatements to consider whether it is pervasive or not. Sometimes you may need to look into the nature of the misstatement to decide whether it is pervasive or not. Now coming to next aspect, SAE is not there. So auditor tried to get the SAE, but management is not responding, and even the auditor did not get the sufficient and appropriate audit evidence. Because of that reason, okay, so since it is not there, since the SAE is not there, for that reason, okay, the auditor may be in a position not to form an opinion. So because of the non-availability of SAE, okay, the possible effect on the financial statements, possible effect of the misstatements. Okay, the possible effect may be existence of material misstatement. Okay, but not pervasive. Okay, the possible effect is what? Material misstatement will be there, may be there, and the effect may be not pervasive. Okay, not pervasive. Then give qualified opinion. So non-availability of SAE may also result to what? Qualified opinion. When the material misstatement, the possible effect may be what? Material misstatement may be there, and the effect is not pervasive. Then give qualified opinion. And last one is material misstatement is there. Okay, material misstatement may be there, and the effect of that material misstatement may be pervasive in nature. Then give disclaimer of opinion. The auditor is unable to express the opinion at all. Okay, whether the financial statements contain misstatement or not, he is unable to express. In that case, he is required to give disclaimer of opinion. With this, I am done with 700 standard also, 700 and 705. 2 standards I am done with. Okay, I directly jumped into audit report chapter, and then I am coming back to standard number 200. Okay, I guess you are all getting the point very, very clear. So keep this chart carefully. Okay, write this chart in your book carefully. Okay, remember well. Try to remember this well. Okay, I guess you are all getting the point clear. Okay, with this, okay, I can now jump to standard number 200 back. So till now we are done with only overall objectives of independent auditor, point number A, point number B. Okay, let us now focus on some other aspects. Okay, now I'll try to link up this other aspect also with 200. First of all, listen to me very, very carefully. The next Okay, 20 to 25 minutes, it is so important for your life. It is so important for your life. If not, your life will become miserable. Okay, no one can save you from failure in audit. Okay, failure in audit. So next 20-25 minutes, okay, you treat me like a god. Whatever I say, okay, you need to remember that in your mind for next 20 minutes only. After that, treat me as a devil or demon. Okay, but next 20 minutes treat me like a god. Okay, done. So 20-25 minutes, please pay 100% attention, sit straight, have pen in your hands. Okay, focus 100% on the class. Let me also drink water. Okay, done. Now, is the auditor able to verify all the transactions? No, because of existence of what? Inherent limitations. Because of existence of inherent limitations, he cannot verify 100% transactions cannot be verified, and we know that cannot be verified. Okay, come to point number 2. So that he can only give what? Reasonable assurance. Okay, reasonable assurance. However, he cannot give absolute assurance. Can he give? No, absolute assurance he cannot give. Only reasonable assurance he can give. Okay, we know that. There arises the concept of audit risk. Audit risk. Okay, what is audit risk? The audit risk is nothing but the risk of expressing inappropriate opinion when financial statements are materially misstated. It is the risk of expressing inappropriate opinion when the financial statements are materially misstated. Okay, so when the financial statements are materially misstated, he needs to give what? Okay, modified opinion, either of the three. Modified opinion. If the auditor fails to give this modified opinion when the financial statements contain material misstatement, that gives rise to what? Audit risk. The objective of the auditor is to issue correct opinion. In case if he fails to issue the correct opinion, okay, inappropriate opinion, if he is issuing the inappropriate opinion, then it is called as audit risk, and the auditor will be held responsible for that. Okay, because lakhs of people are depending upon the opinion which is given by the auditor, and this gives rise to personal obligation of the auditor, personal and professional obligation for the auditor. Okay, because he is expressing inappropriate opinion when the financial statements are materially misstated. There can be vice versa case also, where financial statements are not materially misstated, okay, but the auditor has to give what? Unmodified opinion, but he has given modified opinion. Okay, financial statements contain no misstatement, but he is saying there are some misstatements. Okay, is this called as audit risk? No, this is not called as audit risk, because management won't agree for that. When management has not committed any misstatement in the financial statements, and if the auditor says it as misstatement, then management won't agree for that. Management will ask the auditor to do the audit again, and it is just a waste of time for the auditor. Okay, the second vice versa case is not applicable for audit risk. Only the first case is applicable, and it is called as audit risk. Okay, when the financial statements are materially misstated and the auditor has given the inappropriate opinion. Okay, why is the auditor giving this inappropriate opinion? Why is he coming to that inappropriate conclusion? Okay, because of failure of okay, verifying all the transactions, because of failure of verifying, okay, most of the transactions, because of the existence of what? Inherent limitations. Because of existence of inherent limitations, he cannot cover 100% transactions. When he is not going to verify all the transactions, how can he say whether it is right or wrong 100%? You cannot say. You cannot say. That may be the reason for inappropriate opinion what he is concluding. Okay, so for that reason what he needs to do, okay, to give the right opinion, that is nothing but what? Audit risk to 0. Okay, audit risk to 0. You need to get the audit risk to 0 level. However, it is not possible. However, he can keep the audit risk to acceptable low level. Why is it not possible to keep the audit risk to acceptable low level? Because auditor is not going to verify all the transactions. Imagine there are 1 crore transactions of Flipkart. Can the auditor verify all the transactions? No. For that reason, audit risk cannot be reduced to 0. 100% there will be audit risk. Okay, but the risk level will be high or low. Okay, now you tell me, what is the reason for this audit risk? The inability of the auditor to, okay, identify the misstatement. So first of all, there must be a misstatement. And that misstatement, there must be a misstatement which shall be arised from the mistake of management. Because when let me take one simple example. Okay, there is an organization which deals with high cash balances. Okay, now you tell me, cash is the important item of financial statements. Okay, balance sheet. When the cash is misappropriated by the lower level management, okay, when there is a fraud which has been happened in the area of cash by cashier, management later they came to know that, okay, if management highlights the fraud relating to that particular cash, then their job will be at risk. Because the board of directors won't, okay, spare them, and they'll fire the management, whoever needs to take care of the cash. For that reason, what management may do? Management may cover up the fraud. Management may show the balance of the cash, okay, which is not available physically, because it is already stolen by whom? The lower level employees. Okay, it is a mistake of whom? This misstatement which is there in the balance sheet, incorrect cash balance, it is the misstatement arised because of whom? Management side. Okay, this is called risk of material misstatement. Now you tell me one thing. Always there will be risk of material misstatement which is involved in the preparation of the financial statements. What may be the reason? Because point number 1, okay, it depends on nature of the organization. Now you tell me, you compare two organizations, take insurance company and take other, okay, the trading company. Which business is more risky? Insurance company is more risky, because the preparation of financial statements of insurance company involve high estimations, judgments from the management side. It may give rise to what? It may give rise to misstatements. It is high risky area, because involvement of judgment is there here. Okay, so the risk of material misstatement depends upon the nature of the organization. And another example I'll take. The organization is having high cash balances. Compare, there are two organizations. One organization is maintaining high cash balances. Every time when you go to organization and you open the cash counter, huge cash balances are, okay, found there. Okay, now you tell me, when you compare these two organizations, which one is more risky? Because the organization which is, okay, maintaining high cash balances, it is more risky, because it is easy to carry the cash, it is easy to manipulate, it is easy to misuse the cash. For that reason, the risk of material misstatement for that entity, okay, is high. Okay, it is called as inherent risk. In fact, it is called as what? Inherent risk. Nature of the organization, nature of transactions, because all the transactions are happened in cash itself. Whatever we sell, it is in cash only. It is the nature of the transactions. For that reason, the organization preparation of financial statements involve inherent risk that cash may be misused. Okay, it is called as inherent risk. Exactly, when you want me to say inherent risk, okay, Okay, give me 2 minutes time. I'll explain in detail the inherent risk again. Okay, now let us do one thing. Is there any inherent risk involved in the preparation of the financial statements? Yes. It depends on what? It depends on nature of the transactions. It depends on what? It depends on nature of the entity, nature of the business. Okay, now as an auditor, you need to go to that entity. Okay, get an understanding of the entity, get an understanding of the business, what they do, get an understanding of the transactions, what they enter into. After that, you will be able to understand one thing. Okay, what is that? Inherent risk, whether it is in existence or not. This is what you can conclude. However, for the management side also, this is the inherent risk or not. Okay, so management, when they know all these things, nature of the transaction, it is in cash, management also knows what, yes, there is a chance of misuse of these assets by the lower level authorities. For that reason, management, to avoid those type of situations, management will react with what? They keep some controls. They keep some controls to prevent the misstatement to happen, to prevent the misuse of the assets to happen. Okay, to detect the correct the material misstatements. What the management will implement? Management will try to implement the controls, and it may give rise to, okay, when the controls are operated well, obviously risk will be less. When the controls fail to operate, it is called as control risk. It is called as control. The controls are, okay, failed to operate as per its requirement. Okay, then it is called as control risk. When the controls are not operated well, obviously risk of material misstatement will be high. There may be high chance of material misstatement in the financial statements. Okay, what may be the controls, sir? See, imagine around cash, above the cash counter, they have put in place the CC camera, and there is one policy for the organization that, okay, every day, okay, by the end they need to keep the cash in the bank account. Okay, there is no availability of the cash in the counter, it must be deposited in the bank account. This is the policy they have. Okay, this is the control they implemented, the management has implemented. Now if the controls are operated well, risk of material misstatement will be low. If the controls are not properly implemented by the management, obviously there is a chance of misstatement, and that is called as risk of material misstatement. That is called as risk of material. It is just a risk, it is not actually happened. It may take place. It is risk of material misstatement. Now you tell me one thing. Okay, you went to the organization, you assessed the risk of material misstatement, you understood the entity and its environment and its nature of business, nature of transactions. Okay, the controls which are put in place, whether they are operating well or not, everything you identified, and you came to a conclusion that the risk of material misstatement, there is high chance of material, okay, misstatements. There are high chances that the financial statements may be misstated. This is what you concluded. Now you tell me one thing. There are 1 crore transactions. Okay, and you assessed the risk of material misstatement as high. You assessed the material misstatement as risk of material misstatement as high. Now you tell me, okay, if I give you 2 options out of 1 crore transactions, okay, if I give you 2 options, you are the auditor, there are 1 crore transactions, I am giving you verify 30 lakh transactions only to get the opinion, to form an opinion, or verify 70 lakh transactions to form an opinion. Okay, these are the 2 options which are given to you. Now you tell me one thing, when the risk is high, how many transactions you are going to verify? It is absolutely 70 lakh, because the risk of material misstatement is high. When the risk is high, obviously the auditor needs to, okay, verify more number of transactions to get the correct opinion. When he gets the correct opinion, obviously audit risk will be low. Audit risk will be low. The ultimate objective of the auditor is to, keep the audit risk to acceptable low level. Okay, to issue the appropriate opinion, not to issue the inappropriate opinion. For that reason, now what he needs to plan? He needs to plan to verify more number of transactions. Okay, if he verifies more number of transactions, he will be able to detect the material misstatements. When he is able to detect the material misstatement, that is called as, okay, low detection risk. Okay, when he is able to detect, then the risk is not there. That is called as detection risk. Okay, now you tell me, when the ROMM is high, the auditor shall plan the audit in such a way that in such a way that he'll be able to detect the misstatements by doing more audit. When he is able to detect the material misstatements, okay, by doing more audit, obviously detection risk will be low. Okay, when the detection risk is low, okay, if he plans the audit in such a way, then obviously audit risk will come down, which is the ultimate objective of the auditor. Okay, now you tell me, okay, in order to, can I write this line? In order to bring the audit risk to acceptable low level. Audit risk to acceptable low level. Okay, in order to bring the audit risk to acceptable low level, okay, the auditor shall, okay, plan the audit or conduct the audit. Okay, conduct the audit in such a way that the detection risk is having the inverse relationship with risk of material misstatement. When risk of material misstatement is high, detection risk must be low. When can we call detection risk as low? Okay, when more number of transactions are verified. Okay, so this is what, in order to bring down the audit risk to acceptable low level, see this audit risk, you just need to bring down. Okay, for that reason you need to go and, okay, assess ROMM. How to assess the ROMM? Just by understanding the entity, okay, by looking into the controls, how they are operating and all, you can just, okay, assess ROMM. If it is high, if the ROMM is high, then auditor shall plan, okay, to have the detection risk at low. If the ROMM is high, detection risk must be low. Okay, when can this detection risk be low? Okay, when all the transactions, more number of transactions are verified. Anyway, all the transactions you cannot verify because of existence of what? Okay, existence of inherent limitations. This is the concept of audit risk. So how can you assess this ROMM? ROMM is nothing but it is the function of inherent risk into control risk. As an, okay, in its isolation, okay, isolated calculation of IR, inherent risk, is not possible. Okay, isolated calculation of inherent risk is not possible because always this inherent risk will be reduced. Okay, the management will try to reduce this inherent risk by implementing controls. If the controls are not operated well, then only it gives rise to what? ROMM. So isolated existence of IR won't be there. IR will always be, okay, management will always try to reduce the IR effect to low by implementing the controls. If the controls operated well, then no problem, ROMM will be less. If the controls are, okay, not operated well, CC camera, they have, okay, they have put in place the CC camera, but it is not working. Okay, control, they put in place the control, but this control is not properly been implemented. Okay, now what will happen? ROMM will be high. So in its isolation, okay, IR cannot be in existence. IR will always be existence, okay, with control risk. So now if you want me to define IR, okay, the risk that we calculate when we ignore controls, when controls are not considered, the risk which is there in the financial statements, in the preparation of financial statements, is called as IR. But is it, okay, in existence in its isolation? No, standalone it cannot be there. It will be always in existence along with what? Control risk only. Okay, all this is the work of management. If management fails to do this well, then obviously ROMM will be there. It is the reason for material misstatement in the financial statements. Okay, it is the mistake of the management. Then you need to plan your audit properly. As an auditor, you need to plan how many transactions to be verified. If the auditor verifies more number of transactions, he will be able to detect the misstatement, he will be giving the right opinion, then the audit risk will be at low. Okay, this is the concept I just want to let you know. Okay, now Now, in this entire process, while applying the audit procedures, 7 procedures, and after getting the audit evidence, you need to evaluate whether it is sufficient or not, whether it is suitable for my, whether it is suitable for my requirement or not. Everything the auditor needs to check, right? Okay, he needs to decide which procedure has to be applied, and whether the audit evidence what we get is sufficient and appropriate. He needs to decide upon whether the audit risk is at acceptable low level or not. Okay, whether to verify 70% or 30%. At what level he needs to keep this reduction risk. At what level the ROMM is assessed. So everything the auditor needs to decide, right? He needs to decide. And while performing the work, sometimes auditor may not verify all the transactions. Say for example, there are 100 transactions ranging from rupee 1 to 1 lakh. Rupee 1 to 1 lakh. So one transaction is for one rupee, another transaction is for 1 lakh rupees. So it is in between 1 rupee to ranging from 1 rupee to 1 lakh. Now the auditor, instead of verifying all the transactions, he may decide some amount which is called as material amount. Say example 5,000. So he is going to verify only those transactions which are more than or equal to 5,000. Less than 5,000 rupees he is not going to verify. This is called materiality level. Okay. So in the given instance, what is to be considered as material? What is to be considered as material? It must be decided by whom? Again, the auditor. So now the auditor, he needs to apply his mind. He needs to use the beautiful word called professional judgment. He needs to use the word called professional judgment. Professional judgment. For what purpose professional judgment is used, sir? It will be used for what? Application of appropriate audit procedures, selection of appropriate audit procedures, nature, timing and extent of audit procedure. What is nature? What is the procedure I am going to use? When do I need to apply? To what extent? How many times I need to apply? How many transactions I need to verify? It is all to be decided by whom? Auditor only. So, nature, timing, extent of audit procedures, sufficiency and appropriateness of audit evidence. Level of audit risk must be decided by whom? Auditor only. Point number 4, determination of materiality. Whether to check the transactions more than 5,000 rupees or not, it is to be decided. Which amount is considered as material now? 5,000. It is decided by whom? It is decided by whom? Auditor. Materiality. In all these circumstances. In many things are there. Even when forming an opinion, whether to treat something as pervasive or not, pervasive nature or not, whether the misstatement is pervasive nature or not. It is also to be decided by whom? Auditor only. Pervasiveness. While forming opinion, all this shall be decided by auditor only by applying professional judgment. I guess you are all getting the point clear. With this, I just want to jump into standard number 200 again. I started 200, jumped somewhere, came back, again jumped somewhere. Again, I came back to standard number 200. Let us now read the requirements of standard number 200. So quickly we can complete standard number 200 and after that we can go to standard number 210 also. Within next 15 to 20 minutes, we are going to wind up this session. Done. You don't need to worry. All this is very, very important for your examination purpose. Done. Requirements of standards. Ethical requirements relating to financial statements. The auditor shall comply with, first requirement is ethical requirement. So while conducting the audit, he needs to comply with the ethics. There are some ethical requirements. So few of them are given in the code of ethics issued by ICAI. It is integrity, objectivity, professional competence and due care. Next one, confidentiality and professional behavior. What is integrity? Integrity is another meaning of integrity is honesty. The auditor must perform his work honestly. Point number 2, objectivity. Point number 2, it is objectivity. Remember, it is very, very important. Honesty. What is objectivity? Objectivity is nothing but auditor can conclude anything only after having strong facts in hand. Without having the facts in hand, without having the basis, he cannot say anything whether it is right or whether the financial statements are showing true and failure or not. He must say something only after getting the evidence. That is called as objectivity. Objective is different from objectivity. Objectivity is having strong basis to conclude anything. And next one is professional competence and due care. Professional competence and due care. Okay, professional competence, as we all know, professional competence is nothing but, just a minute, ఎవరు సందీప్ చెప్పు, నా క్లాస్ అవుతుంది. ఏ క్లాసు? అది ఇంకా రాలేదు, అది ఇంకా రాలేదు, వాళ్ళకి ఈరోజు క్లాస్ లేదని చెప్పు. Okay, this is Telugu what I have just spoken. Okay, we as we are from Andhra Pradesh, our regular language, native mother tongue is Telugu. Okay, for the first time I am recording the classes in English. Okay, if there is any inconvenience for you with my English, okay, please forgive. I cannot do anything, this much I can speak. Okay, done. So professional competence and due care. What is professional competence? It is the capability of the auditor. Okay, when he is accepting some audit, he must have that professional capability. Okay, professional competence he must have. Okay, he must exercise his duty, he must perform his duty only after having professional competence. See, whenever he accepts any bank audit, okay, any bank audit, so for that bank audit only a CA is not sufficient, CA degree is not sufficient. In addition to that, some post qualification okay, certification is required, that is called as DISA. This shall also be there for the purpose of accepting the bank audit. Okay, this is called professional competence example. Okay, done. Then confidentiality, whatever the knowledge we get about our clients, okay, that must be kept confidentially. Okay, it must not be disclosed to anyone. Here and there we cannot disclose the information of the client. However, with the permission of the client we can disclose, not an issue. And if it is required by the law and regulation, then we can also disclose. These are the two exceptions for confidentiality. So point number 1, with permission of client we can disclose. Point number 2, as per the requirement of the law, if in the court the judge is asking you to disclose the information of your client, you cannot say the confidentiality, code of ethics, ICA, etc. At that point of time you need to disclose them, because it is required by law. Exceptions, these are the exceptions. Permission taken by the client, point number 1, and along with that law requires you to disclose the same. And last important point, independence. Okay, whenever you do the work, you must do that independently without getting affected by anyone or anything. Okay, see, for example, any relationship, the board of directors of that company, okay, one of the person is your wife. Okay, now independently you cannot do the work, because if you give the modified opinion, okay, at home you won't get any dinner or lunch. For that reason, okay, you may not give the appropriate opinion. This must not be there. For that reason, first of all, you shall not accept the audit at all. Just for fun I am saying, okay, this is called as independence. So whenever the auditor is, okay, expressing opinion on the financial statements, he must do the work independently without getting affected by any relationships. Okay, anything or anyone. Okay, you shall not get affected, and independently, honestly, you need to give the opinion. Okay, and one important point is that independence must be in mind, in appearance. Okay, the auditor himself has to be in his mind, he has to be what? He has to have that independence, and he must appear to be independent to the outsiders. Whenever some outsider, okay, sees the auditor, he must appear to be independent. Okay, that care shall be taken by whom? Auditor only. Independence in mind, independence in appearance. Independence in mind and independence in appearance. Now, next requirement of standard number 200. So it is professional skepticism. We know professional skepticism. What is professional skepticism? It is the attitude, questioning mind. Okay, it is the attitude of not accepting the things so easily. So when the management says you something, you shall not accept the same immediately. You need to have that questioning mind. Okay, you need to be alert to the instances. Okay, be alert to the instances. This question is so important. Professional skepticism include being alert to, okay, So different evidences we are getting. When I inquire, management is saying something. When I inspect the books of accounts, I am getting another audit evidence. There may be a contradiction between the audit evidence what we get by using different procedures. In that instance, you shall not accept that so easily. You shall exercise professional skepticism, having what? Having questioning mind. Having questioning mind. Okay, and professional judgment, just now we talked about professional judgment. See, professional judgment means what? It is the application of training, knowledge, experience. What an experienced auditor will get. Okay, so during that articleship and all, we get the training and we have that knowledge, experience. After using all those things, okay, you need to form some conclusions relating to what? Materiality, nature of audit procedures, sufficiency and appropriateness of audit procedures. Okay, even see audit risk also. So drawing conclusions about the audit evidence. Okay, everything. This is the point I discussed just now. Okay, again I am not going to discuss now. Last area, conduct, second part of standard number 200, conduct of an audit in accordance with SCS. Okay, simply I will conclude this. So while the auditor performs the work, he needs to comply with the standards. In accordance with standards only needs to do the audit. Okay, however, in some instances he is not required to comply with the standards. What are those exceptions? There may be some cases where that standard, okay, in its entirety may not be applicable for the auditor, auditor. So example, there is one entity, X Limited. It is only one entity, it is not a group company. Okay, and this X Limited has appointed Mr. Ravi as the auditor. Only Mr. Ravi is required to perform the audit. Okay, and there is one standard called as standard number 299, where it talks about joint auditors. Joint auditors is nothing but for one company, okay, many auditors are appointed as an auditors. Okay, then only standard number 299 will be applicable. Now, in the present instance, for X Limited, there is only one auditor. Is he required to comply with standard number 299? No, because standard number 299 in its entirety, it is not applicable for the situation, for the audit. Hence, okay, this standard they don't need to apply. And there may be another case also where standard number 501, okay, it talks about getting the audit evidence for different things. Okay, point number 1, getting the audit evidence for inventories. Okay, getting the audit evidence for litigations and claims, like provisions etc. Okay, contingent liabilities, provisions etc. Litigations, court cases, litigations. Okay, and other point is segment reporting. Standard number 501 talks about all these three. And standard number 501 is applicable only when the inventory is material to the financial statements. When the inventory is not material, when the inventory is not so significant, it is only of 1 lakh rupees, where the turnover of the company is 100 crores. Turnover of the company is 100 crores, inventory is less than 1 lakh. Is this material? Okay, by application of professional judgment, auditor decided it as not material, and hence standard number 501 is not applicable. Remaining two aspects for 501 is not applicable. Okay, 501 is not applicable for inventory only. We don't need to follow standard number 501. See, the applicability of the standard says certain conditions. If those conditions are not satisfied, the auditor is not required to apply that particular standard. 501, second example. Okay, now what can we conclude? In the heading itself, it says something called as conduct of an audit in accordance with what? Conduct of an audit in accordance with what? SCS. It is not SCS, it is relevant SCS. Only those relevant SCS we need to follow. All the SCS we don't need to follow. Okay, now, and last aspect of the standard, we can come to here. Okay, see, when the standards are not relevant. Okay, when the standards are not applicable, because when entire standard is not relevant, example 299, when the requirement is not relevant because it is conditional and condition doesn't exist, 501. Okay, there may be some cases where we may not apply standard, okay, but we shall actually apply other alternative procedures to verify the same. When the standard is not applicable, when you are not able to apply the requirements of that standard, you need to apply some other process to get the audit evidence. If you fail to get that, then it may need you to modify the audit opinion or withdraw from the engagement, or also you can do what? Withdraw from the engagement if law requires you, if the law allows you to do so. Okay, with this I am done with standard number 200. Let me go to standard number 210 also. Okay, within 10 minutes I just want to close standard number 210. Okay, it is also an important area. So agreeing the terms of audit engagement. See, okay, the management shall request the auditor, okay, to act as an, the management shall request the auditor to act as an auditor for the company. Okay, Mr. Ravi is the auditor. Management shall request the auditor to come to the entity and do the audit. Okay, and he is to be appointed by whom? In the annual general meeting. Shareholders shall appoint. Who recommends this name? Okay, audit committee will recommend this name, and board of directors will accept the same, and they shall forward the same to whom? Okay, shareholder. This is there in law, in fact. Okay, management will request the auditor, and the auditor needs to accept the same, and it becomes the audit engagement. So before the auditor accepts the engagement, they need to agree. Who need to agree? Management and the auditor. Management and auditor needs to agree for the same. Auditor and management needs to agree for the same. Okay, that agreement, what it contains, it is discussed in standard number 210. Okay, first of all, before the auditor accepts the same, okay, there must be certain preconditions that are to be satisfied. Preconditions that are to be satisfied. Okay, if these preconditions are not in existence, then auditor shall not accept the same. So what are the preconditions? Okay, before the auditor accepts the same, following conditions must be existence. Okay, point number one. Listen to me very carefully. Auditor needs to check, he needs to determine whether the financial reporting framework, okay, that is to be applied in the preparation of financial statements is acceptable or not. Okay, point number one, FRF, which is used in the preparation of financial statements, FRF used in preparation of financial statements, okay, is acceptable. Important question, acceptable or not. Say FRF is divided into two types. Okay, general purpose framework, special purpose framework. General purpose framework is nothing but, okay, the financial statements are to be used by wide range of public who are there in India. Okay, this is called general purpose framework. They need to follow Indian GAAP, generally accepted accounting principles. However, special purpose framework is, it is for limited people only. For them only we need to prepare the financial statements. Say imagine, okay, IFRS we are following, IFR, International Financial Reporting Standards, we are following to prepare the financial statements of a group company, where the holding company is in USA. You are now following what? US GAAP to prepare the financial statements. Is it relevant in India? No, in India it is not relevant. In India only GPF is relevant, SPF is not relevant. Okay, now in India which one is acceptable? Only GPF is acceptable. Now if your client is requesting you to do the audit of GPF, the financial statements which are prepared as per GPF, then it is called as acceptable. If not, it is not acceptable. If the FRF is acceptable, then only it shall form part of preconditions. It is satisfied. Then only you can accept the same. Okay. If not, the auditor is not eligible to accept the same. Okay, now, so after the first condition is satisfied, come to second conditions. These are so easy. Okay, the auditor is required to get an agreement from the management, okay, that management is responsible for the preparation of financial statements. If they do not prepare the financial statements, how can I audit the same? That is what we need to agree. You are responsible for preparation of financial statements as per the applicable FRF, which is acceptable. Point number 2. And you are actually responsible to keep in place the internal controls for the purpose of enabling the preparation of finance statements free from material misstatements. Previously I told you few internal controls. All the internal controls is the responsibility of whom? Okay, management only. Now it is the responsibility of the management. Management, you need to agree for that. You are responsible for what? You are responsible for keeping the internal controls whichever is necessary for enabling the preparation of finance statements free from material misstatements. This is point number 2. And also you provide me with, okay, you management, you provide me with access of all the relevant information and documents. Whatever I want to verify, you allow me to verify. If you don't allow me, okay, I won't accept the engagement at all. Okay, if I require any additional information, if I request you, you shall give me. Okay, if not, I won't accept the audit at all. You agree now? Okay, that is what you need to talk to whom? You need to agree with whom? Management. And last point, unrestricted access to persons within the entity, okay, to obtain audit evidence. So management, when I come to do the audit, okay, if I want to talk to anyone for the purpose of audit to get the audit evidence, you must allow me to, okay, go there and talk to them. Unrestricted access to anyone you must give me. That is what we need to talk. Point number 3. These are the preconditions. So once the preconditions are satisfied, the auditor can accept the same. So after, okay, now I'll talk about few things called as limitation of scope. So while before he actually agrees for the same, okay, actually enters the audit agreement, okay, the management is trying to restrict the scope of the auditor. Management is trying, hey auditor, okay, you do not have the access to these books of accounts, okay, whatever you want verify, but okay, but these things, some of these things we won't provide, don't ask us. This is how they are talking. Okay, they are trying to limit the scope of the auditor. They are not allowing the auditor to do more work which is required for the purpose of audit. Then it happens, if it happens, the auditor shall not accept such limited engagement unless if it is required by law or regulation. Law is asking the auditor to, okay, to audit that particular company even though if they are not supporting, even though the books of accounts are not fully there. Now in this case, you as an auditor, you need to continue the audit because it is required by the law. Okay, now so what may be there in the agreement? In the agreement, what is written? Point number 1, okay, what is written? Point number 1, what is the objective of the auditor? Okay, what is the timing objective? Okay, timing objective, like when do I need to give the report? Okay, what is the time which is allotted for me to complete the audit? All these things will come will form part of what? Objective of the audit. And what is the scope of the audit? Okay, to what extent I can do the audit? This must be first agreed with the management. Okay, the objective and scope. When do I need to give the report and what is the work I need to do? Okay, this is what we need to agree with the management. Objective and scope of the, okay, audit of finance statement. This is what we need to write in the engagement letter. Where do we need to write? Audit engagement letter. Audit engagement letter. Okay, so we'll write the audit engagement letter, we'll give that to management and management will sign that and it will send back to auditor again. Done. Next point. So in that audit engagement letter, second point is, what are the responsibilities of auditors? What are the responsibilities of management? Pani enti, neekenta, naakenta. What is the work? What will you do? Okay, what will I do? That is what you need to agree. Okay, and then identification of FRF. So what financial reporting framework is applicable for the financial statement? That is also written in there in that audit engagement letter. And beautiful point, after I do the work, okay, the expected form and content of the auditor's report which I am going to give you after the audit is done, that expected form you need to write, okay, now itself, expected form, and you need to write a disclaimer that, okay, this is just an expected form. The final form, the final audit report may differ from this expected form. That also we need to write. Reference to expected form, okay, and also write it may differ from its expected form and content. Okay, and one more important point, if law and regulation, if the scope, if the terms are already decided by law, okay, it is not between whom? It is not between, if it is not between auditor and, if it's not between auditor and management, the agreement, okay, the terms are not decided by auditor and management. If it is already fixed by whom? Law itself. If the law already fixes the terms, then they don't need to write the terms again. They need to just follow what? Law. The terms which are there in law. However, auditor needs to get an acknowledgement from the management that they know the terms as per that law. They need to get an acknowledgement that management has the knowledge of the terms of the law, and they need to give that acknowledgement to whom? Auditor. If it is yes, then there is no need to write the entire law terms again in the audit engagement letter. They can just refer what? The terms of the audit engagement is taken from the particular law. That is what they need to write in the audit engagement letter. With this I am done with audit engagement letter also. Next aspect, it is recurring audits. See, so this is the first year I have written the audit engagement letter. The next year also I am the same auditor. For that entity I am the same auditor who is actually working. Again I am the same auditor. So this is called recurring audit. Every time I am only acting as an auditor. Is there any requirement every year to rewrite the audit engagement letter? Rewrite the audit engagement letter. No, it is not required. When there is recurring audit, the auditor is not required to write the audit engagement letter again. So agreement of agreeing the terms of audit engagement is not required every year. I guess you are all getting the point clear. Every year. However, there are some instances where the revision of the audit engagement letter is required. Revision of the audit engagement letter. When is it required, sir? When is it required? Now you tell me, the objective and scope of the audit which was already decided is now changed. Or there is some misunderstanding between management and the auditor regarding the scope of the audit and the objective of the auditor. Now you tell me, is there any requirement to revise? Yes, sir. Yes, see here, indication of entity misunderstanding the objective and scope. Any revised special terms of the audit engagement. Now the terms got changed. Then you need to revise. The management has been changed, senior management has been changed, and ownership of the the owners of the company got changed. Now change the audit engagement letter. Responsibilities of auditor got changed, responsibilities of management got changed. Now you need to revise everything. FRF got changed. Revise the audit engagement letter. Other reporting requirements got changed. These are the instances where the auditor is required to change the audit engagement letter. Now. Done. So next one. So auditor is requested to change the audit engagement terms after the acceptance of auditor. Is it possible? Yes, sir, it is possible. But however, generally auditor shall not accept for the change in the terms. However, auditor shall ask the management for the reasons for justifying the change in the terms. If the reasons are justifiable, then If the reasons are not justifiable and the auditor is unable to continue with the revised terms, and the management is also not willing to continue the engagement if there is any existing terms still there. Management is not agreeing to continue with the existing terms. Auditor is not agreeing to continue with revised terms. Then what will happen? See, withdraw from the engagement wherever it is possible under law. And the auditor needs to determine, just like that he cannot go just by giving shake hand to the management. He needs to determine, is there any professional responsibility on the auditor to inform to the person who have appointed them, because he is the actual person who needs to report to shareholders. Now is there any requirement on the auditor to report to shareholder or not? That you need to decide. See, determine whether any obligation on him to intimate to other parties. With this I am done with standard number 210 also. There is only one topic still pending, that is standard number 210. At the end of the discussion, at the end of this 15 hours or 10 to 15 hours, I will be discussing that standard number 220. With this I am done with first chapter revision. Along with first chapter, I completed standard number 700, 705. I completed chapter number 4, audit risk concept also. Half of the portion of chapter number 4 is now over. Now I just need to just need to teach only other parts of chapter number 4, which is very, very simple. In the next session we'll meet. Let us wind up here. Thank you. Done. So let us continue with chapter number 2. Chapter number 1 is over. and except standard number 220, everything was done. Okay, now standard number 220 at the end we are going to see. Okay, we are going to see at the end. Now let us start with chapter number 2. So before moving into chapter number 2, let us have a basic idea of, so whatever we discussed in the previous session, I just want to keep it here now. Audit risk, audit risk is equal to ROMM. It is the function of ROMM into detection risk. Okay, it is the function of ROMM into detection risk. Now, okay, first of all, auditor must assess the risk of material misstatement, and based on that he needs to plan the audit, whether to verify more number of transactions or less number of transactions. That is what the meaning of this audit risk is equal to ROMM into detection risk. Okay, now okay, let us have the sequence of conducting the audit, the process of audit. Okay, management will request the auditor to act as an auditor. Okay, management will request the person to act as an auditor. Once he accepts the same, it will become audit engagement. Once the audit engagement is over, okay, now let us stop here and go back to the last step. Okay, what is the ultimate objective of the auditor? He needs to issue the auditor's report to the intended users. Auditor's report. What is here? Auditor's report. Okay, to issue this auditor's report, first of all, auditor shall form an opinion. Okay, auditor shall form an opinion, and that is called as auditor's opinion. What is AO? Auditor's opinion. This opinion shall be issued to whom? AR. Through the auditor's report to whom? Intended users. Okay, so this opinion he can be able to form only when he is having the audit evidence. What is AE? Audit evidence. That evidence must be sufficient and appropriate. Okay, how can he get the audit evidence? Okay, he gets the audit evidence only when he applies the audit procedures. AP is equal to audit procedures. Okay, there are various procedures. Nature, timing, extent. These are the words we need to remember. Nature, timing, extent. So whenever you write in the notebook, okay, you need to write the details. Okay, nature, timing and extent. Full forms you need to write. Nature, timing and extent. This is sufficiency and appropriateness. This is audit report. This is audit opinion. This is audit evidence. To get the audit evidence, okay, we need to apply the audit procedure. So when to apply which procedure? Okay, that has to be first of all planned. Okay, there must be a plan to perform the audit. Okay, that shall form part of audit planning. Okay, then after we plan, we apply the procedure to get the audit evidence to form an opinion. That opinion shall be given to intended users through the auditor's report. This is the sequence of steps we need to follow in case of audit. See, management will request, okay, and the auditor will accept. If the auditor accepts the same, it will become audit engagement. Okay, it is audit engagement. So after the engagement is agreed, see SA 210, after that he needs to start planning. Auditor shall plan for the same. This is covered under standard number 300. Then he needs to apply audit procedures to get the audit evidence, to form an audit opinion, to issue the audit report. Now what kind of audit procedures we need to apply? These audit procedures are divided into two types. Okay, two types. Risk assessment procedures. Further audit procedures. I already told you one thing, that first of all, auditor shall do what? He must assess the risk of material misstatement for the purpose of further planning, for the purpose of determining how many transactions should be verified. For that reason, he needs to assess the risk of material misstatement. So the procedures which we apply to assess the risk, okay, what is this risk? It is nothing but ROMM. What is ROMM? It is IR into CR. Okay, this he needs to assess first of all. Okay, the procedures what he applies for the purpose of assessment of ROMM is called as what? Risk assessment procedures. Risk assessment procedures, the procedures which the auditor applies for the purpose of assessing the risk of material misstatement is called as risk assessment procedures. Generally, point number 1, what kind of procedures he can apply? First of all, this is discussed in standard number 315. This is discussed in standard number 315. So what 315 says? Auditor shall apply risk assessment procedures for the purpose of assessment of ROMM. What kind of procedures he can use? Inquiry. First of all, as per 315, the auditor shall get the knowledge of the business. Knowledge of the client. Without knowing the without knowing knowledge of the business, without knowing the business, how can he assess the risk of material misstatement? That is what we discussed. There are two entities, one is insurance company, another one is trading company. Which one will have the more risk? Obviously it will be insurance company. How can we know that? Because we have the knowledge of the business, and that business, that insurance business will involve, it involves high estimations, management judgments. Obviously there will be risk of material misstatement which is to be assessed as high. For that reason, see, as per standard number 315, the auditor is required to get the knowledge of the business. How to get the knowledge of the business? It can be inquired with the management, or it can be observed. Also, you can apply analytical procedures to understand the position of the company. You can compare previous gross profits, previous performance of the organization, and you can just compare with current year performances to know whether the risk is in existence or not. These kind of procedures we can apply. This is analytical procedure. We'll apply for the purpose of understanding what? For the purpose of assessing ROMM. Who said you to assess this? Standard number 315 said you to assess this. After the auditor assess ROMM, the next step will be obviously planning the audit, whether to verify more number of transactions or less number of transactions, and that shall form part of further audit procedures. If this is ROMM, this will be detection risk. When more number of transactions are verified, obviously detection risk will be less. Why are we applying further audit procedures? The purpose of applying further audit procedures is to detect the material misstatements, which are material in nature. So why we apply further audit procedures? What is the answer? To detect the misstatements. However, not all the misstatements are relevant. Only those misstatements which are material in nature. Now let us have a discussion of materiality also in a while. Let us now quickly revise this. First step will be assessment of risk. Audit procedures are divided into, this is audit procedure. They are divided into two types, ROMM, so risk assessment procedures, and further audit procedures. What is the purpose of risk assessment procedures? It is the purpose to assess the risk of material misstatement. If based on that risk of material misstatement, auditor needs to plan the further audit procedures, whether to verify more number of transactions or less number of transactions. He can decide upon nature, timing, extent of the audit procedure he needs to use to detect the material misstatements. Now after he applies the further audit procedures, he'll get the details of the misstatements which are in existence. He'll find out all the misstatements which are there in the financial statements. Now the auditor will request the management to rectify these misstatements. If the management rectifies the same, then there won't be any problem. If the management fails to rectify the same, those are called as uncorrected misstatements. Now as an auditor, you need to evaluate whether those uncorrected misstatements are material in nature or not, whether they are affecting the financial statements materially or not. This is called evaluation of uncorrected misstatements by the auditor. Whether those uncorrected misstatements are material or not. Now 3 times we have listened to the word called materiality. Point number 1, ROMM. ROMM, when you assess the risk, not all the risks are relevant, only those risks which are material in nature is relevant. We can fix the materiality right in the assessment of risk of material misstatement. Come to point number 2. While we apply the further audit procedures, not all the transactions we are going to verify. We are going to verify only those transactions which are material in nature. Okay, so materiality will be applied here also. Okay, in performance of the auditor. This is called performance of the auditor. Okay, further audit procedures. Now there is another aspect. Okay, materiality is now applied on a place. Okay, to evaluate whether the uncorrected misstatements by the management is material or not. Okay, I guess you are all getting the point. 3 instances. Point number 1, at the time of risk assessment, okay, we applied materiality. At the time of further audit procedures, we applied materiality. Come to point number 3. Point number 3, at the time of evaluation. At the time of evaluation of what? Evaluation of uncorrected misstatements. Okay, uncorrected misstatements, whether they are material or not. Here also we apply what? Materiality concept. On all these areas we apply materiality concept. Okay, only those misstatements which are material in nature we consider. Okay, the audit is concerned about this materiality in 3 areas: at ROMM, at FAP, at evaluation of uncorrected misstatements. Okay, now let us have the discussion of materiality. What is materiality in fact? Okay, materiality is nothing but it is the misstatement which can significantly affect the economic decisions of the users. Which can significantly affect the economic, okay, decisions of the users. Say for example, in a financial statement, okay, okay, say imagine it is P&L account. It is P&L account. Okay, it is P&L account. Some X, Mr. X, okay, he is the person who is actually reading this, okay, P&L account to know the net profit, okay. After reading this P&L account, if he identifies the net profit as 1 crore rupees, then he is going to invest in the company. However, what management has done, okay, the original P&L account, the P&L account which is not misstated, if it is not misstated, then the net profit would have been only 50 lakh rupees. However, that P&L account got misstated by the management and they have shown it as 1 crore rupees, and Mr. X is now ready to invest in the company by reading the net profit which is misstated. Okay, Okay, now 50 lakh rupees have been 50 lakh rupees additionally they are, okay, showing in the P&L account profit side. 50 lakh rupees. Because of this 50 lakh rupees misstatement, now the economic decision of the user got changed. Okay, his focus is mainly on what? His focus is mainly on P&L. Okay, his focus is mainly on profit making, okay, of the company. His focus is mainly on profits. Okay, for that reason, because of this misstatement, Mr. X now, okay, now he is now subscribing to the securities of the company. He is now investing in the company because of this misstatement. Okay, so this is called materiality. This is called materiality in the point of view of, okay, in fact, whose decision got changed? Investor's decision got changed. However, materiality will not be fixed by the investor. Materiality will be fixed by the auditor. Now, auditor shall think from the side of investor. Okay, investor, also called as user of the financial statements, and he needs to, okay, step into the shoes of the users, and he needs to think from the side of user, okay, what his expectations are in relation to the financial statements. It is to be assumed by whom? Auditor. And it is the, okay, it is the thing where the auditor needs to assess, okay, or auditor needs to fix the materiality. Okay, he needs to fix the materiality going into the shoes of investor, okay, by looking into the aspects where what the user is tend to be focused upon, okay, where the investor is focusing upon. Based on that, the auditor shall fix the materiality. Now, can you define materiality? Materiality is nothing but it is a misstatement, Okay, it is the misstatement which can significantly affect the economic decisions of the users. Significantly affect the economic decisions of the users. Okay, it is from the point of view of user. However, it must be fixed by whom? Auditor. So auditor, first of all, he must step into the shoes of, okay, user, and then he needs to think from their side, okay, the focus where they show. Okay, based on that he needs to fix the materiality. So it is the amount fixed by the auditor which can significantly affect the economic decision of the users. Okay, now let us go into the details of materiality. First of all, it is there in chapter number 2 itself. So first of all, I am going to discuss materiality. So little, okay, quickly I'll complete this materiality concept. See, this is materiality, concept of materiality. So as per accounting also materiality is there. Say, as per schedule number 3, okay, those transactions which have 1% or more of the total turnover, okay, such transactions shall be taken into separate account other than miscellaneous account. Those expenditures which are more than 1% of the turnover, such expenditures shall be taken into separate account other than miscellaneous account. Now, as per accounting, materiality amount is 1% or 1 lakh rupees, whichever is higher in fact. Okay, and whichever is lower in fact. Okay, so this is as per accounting, which is not relevant now. Okay, so FRF, if it is prescribing the materiality, then it is for what? Accounting purpose. For auditing purpose, generally it is the misstatement. Okay, it is the misstatement including omission. Misstatement means what? What is to be there, it is not there. So it has to be 1 crore, but it is what? 50 lakhs. This is called misstatement. Or it has to be 1 crore and nothing is there at all. This is called omission. Both the things will come under misstatement only, and they are considered to be material. Okay, when it could reasonably expected to influence the economic decisions of the users of the financial statements. Okay, now the judgment has to be made by whom? Auditor. Okay, it is not the user, it is the judgment which is to be made by whom? Okay, auditor. So he must come to that conclusion of fixing the materiality. It must be made in the light of surrounding circumstances, okay, affected by size or nature of the misstatement. Size and nature of the misstatement. What is he talking about exactly? Okay, sometimes okay, users are scattered, right? Users of the financial statements are scattered. Okay, say there is Mr. A whose focus will be on P&L account. Okay, there is Mr. B who is the user of the financial statements whose focus will be on balance sheet, maybe on balance sheet data. So what is material for him, okay, may not be material for Mr. B. Okay, what is material amount for Mr. B may not be the material amount for Mr. A, because both of them have different focuses. Both of them are paying focus on different elements. Hence, they both may not match. Okay, now the auditor shall keep in mind not any particular individual. He needs to keep in mind entire general public, and he needs to think from the side of the entire general public. He needs to step into the shoes of general public, not any particular person, and he needs to decide the materiality. Okay, where he needs to keep in mind the general tendency of the people where they are going to focus on. Okay, it is to be generalized, not okay specific person's side we need to see. Okay, I guess you're all getting the point clear. Okay, now quickly see, judgments about the matter of material to users of the financial statements are based on, okay, consideration of common financial information needs of the users. It is not any specific person needs, it is common financial information needs of the users. Okay, see, the possible effect of misstatements on specific individual users whose needs may vary widely is not considered. So individual preferences are not taken into account. Okay, I guess you are all getting the point, which is very, very important. Okay, now I already told you one thing. Materiality can be fixed at what areas? Materiality is the amount. Materiality is the amount which may be fixed at the time of RAP, what is RAP? Risk assessment procedures at the time of further audit procedures. It is the amount fixed at, okay, assessment of ROMM and application of further audit procedures. Okay, now materiality may be fixed at, okay, financial statements level, like for overall financial statements, he will be keeping one amount as material amount. Say imagine 5,000 rupees. Now the audit is going to verify only those transactions which are more than 5,000 rupees in the financial statements. Statements. Like all the transactions, out of all the transactions, is going to verify only more than those transactions which are more than 5,000 rupees. This is called financial statements level. Okay. Also, he can keep the materiality level. Okay, not at the financial statement level. It may be at class of transactions, it may be at account balances, it may be at disclosures. Okay, what is class of transaction? Okay, what is class of transactions? It is P&L account, it is balance sheet, it is notes to account. So different materiality levels may be kept for P&L items, different materiality levels may be kept for balance sheet items, different materiality levels may be kept for notes to account items also for the purpose of verification. It is also possible, and this can happen at RAP. The same will be happening at what? Okay, FAP also. FAP also again divided into what? FSL. Okay, and the second side is called as assertion level. The second side is called as assertion level. Assertion level. Write this in detail. Okay, assertion level. Okay, later we'll have a beautiful discussion on this assertion. Okay, again it can be divided into what? P&L, also called as class of transactions, balance sheet, also called as, okay, account balances, and notes to accounts, also called as what? Disclosures. Notes to accounts, NTA. Notes to accounts, NTA. Okay, I guess you're all getting the point clear. Okay, that materiality may be fixed at different levels. Okay, now there is another concept called performance materiality. What is performance materiality? It is the, okay, amount which is fixed by the auditor just below the actual materiality. Because, okay, the purpose of keeping this performance materiality is, see, the purpose of performance materiality is what? It is the amount. See, what is performance materiality? It is the amount or amount set by the auditor. Okay, amount is nothing but financial statement level. A single amount will be there. Or amounts is nothing but what? Different levels. P&L account, balance sheet, and, okay, notes to accounts. So it may be amount or amounts set by the auditor which is less than what? Materiality level. Okay, materiality level, to reduce to an appropriately low level the probability that aggregate of uncorrected or undetected misstatements exceed the materiality for the financial statements as a whole. See what is happening here. Okay, the auditor has decided the materiality at 5,000 rupees. Now he is going to verify only those transactions which are more than 5,000 rupees. Now the management intelligently, okay, conducting the fraud, conducting the misstatement at less than, okay, in the transactions which are less than 5,000 rupees, at, say example, at, okay, at 4,500 rupees they are conducting the misstatements. Now as an auditor, what you need to do? You need to fix the materiality just below the actual materiality. What is actual materiality? It is 5,000. If you keep the performance materiality at 4,000, then obviously you will conduct the audit. Okay, you will conduct the audit of all the transactions which are more than 4,000 rupees. If that is the case, then the auditor will be able to find out the misstatements which may happen at 4,500, because he is verifying all the transactions above 4,000. And he is now able to identify the misstatement. Okay, to achieve this purpose, okay, see, undetected misstatements, to find out the undetected misstatements which may exceed the actual materiality. Okay, if those are clubbed, see, two transactions at 4,500, if it is clubbed, okay, obviously it will be crossing the actual materiality. That is called as aggregate. See, aggregate of uncorrected or undetected misstatements because of fixing materiality. Okay, to avoid these type of circumstances, what the auditor is having, okay, he is having the weapon called as performance materiality. It is fixed just below the actual materiality. Okay, I guess you're all getting the point clear. Okay, now let us talk about benchmark concept. Okay, benchmark. What is benchmark? So to get the material amount, say in previously I have selected 5,000 rupees as the material amount, right? How to fix this 5,000 rupees? Okay, generally we apply small percentage. We apply small percentage like 10% or 1% or 2%. Okay, the small percentage is applied on something called as benchmark. Something called as benchmark. For example, this benchmark may be net profit. This benchmark may be total asset. Okay, this benchmark may be net worth. Okay, it can be anything. So first of all, auditor needs to select this benchmark, and based on that he needs to apply the small percentage to fix the materiality, to calculate the material amount. Now the discussion is about how to select this benchmark. What factors may affect the selection of the benchmark? Now let us have some discussion on this. Okay, there may be a case where for the first time we are auditing the entity which has been incorporated in the first year itself. Okay, now in this year itself X Limited has been incorporated. Okay, so for that there is balance sheet where the fixed assets are there, current assets are there, and liabilities are there. However, the company is not into the business completely. Okay, company is not earning. The company did not sell anything. There is no P&L account. So the elements of the financial statements, now got only liabilities and assets. Now, as an auditor, you need to fix the benchmark out of the elements of the financial statements only. If the P&L account is not there, how can you select net profit as your benchmark? It is not possible. So this is the first factor. The elements, based on the elements, you need to decide the elements of the financial statements. You need to decide the benchmark. This is the first point. See, factors affecting the selection of the benchmark. See, the factors which may affect the identification of the benchmark. Point number 1. What is point number 1? Believe me, my eyes may look sleepy. My face may look sleepy, but believe me, I am not sleeping. Okay, this may be the last class for the day. It is almost 11:30 in the night. I started recording classes. I started taking classes in the morning right from 9 o'clock. Okay, various classes I have taken, and continuously I have been recording since evening this class. Okay, this may be the last class. So believe me, I am not sleeping. So this is the magic of CA, in fact. Okay, you can get enormous confidence. Okay, you can do whatever you want after you qualify CA. That level of confidence you get, even not after CA. Okay, even after completing CA Inter itself, people will get huge, enormous confidence. Okay, right from the morning I started taking classes. I dealt with CA Inter Law. I dealt with BCK Foundation. Now I started with CA Inter Revision classes. As the exams are very near, I started with this. Okay, that commitment one will have. Okay, one will get only after doing this courageous course called as Chartered Accountancy. I hope one day you will become Chartered Accountant, and that day is no longer. It is coming soon. Okay, keep your efforts intact. Okay, pay 100% attention in the classroom. Pay 100% attention when you prepare. Keep your mobile phones, etc. After the class. Okay, after the class, keep the mobile phones, etc. aside, and try to focus 100% on the preparation. Okay, last 10 days. Okay, keep your commitment intact and do whatever the maximum extent you can do. Okay, done. Point number 1, elements of the financial statements. Come to point number 2. Now you tell me, while fixing the benchmark, there are certain industries, there are certain companies where users' attention will be mostly on what? P&L account, not on wealth, because that company is been incorporated recently before 5 years, and the company is now earning huge profits, where the users of the financial statements focus tend to be on what? P&L only, rather than what? rather than balance sheet items. So now if the focus of the users is on P&L item, then better to fix the net profit as the benchmark, because their focus is on what? Profits only. If the focus is on balance sheet item, then better to fix the benchmark as net worth or total assets. Okay, now this is the second point. See whether there are items on which the attention of users may tend to focus upon profit, etc. See, of a particular entity's financial statements tend to be focused where the attention of the users are going to be. Attention of the users is going to be. Okay, that is what we need to keep in mind while fix the benchmark. If they are interested in P&L account, go and fix the benchmark as net profit. If they are interested in what? Okay, if they are interested in balance sheet items, then go and fix the benchmark as net worth. Okay, now coming to third point. Okay, now you tell me one thing. There will be life cycle for the entity. Okay, after the entity comes to the maturity level. Okay, maturity level. So from that period itself, the profits will be stabilized, or the profits will be in a may fall down. Profits may be declining. So for the first year, imagine for first 10 years profits are rising. For next 10 years, okay, company came to for next 10 years. Okay, in between company came to maturity level. After that, profits won't be changing, but the company's focus will be mostly on what? Wealth, not on profit making. It will be on wealth. Okay, after the company came to its life cycle, end of the life cycle, then the benchmark selection would be based on what? Wealth. In this case, net worth may be suitable, but for the first 10 years, net profit may be suitable. So this is the third point, nature of the entity, where the entity is in its life cycle. Is it at the end of the life cycle, or beginning of the life cycle, or middle of the life cycle? Okay, this is the third point. And last point, entity's ownership. Last 2 points, entity's ownership. If the entity is completely financed by debt, whatever the profits they earn, okay, they will go out by way of interest. Always the profits will be low only, because the company is completely financed by debt, borrowings only. So in this case, net profit will be always less. Okay, when the net profits are less, then better to go for the benchmark which may be taken from balance sheet. Okay, net worth is better to be chosen rather than net profits, because the entity is going to get the get low profits, because the entity is completely financed by what? Debts, and interest expenditure will be huge. And one more last point, you tell me the answer. There is net profit, there is net worth. From last 10 years, I'm observing the same. The net profit is not stable. 1 year it is showing 1 crore. The next year it is showing 10 lakhs. The next year it is showing 20 crores. The next year it is showing something else. Okay, it is completely volatile. There is no stability in the net profits. Hence, it is better to choose net worth as the benchmark rather than net profits, because the benchmark is having the volatility which is high. Okay, that is the last point. Okay, now revision of the audit. Revision as the audit progresses. Yes, you fixed the materiality, you planned the audit, you performed the audit. Now, okay, in the middle of the audit, you got certain information. See, you are aware of certain information. Okay, and it caused you to see during the audit, that would have caused the auditor to have determined a different amount or amounts initially. You got that information. Now it caused you to think of different materiality initially, different material amount initially. Oh, if this amount would have been taken at the initial stage, then it would be correct. This is the opinion you got now. Okay, if such kind of information is there in your hands, then as an auditor you need to revise the audit materiality which was already fixed by you previously, and you need to conduct the audit, okay, right from the revised materiality. Now you need to further plan the audit taking the revised materiality levels. This is revision of audit, okay, revision of materiality as the audit progresses. If he has that information in his hands, which may require him to change the materiality which was already fixed. Okay, this thing you can just read. Last one, what is the documentation requirement under this standard? You fix the materiality, okay, you fixed the performance materiality, and you fixed at financial statement level, or you may fix at assertion level also, and at last you may have to revise the materiality, you may have to revise the performance materiality. Okay, then all these things shall be documented properly. All these things shall be documented properly. With this, I am done with standard number 320. Standard number 320. Okay, quickly within 20-25 minutes, I just want to wind up chapter number 2 by discussing, okay, standard number 300. Standard number 300. SA 300. SA 300. It talks about planning in an audit of financial statements. Planning in an audit of financial statements. Now, what is planning? What are the benefits of planning? What are the benefits of planning? Okay, planning. It is what? It is the plan what the auditor keeps. What the auditor keeps, just a minute. It is the plan what the auditor keeps to perform the audit. Okay, so this planning involves 3 points. Point number 1, 2, 3. Establishment of overall audit strategy. Okay, establishment of overall audit strategy. Okay, development of audit plan. Development of audit plan. Next one, writing the audit program. Okay, writing the audit program. Okay, these 3 things will form part of audit planning. So when we have the planning in our hands, okay, who does this planning in fact? Okay, now let us have a small example for that. Take the example of Balla and Associates. Balla and Associates, it is the audit firm having 10 partners. Now there is an audit which has been allocated to, okay, which has been allotted to Balla and Associates. The client's name is X Limited. Now, okay, out of these 10 partners, one partner will be engaged to this. He is the responsible person for conduct of audit of this X Limited. He is called as engagement partner. Okay, under him there may be many other companies also. One of the companies is, okay, X Limited. Now this engagement partner will have his engagement team. What is that? Engagement team members. Okay, this team will contain whom? Article assistants, audit assistants, etc. Okay, and this engagement team members may have some key members also. Key members who have such, okay, experience, knowledge, etc. Okay, now once we start the audit of X Limited, this engagement partner and this key members of the engagement team, they'll sit together, okay, they'll discuss and they'll formulate the plan. Okay, they'll formulate overall audit strategy and they'll develop the audit plan, and they'll also write what? Okay, audit program. All the 3 are completely different. Okay, now this engagement partner is the ultimate person who is the responsible person for the audit. Okay, though the work is done by engagement team members, okay, every time this engagement partner has to review the work which is done by others. He has to direct them. He has to, okay, supervise them. Okay, to whom he needs to supervise? Okay, whom do he needs to supervise? Okay, he needs to supervise whom? Engagement team members. Now that is what he needs to plan first of all. Okay, what is to be conducted? Who shall conduct the same? And at what time the work shall be reviewed? Everything must be planned. So that planning includes review procedures also that are to be performed by engagement partner. Okay, now okay, at last we will be seeing the benefits of planning. First of all, engagement partner and other key partners or other key members of the engagement team will be involved in development of audit plan, and they'll perform the audit in such a way as per the plan, okay, or as planned. Okay, done. Now okay, first one we'll start with establishing overall audit strategy. While establishing overall audit strategy, okay, auditor needs to consider three things: scope of the audit, timing of the audit, point number 3, the direction that has to be given by the engagement partner to engagement team members. Direction, okay, engagement partner to engagement team, okay, direction that is to be given by the engagement partner to engagement team. All these things he needs to keep in mind. So what is scope? First of all, scope of audit is nothing but to what extent the auditors are required to do the audit. Say how many locations are there for the client, okay, how many locations, okay, so that the scope will be more, right? When there are more locations, obviously the scope of the audit will be more. We need more team members to perform the work because the locations are more, okay. That is called as what? Scope. This is one of the examples. Scope. First of all, scope must be decided, okay. He must keep scope in mind to fix what? Audit strategy. So what are the benefits of audit strategy? Later we will see, okay. Once we fix the audit strategy, okay, some benefits we are going to get. Now next one, timing. When to report. So this is called as reporting objectives, okay. When to report, what is the time we have to complete the audit. And third point is direction, okay, direction requirements. To what extent engagement partner shall direct the engagement team members efforts, okay. There are certain factors, okay, which may affect the direction responsibilities of engagement partners. Now let us talk about one or two factors, okay. Now tell me one thing. This engagement partner has done the audit previously also. All these engagement team members are new. They came into picture in the current year itself. Now as the engagement partner who has that knowledge, he has to take the responsibility of directing this engagement team members work. All the engagement team members are, okay, new, and they have to be, okay, directed by the engagement partner. They have, okay, the work of engagement team members have to be reviewed by whom? Engagement partner, okay, directed, supervised, okay. This is the factor, previous knowledge of engagement partner. This is the first factor. New members in the engagement team, it needs, okay, more direction to be given by engagement partner. This is called as direction responsibilities, okay. STD, that we need to keep in mind. So this is how we develop the overall audit strategy. What are the benefits of overall audit strategy? Once we develop the overall audit strategy, see, our engagement team members may have, okay, in the firm there may be many people. Now after we develop the audit strategy, keeping in mind the scope, timing, direction, then, okay, these things we will be achieving. See, we will be achieving employment of qualitative resources. What is called as resource? Resource is what we use for the purpose of doing the audit. Generally human resource, article assistants, okay, audit assistants, those are the persons who are called as resources for the auditor, okay. Now after developing the audit strategy, okay, the engagement partner can engage, okay, qualitative resources, okay. He will come to know whom to be engaged in the work, whom to be the person who has that capability has to be engaged for that particular work. That is what he will come to know, okay, whom to be engaged. How many are required? How many of the persons are required for conducting the audit, okay. At what time they need to be sent, okay, at what time such persons are to be sent to the audit. Timing, at what time. Come to fourth point, okay, all the resources can be properly managed by the auditor when he implements the audit strategy, well. This is the first point. This is the first point. Okay, overall audit strategy. Overall audit strategy. Come to the second point. It is called development of overall audit plan. Development of audit plan. STD in the previous case. Okay, now in the current case, development of audit plan, it is nature, timing, extent of, okay, in the plan, what do we need to write? The auditor needs to write NTE of risk assessment procedures. And we know that. What is risk assessment procedure? Can you name one procedure for the same? Inspection, inquiry, observation, analytical procedures. These are the things we use as risk assessment procedure. That we need to write in the plan. Okay, nature, what procedure we need to use, timing, when to apply that procedure, okay, to what extent that is to be applied, everything must be written in the plan. This is first point. NTE of further audit procedures. After the risk is assessed, further audit procedures. Now third point, NTE of other audit procedures. Other audit procedures. These are to be, okay, forming part of audit plan. It must be developed by the auditor. Okay, nature, timing, extent of risk assessment procedures, nature, timing, extent of further audit procedures, nature, timing, extent of other audit procedures. And we know what? We know this risk assessment procedure, we know this further audit procedures. Okay, now my work became so easy. Okay, if you do not know these names, then it is very difficult for me to explain this question. Explain this question called as audit plan. Okay, I guess you're all getting the point. Now, let us look into the benefits of the audit planning. Benefits of audit planning. See, out of all the areas, if you can plan properly, you can identify the important areas where the focus must be more. Attention to the important areas. Okay, and if any problem is identified, with the help of your planning, you can resolve the problem, okay, on timely basis. So when you have the proper plan in your hands, you can select right people to right work. Proper selection of engagement team. Okay, and the audit can be properly organized, audit can be properly managed. Proper organization and management of the audit, okay, engagement team, audit engagement team, or audit engagement is sufficient. Audit engagement. See, direction, planning involves what? Direction and supervision of engagement team. This we know. Okay, and this last point you will be able to understand only when I talk about experts. Only when I talk about experts, or only when I talk about auditors of components. Okay, in other stand we will be getting this knowledge. Okay, in other standards, auditors of the components, etc. will be talking about, okay, in standard number 600. Okay, when I talk about 600, we will be getting the understanding of point number 6. Okay, till then we need to wait, in fact. So I cannot just directly jump to standard number 600 now. Okay, done. So all the planning must be done by the auditor only after having the knowledge of the business. That we know. Okay, how to get the knowledge of the business? In standard number 315 we are going to learn. Okay, just for the time being you can just ignore this. Okay, how to get the knowledge of the business, how to get the knowledge of client's business, that we'll learn when I go to standard number 315. So for the time being I am leaving. It is so simple, in fact. These are the 5 points. It is so important, in fact. Okay, well, we'll be learning in standard number 315, which is there in chapter number 3. 1, 2, 3, 4, 5. These are the 5 points you need to write whenever it is asked in the examination. This question. Okay, done. Now, one important question which may be there in the examination this time. Okay, I already told you that the auditor, okay, the engagement partner has to direct and supervise the engagement team members. Okay, so to what extent he needs to direct, to what extent he needs to supervise? Okay, is it okay, it has to be regular or not? Okay, what can be the time gap between each, okay, reviews? Everything will depend upon certain factors. Those factors are point number 1. You can just simply answer the same. When I ask you something, okay, if the entity is huge in size, Okay, huge in size, and the transactions which involve in that entity is complex in nature, then obviously review procedures and direction, supervision, responsibility of the engagement partner will be increasing. Okay, it may be one of the factors of direction, because as the transactions are complex in nature, then obviously it affects the direction, responsibilities of whom? Engagement partner. So point number 1, is it clear or not? Size and complexity. Okay, and some areas of the audit which is critical in nature. So regarding that areas, okay, the audit engagement partner's direction is needed. Okay, that may be second factor, area of the audit which is complex in nature. Point number 3, if the assessment of risk of material misstatement is high, okay, when ROMM is high, obviously when the risk is high, the engagement partner shall take care of the audit very well. Okay, now it needs to be reviewed, okay, frequently. For that reason, assessed risk of material misstatement is also the okay factor which may affect the engagement partner's direction, responsibilities. Okay, now you tell me, if the engagement team members are capable enough to, okay, complete the work on their own, they are capable enough, they have that competence. When they are competent enough, obviously the work of the engagement partner to review the same will reduce. Okay, if they are not competent, obviously the responsibility of engagement partner to direct the same is increasing. Okay, so the factor is what? The capability and competence of individual team members in the audit work. If they are capable enough, reduce the review processes. If they are not capable enough, increase the direction, responsibilities. Okay, I guess you are all getting the point very clear. And the next concept is, okay, planning. Is it a discrete phase of audit or is it a continuous process? Okay, planning is not conducted at the beginning of the audit or at the end of the audit or at the beginning or at the middle of the audit. Okay, it is a continuous process. It starts right from the end of the previous audit, it ends till the audit is completed. Okay, it is a continuous process. As and when we get the new information, we may change our plan. Like how we plan our preparation for CA final or CA inter. Okay, initially we plan something, later it becomes something. We plan for both groups, we change to group 1. Okay, later we change to single group exemption. Okay, at the end we are not going to write the exam. It may happen. Okay, in a similar way, because of the changing circumstances, plan may also be changed. That is called as what? Planning, a continuous process, and there can be a change in planning also. Okay, based on what? Unexpected events or changing conditions. Based on that, the plan may be revised. Okay, so now under standard number 300, what are the things to be documented? Okay, we established the overall audit strategy, we developed the audit plan. Okay, and we may change the audit plan or audit strategy. Okay, all these things to be documented properly as per standard number 300. Okay, yes, this is given as homework. You can read. Easy only. Homework. Factors to be considered in development of overall audit plan. Okay, around 6 or 7 points you need to read. Easy only. Okay, overall audit strategy, it is done. Scope. Okay, timing, direction, it is done. Establishing overall audit strategy, what is to be kept in mind? So scope, timing, direction, it is also done. Those 3 points are enough. Last point is nothing but what? Ascertaining nature, timing, extent of procedures necessary to perform. Okay, one last point. Okay, this may be the important question. Overall audit strategy and audit plan. Okay, overall audit strategy is getting the knowledge of scope, timing, direction. Okay, after you develop the audit strategy, then it forms the basis for audit plan. So first step will be overall audit strategy, next step will be audit plan, where we write the nature, timing, extent of the audit procedures, what we are going to apply in relation to risk assessment procedures, in relation to further audit procedures, in relation to other audit procedures. So the relation between overall audit strategy and audit plan is step number 1 strategy, step number 2 audit plan. Okay, and development of audit strategy provides the guidelines for development of audit plan. Okay, audit strategy establishes the scope, timing, direction, but audit plan gives you nature, timing, extent of risk assessment processes and further audit process. This is the relationship between overall audit strategy and the audit plan. Okay, now the last concept, okay, around 5 minutes or 5 to 10 minutes I will take to complete. Okay, audit program. Audit program is nothing but more detailed plan. Audit program is nothing but more detailed plan. Okay, every inch of the audit is been recorded here. Whatever we are going to do in the coming 2 or 3 months, everything is written down now. Okay, who needs to go there, at what time he needs to go, every detail you must write. This is called as program, and this program involves review procedures also. See, audit plan contains only risk assessment procedures, other audit procedures, or further audit procedures. However, audit program will contain the details of review procedures which are to be exercised by the engagement partner, because he has to review the work which has been performed by engagement team members. It shall form part of what? Audit program. Okay, an audit program is the detailed plan. See, it is the detailed plan of work being prepared by the auditor while carrying out the audit. Okay, point, it constitutes not only the plan but also provide for supervision and control of the audit work. What is supervision? Direction, supervision and review. Okay, it comprises set of techniques and procedures which the auditor plans to apply in the given audit. Okay, whatever he wants to do, everything must be written in a document called as audit program. Every detail, it is more detailed plan. The more detailed plan is called as what? Audit program. It must be written format. See, the audit program lists down the areas of audit. The audit program covers the audit timings and it acts as schedule for the audit, plan. It acts as schedule for the audit plan. Audit program allocates the work among staff members and fixes the responsibility over them. This is the advantage. Okay, so this is the requirement of audit program we are reading now. Audit program allocates the work to the staff and it fixes the responsibility to them, accountability to them. It specifies the procedures to be performed. What procedure they need to perform. Okay, the audit program acts as checklist during the performance of the audit. Okay, when you write down everything, then this acts as a checklist to compare with the works you do. Okay, done. This is called as checklist during the performance of the audit. It works as the basis for billing the clients. This is the work I have done. Based on that, I am going to bill you. Okay, I am going to give you the bill. I am going to charge you. Okay, that is the last point. It acts as the working papers of the audit staff. The working papers of the audit staff can be reviewed. See, it is not acting as working paper. Okay, my mistake. It is 6 point. The working papers of the audit staff can be reviewed against the audit program, because as per audit program only they have conducted the audit. Okay, as per that only they need to collect the working papers. Both shall match. Okay, so it is possible by having the audit program. Okay, now yes, this is given as homework. In fact, you can ignore this. Okay, come to the next point. While you develop the audit program, following matters must be kept in mind. It shall be written format only. Okay, and while you develop the audit program, the audit objective must be known. Okay, the audit objective, which area to be focused more, which area is not to be focused more. If it is internal audit, all the areas must be focused upon. If it is only statutory audit, only financial areas will be focusing upon. Okay, so for that reason we need to have in mind what? Audit objective. Then we need to think of the reliance to be placed on internal controls. Okay, this point you will understand in the next session. And timing of execution of the audit procedures, everything you need to keep in mind. Okay, when you have this in your mind, requirement of the audit program, you will be able to answer advantages of audit program. Once you know this advantage, you will be able to answer disadvantages also. Easy to read. I am giving this particular point as homework. Okay, next 2 questions are there. Advantages of the audit, program and disadvantages of the audit program. Everything is easy. If you have any doubts after reading this, any point, okay, any point, you can just comment down below the video. Okay, I'll be texting you back through that comment. Okay, it is an easy concept only. Advantages and disadvantages. In regular class, I give this topic as homework. Okay, now so entire topic will be given as homework, in fact. But now in the revision class, I have taken up all the topics except two, advantages and disadvantages, which are very, very easy to work upon. Okay, this is given as homework. Okay, with this I am done. Okay, if any doubt you have, you can just comment below. I'll be replying for that. Okay, done. With this I am done with chapter number 2 also. It took me around 1 hour 5 minutes to complete materiality and standard number 300 also. Along with that, we have discussed some concepts of chapter number 4. Okay, that is standard number 315. Okay, done. With this, I just want to wind up today's session. Okay, hectic session for me, hectic day for me, in fact. Okay, done. Tomorrow freshly we'll start. Done. Thank you. Okay, bye bye. Yes, welcome back. In the previous class, we were done with chapter number 2 revision. Now we can start with chapter number 3. So straight away we cannot discuss chapter number 3 in its entirety. We need to go to chapter number 4 also sometime. So simultaneously we will be almost completing chapter number 3 and chapter number 4 itself. So when I was discussing chapter number 1, I went to chapter number 4. Okay, and again when I discuss chapter number 3, I'll go to chapter number 4. By the end of this discussion of chapter number 3, we'll be almost done with chapter number 4 also. Okay, let us now try to understand what it is there in chapter number 3 and chapter number 4. Okay, now today the session, 1.5 hour, almost it will be for 1.5 hour. The next 1.5 hour, whatever I teach, it is the area in the audit which is very, very important for the examination purpose. Okay, the concept behind this behind these topics, it is too important for MCQ purpose, and it is the actual beauty of the audit which is there it lies. Okay, it is the actual beauty of the audit which is there in this topic itself, Okay, done. Let me talk something related to audit procedures, which is so significant for examination point of view, and along with that, conceptual understanding is 100% required in this area. Conceptual understanding is 100% required. Okay, next 1.5 hour, I cannot go quickly in these areas because they are very important for examination purpose. I cannot complete in a quick way, like 30 minutes, 45 minutes I cannot complete. I'll take at least 1.5 hour, and it is worth watching this 1.5 hour. Worth watching. It is the area where the beauty of the audit lies. Hence I suggest you to listen to the class patiently for next 1.5 hour. I cannot help it because I must take 1.5 hour time to complete. Though I know I shall complete the entire revision. I shall complete entire revision within 12 to 15 hours. So out of the 2 hours discussion, almost 2 hours discussion will be there. It will be more than 1.5 hour, in fact less than 2 hours. Almost it can take. So I know the value of these 2 hours in that entire 12 to 15 hours. So now you can understand how important it is. Now you need to pay 100% attention. Done. With this, I just want to write one audit sequence now, which was already completed, and with that we'll start going further. So we'll start with what? Management request. Management will request the auditor to conduct the audit. See, management request, and that request shall be accepted by whom? Auditor, and it will become audit engagement. After that, the auditor will start planning. And that planning we studied in standard number 300. And then auditor needs to apply audit procedures. After he applies the audit procedures, he will be getting audit evidence which is sufficient and appropriate, and then he will be able to form audit opinion, and then he'll be able to give audit report. This is audit planning. Okay, now our focus will be mainly on this area in this session. That is what? Audit procedures. Okay, let us understand. Okay, audit procedures are divided into two types. Risk assessment procedures and further audit procedures. That is what we discussed in the last class itself, and it is there in standard number 500 also. When we start reading standard number 500, initially in the first paragraph itself, it will be there. Okay, audit procedures are divided into what? It is divided into risk assessment procedures and further audit procedures. Now, risk assessment procedures are there in standard number SA 315. Further audit procedures are there in SA 330. Okay, now this standard number 500 is there in chapter number 3. Okay, where they talked about something called as 315. They talked about something called as risk assessment procedures, and this 315 is there in chapter number 4. For that reason, now I just need to go to chapter number 4. Now before I go there, okay, let me complete this chart. First of all, you need to write the chart whatever I write, and then slowly I will go to other areas. Okay, this is risk assessment procedures. Okay, now after the let us do one thing. Okay, I'll complete the concept and then I'll fill up this chart. Okay, I hope now you will get the understanding a little better. Okay, in a little better way. Okay, for that reason I'm doing the concept first of all, and then I'll develop the chart. Okay, I hope you understand what I'm saying. Okay, done. With this, I just want to go to chapter number 5 first of all to see RAP standard number 315. Okay, done. Let me go to chapter number 4. I'll interrelate every concept in a detailed way. Okay, this will help you a lot for your preparation. Okay, let me go to chapter number 4. Chapter number 3 is use. That's why I'm taking 1.5 hour to 2 hours time to complete this. Chapter number 3 is use. See, chapter number 4, it talks about risk assessment and internal controls. Okay, it is audit risk concept we were already done with, and we all know this. Okay, called as inherent risk, control risk, detection risk, everything was already completed. Okay, now there is a relationship between inherent risk and control risk. It was also done, and ROMM into detection risk also we know that. Okay, and all this we were done with. Now let us try to understand standard number 315. Okay, what is the name of the standard? Standard number 315 talks about, see, okay, standard number 315 talks about, the name of the standard itself says identifying and assessing the risk of material misstatement by understanding the entity and its environment. Okay, this is the meaning of this standard. So name of the standard. Okay, standard number 315. I'll go. Okay, I hope you understand why I'm going slowly. Okay, identifying and assessing the risk of material misstatements, and you know why we are assessing the risk. Only because it is because only when you assess the risk of material misstatement, then only you can plan the further audit. Okay, to what extent you can do the audit and all, you will be knowing only after you assess the risk of material misstatement first. Okay, for that reason, and this concept starts from what? Audit risk concept only. Okay, now identifying and assessing the risk of material misstatement by understanding the entity, and its environment, environment. This is the standard name. Now you tell me the procedures what you apply for assessing this ROMM, identifying this ROMM. Okay, it is called as risk assessment procedures. procedures. Risk assessment procedures. So in standard number 315, what they said, in an organization, for the purpose of assessing the risk of material misstatement, following procedures must be used by the auditor. Okay. Point number 1, inspection. Point number 2, inquiry. Point number 3, observation. Point number 4, analytical procedures. Okay, procedures. These are the procedures. Okay, as a part of risk assessment procedure, as a part of risk assessment, an auditor can apply. Okay, that is inspection, inquiry, observation, and analytical procedures. Okay, so by applying this, the auditor will come to know, okay, at what level the risk of material misstatement is there for the entity. For that purpose, he may inspect various books of accounts. He may inspect various documents which contain the strategies of the organization or the procedures what they follow, the policies what they have. Okay, everything he can inspect. All this is preliminary assessment, right? Okay, for that purpose, he may inspect the documents, records. Okay, for preliminary assessment of the business. And he may talk to whom? He may talk to management. He may talk to other employees. He may talk to internal auditors. He may talk to legal counsel, okay, to get the information about the entity. So all this he is doing for the purpose of assessing the risk of material misstatement. In that, what are we having? We are having what? Inherent risk, and we are also having what? Control risk. To assess the control risk, we need to have the knowledge of the controls. And also you can observe what? Okay, you can observe how well they are doing the business and how well they are implementing the controls. Okay, that is what we can observe. Okay, how well the operations are being done by the company. Okay, that is what we can observe. And you can also use analytical procedures. You can compare the entity's results with previous results, and you can also compare entity's results with industry results. You can compare the gross profit ratio of the company with gross profit ratio which is average of the industry. Okay, everything you can do preliminarily to assess the risk of material misstatement. What the auditor is trying to do? Okay, he is now trying to do in the financial statements, balance sheet, P&L account. Okay, what is the risk of material misstatement? Is it high or is it low? Okay, he is trying to give the assessment just by understanding about the entity. What he is trying to do? He is now trying to get an understanding of the entity. Okay, understanding of the entity. Okay, how to get this understanding? There is one beautiful question. Okay, based on that, he is able to now decide, okay, at what level the risk of material misstatement is there. Is it high or is it low? Okay, for that reason, what he is trying to understand, he is trying to get an understanding of the entity and its business. So along with that, he needs to get an understanding of the internal controls also. See, why the internal controls are put in place? Internal controls will replace the human presence. Okay, the senior management, because they cannot they cannot see each and every aspect of the organization, each and every transaction. They put in place certain controls. Those controls will serve the purpose of preventing, detecting, correcting the misstatements which may happen. For that reason, who will implement these controls? Management will implement. Senior management, those charged with governance, they will try to implement the internal control. Those controls will replace the requirement of the presence of the senior management, though they may not be there each and every time, each and every points of time. Okay, so these controls will replace. Okay, and the objective of this control is what? Okay, to prevent, detect, prevent the occurrence of the material misstatements. Okay, now auditor is now what he is trying to do? Okay, he is trying to understand the entity and he is trying to get an understanding of the internal controls also. After he does the same, now he will be able to assess the risk of material misstatement as high or low. If it is high, okay, he needs to plan the further audit processes in such a way. If it is low, he needs to plan the further audit processes in such a way. I already told you, when ROMM is high, okay, the responses will also be high. The further audit process will also be high. So out of 1000 transactions, okay, if ROMM is high, they may verify 900 transactions. If RVMM is low, they may verify only 300 transactions. So how many transactions to be verified? It depends on what? It depends on the level of risk of material misstatements, whether it is high or not. Okay, how to assess after understanding the entity? Now you tell me one thing. After getting an understanding of the entity, auditor came to a conclusion that whoever is preparing the financial statements, they have no integrity at all. Previously they were been to jail, they were sent to jail for 10 years and recently they came out and they are preparing the financial statements. Now you tell me, is there any integrity? Will there be integrity or not? There may be chance of material misstatement in the financial statements. There may be a chance of fraud also in those areas. Okay, or lack of knowledge of the management. I inquired with the management, I asked their competence, I asked their qualifications, because they are the actual persons who are preparing the financial statements. They need to have the knowledge. When I asked them, they replied, I studied 10th class 10 times. Can you determine, can you give the level of risk assessment as high or no? Because they have no knowledge of preparation of financial statements, then the risk of material misstatement may be high. And by inquired with employees, the employees said in this financial year 2 times we identified the frauds. This is the preliminary information what I got from the employee just by inquiring them as a part of risk assessment procedures. Now you tell me, there may be a chance of risk now. Now you need to assess the risk of material misstatement as high. This is how we do preliminary assessment of the organization for the purpose of giving a level of assessment, for the purpose of giving a level of risk to that, allocate the risk, level of risk. For that reason, after doing everything, auditor can assess the risk of material misstatement of an organization at 2 levels, low or high. That is what the general words we use. In the auditing terms, we call them as financial statements level. Financial statements level. It is a high level of risk of material misstatement because it is pervasive in nature. The misstatements may be having pervasive nature, high level. Coming to the second side, it is what? It is not financial statement level. It is it is assertion level. It is assertion level. So this is not as high as financial statements level. And what is this assertion level is called as? This assertion level is called as, it is divided into 3 parts. Either it can be class of transactions, COT means what? Class of transactions, and AB is account balances, and third one is disclosures. Generally, class of transactions are called as what? P&L items. Account balances are called as what? Balance sheets. Disclosures will be there in the notes to accounts. Now, as an auditor, after getting a preliminary understanding of the business of the organization and after getting the knowledge of the internal controls which are put in place by the management, preliminary assessment, what he is trying to do? He is only trying to do the preliminary. He is not verifying anything. He is just talking to someone, getting the information. He is observing something, getting the information. Based on that, he is giving the assessment. Whether high or low. There may be 2 instances. Either he may decide the risk of material misstatement at financial statement level, which is high. Or also he can decide, the risk is there only a few areas. Either it can be in the balance sheet items, or it can be in the P&L items, or it can be in the notes to accounts items. There are some misstatements, there is some risk which is existence in disclosures, because the management may fail to disclose as per the requirements of FRF. This is the risk what there may be. For that reason, he may assess the risk of material misstatement at assertion level also. Now what exactly this word called as assertion? Assertion is nothing but it is the representation made by the management. They don't need to say it separately. This representation will be embodied in the financial statements. Now let me take some example. In a balance sheet which is prepared by the management, there is an asset called as fixed asset machinery. Fixed assets, they are showing okay, 1 crore rupees. After this fixed asset is shown in the balance sheet at 1 crore rupees, okay, what is that management is trying to say to the users of the financial statements? Okay, the first point what they are trying to say is the value which is there in the balance sheet 1 crore rupees, this is properly valued. Once they have shown in the balance sheet, okay, is this properly valued or not? Okay, is this properly valued? Yes, this is valued properly after taking out the depreciation at appropriate rates. Okay, this is what the management is trying to say to the intended users through the financial statements. They don't need to separately say whether it is properly valued or not. Once they show this 1 crore in the balance sheet, it says what? It is the representation made by the auditor, okay, which says this the fixed assets is valuing 1 crore rupees. Okay, 1 crore rupees, it is been properly valued. Okay, and when I show this 1 crore rupees in the balance sheet, okay, is that in, okay, physically in existence? Is that asset, okay, is there physically? Is that asset is in existence physically? Yes, sir. Okay, existence is the thing they are trying to confirm. Okay, they are now trying to confirm to, okay, whom? To the users of the financial statements through this financial statements. Okay, they are trying to say whatever the asset which is shown in the balance sheet, it is in existence. It is in existence. They don't need to say it separately. What it means, when they show 1 crore rupees in the balance sheet, it means the asset is in existence. It means the asset is in existence. And okay, once that 1 crore is there in the balance sheet, who is the owner of that asset? Okay, company is the owner of the asset. Okay, that is called as ownership. Ownership, also called as all the rights and obligations of that asset is there with the company itself. This is what they are trying to say. Okay, these things when put together, okay, individually it is called as what? Assertion, valuation, assertion, existence, assertion, ownership, assertion. Okay, assertion. I guess you are all getting the point very clear. Okay, now whatever I discussed, it is the assertions related to balance sheet item called as financial fixed assets, balance sheet item called as fixed asset. Okay, now also we call it as what? Account balances. Similarly, there are some assertions for class of transactions also. There are some assertions for disclosures also. Okay, we'll discuss that, okay, in a while. Okay, now what I just want to let you know is, okay, for every transaction, okay, for every item which is there in balance sheet, which is there in P&L account, which is there in the notes to accounts, they have what? They have assertions. Management is trying to say those assertions are valid. Now as an auditor, okay, you need to check whether those assertions which are made by the management is, okay, right or wrong. I guess you are all getting the point very clear. See, okay, what they told, this asset which is, okay, valuing 1 crore rupees is in existence. This is said by whom? Management, which is embodied in the financial statements. Now as an auditor, you need to check whether this assertion which is being made by the management is proper or not. Now what you need to do, you need to go and physically verify the existence of the asset. Okay, now as an auditor, you need to go and check whether that, okay, whether that asset is in existence or not. This is what your work is all about. Okay, now you need to verify each and every assertion, okay, which is being made through the financial statements by the management. Now, is it possible to check each and every assertion for every transaction? No, because of existence of inherent limitation, time constraints, cost constraints, etc. Okay, so now as an auditor, okay, see, as an auditor, what you need to do, you started with standard number 315. As a part of standard number 315, you need to identify the risk. You need to assess the risk. How to identify the risk? The risk may be identified by using following procedures. What are the procedures? Inspection of certain documents, strategies of the organization, policies of the organization. That is what you can inspect. Inquire with various persons of the organization to get some preliminary understanding of the organization. Observation of the work which is performed by others, or observation of the business operations, what exactly they are doing. Okay, or you can compare the entity's financial results with, okay, previous financial years or other industries players. Okay, this is what you can do for the purpose of assessment of risk. After that, okay, you need to assess the internal controls also. You need to get an understanding of the internal controls which are being put in place. Who will keep that internal controls? Okay, internal controls will be implemented by management. And why the internal controls? Because internal controls will replace the existence of, presence of, okay, whom? The higher management. Okay, these controls will always try to prevent, detect, correct the misstatements. Okay, see, now imagine an instance where in an organization there will be cashier. Cashier is the lower level management, where the owner is someone, where the director is someone which is different, who is different. Okay, now this owner cannot, okay, this owner or this senior management cannot, okay, sit before the cashier every time to check whether the cash is properly handled or not, whether the cash has been misutilized or not. For that reason, what the owner can do, what the senior management can do, okay, they can keep a CC camera there, okay, and it will try to prevent the misuse of the, okay, prevent or detect the misuse of the, okay, misuse of the cash, of cash. That is the purpose of the, okay, that is the purpose of, okay, what? Internal controls. That is the purpose of internal. I hope you are all getting the point clear. Okay, for everything, okay, for every transaction, it can be sale, it can be purchase, it can be acquiring the fixed assets, it can be taking the bank loan. For everything, there will be internal controls which will be put in place. Internal controls. Let us have some beautiful discussion, okay, on internal controls also, but soon, okay, we'll try to discuss that soon. Okay, give me 5 minutes time to, okay, conclude whatever we discussed till now. Okay, now we came to know that risk can be assessed at two levels. Either it can be financial statement level or it can be assertion level. If auditor concludes, okay, if auditor concludes the risk, okay, shall be assessed at financial statements level, then it is called as what? Pervasive nature. It is high level of risk of material misstatement. Almost all the areas of financial statements may get affected because of that risk. Okay, because of what reason it may happen? Okay, because of lack of integrity of the management, because they are not honest enough to, okay, prepare the financial statements free from material misstatement. For that reason, what may happen? Okay, the reliability of the books of accounts, the reliability of the financial statements, okay, may be compromised because of the lack of integrity of the management, lack of knowledge of the management. Then what may happen? There may be existence of fraud and the reliability will be decreased. Reliability factor will be decreased. In that instance, the, okay, risk shall be assessed at financial statements level. I guess you are all getting the point clear. Okay, done. Many a times I fail to start recording. Okay, all whatever I discussed till now, it will be gone wasted. Okay, that is the reason why I go in the middle, I check whether I am recording or not. Okay, sometimes it happens. Many a times it happened, in fact. Okay, all the time got wasted. Okay, I'll be in a hurry to, okay, teach, forgetting to press the recording button. Okay, it happens sometimes. So point number 2, what is this? Reliability will be decreased. When these happen, obviously the auditor will assess the risk of material misstatement at high level called as financial statement level. Then if the auditor has such doubts, he needs to respond right after the risk is been assessed. Okay, now he needs to respond whether actually the material misstatement is there or not. So having risk is something different from actual misstatement. Okay, this risk is what? Okay, there may be a misstatement, there may not be a misstatement. Now how can you get the, okay, get the conclusion of whether the misstatement is there or not? Just by checking the transactions. Once the risk is assessed at high level, then auditor needs to respond overall. He must try to keep the, okay, qualitative resources. He must try to give more time for the resources to complete the audit. Who are the resources? Okay, it is the human resource who actually conduct the audit. Okay, qualitative resource he needs to have. Okay, he must have some good time to complete the audit, because to get the right conclusion, because it is high risky. high risky. Overall response, okay, shall form part of what? These are the points which shall form part of overall response. Okay, he must take care of the audits, okay, audit, okay, so well. This is called as overall response, keeping more experienced persons, more knowledgeable persons, so that they can do the audit well. This is the response what he will give, okay, only when the risk of material misstatement is assessed at financial statement level. I hope you are all getting the point clear. Okay, now for that reason, okay, if the risk is assessed at assertion level, okay, he assessed the risk at only sum of the class of transaction, either it can be sales or purchases, or if he assess the risk at account balances, or he may assess the risk at disclosure levels. Okay, now how can he respond? He will respond in case ROMM is assessed at assertion level. Okay, his response will be called as further audit procedures. Okay, further audit procedures, which is discussed in standard number 330. Even the first response, overall response, okay, see, okay, for this level, what the auditor will try to do? Okay, he'll try to respond overall response. It is called as what? Overall response. Okay, here we'll call it as further audit procedures. Okay, both are covered under standard number 330. Okay, both are covered under standard number 330. Basically, the name of the standard number 330 itself says responses to assessed risks. Where we identified the risk, we assessed the risk in 315. Now we are responding as per 330. Okay, now what is the response we'll give in case the ROMM is assessed at, okay, assertion level. It is called as what? It is called as further audit procedures. Now, further audit procedures are divided into two types. Test of controls. Coming to point number 2, substantive audit procedures. Point number 1 is called as what? Test of controls. Everything I am writing in detail because it is so important for examination point of view. Okay, done. So test of controls, these are the two ways. Now auditor can respond, okay, by checking the controls or by checking, okay, what is called as substantive audit procedures. It is nothing but checking the documents. It is again divided into test of details, and okay, and also called as, there is another point which is there called as substantive analytical procedures. This is how he needs to respond in case if he assesses the risk at, okay, okay, assertion level. He may verify the controls or he may verify the substantive audit procedures. He may apply the substantive audit procedures. Okay, now he can use the combination of both. Okay, now what he can do? He can apply TOC, he can apply SAP, or also he can use what? TOC and SAP. Okay, let us now have some beautiful discussion on this test of controls. Okay, I guess you're all getting the point clear. So test of controls is nothing but checking the controls. Substantive audit procedures, generally we talk about test of details. Okay, it is nothing but taking the document, verifying everything. Say imagine if you want to verify the sale, how will we verify sale? Okay, we'll take the sale invoice, we'll check all the details from the sale invoice. This is what it is called as inspection of the sale invoice. Okay, it is called as what? Substantive audit procedure, test of details. Okay, that is nothing but checking the documents, inspecting the documents is called as what? Test of details. Okay, now we need to have a detailed understanding of TOC. For that reason, okay, first of all we need to have a clear picture of internal control, and then we need to go to okay, test of controls. Let us go to material ones. Okay, without showing material, it is not that appropriate to discuss. Okay, if you want to get the clarity, if you want to get the confidence on the subject, this area needs to see all this is discussed. See 315. What is 315? See, identifying and assessing the risk of material misstatement at finance statement level or at assertion level through understanding what entity and its environment and its related internal controls also. This is what I discussed, okay, till now. And thereby after you assess, you can actually design the response for the assessed risks. If it is okay, assessed at financial statement level, overall response. If it is assessed at assertion level, then further audit procedures. All this will be this is there in, okay, standard number 330. Okay, till here it is standard number 315. Responses are there in standard number 330. Okay, now see, assessment of risk of material misstatement at what? Financial statement level. This may happen because of what? Okay, concerns of the integrity in the entity's management and reliability compromise is there. Okay, so auditor is not, okay, willing to depend upon the books of accounts. He cannot use that books of accounts as the, okay, sufficient and appropriate audit evidence for the purpose of forming an opinion. He has the concerns relating to reliability. Then he can assess the risk of material misstatement at high level called as financial statement level. And second point we all know, that is assertion level. Okay, now what are the assertions? Assertion is nothing but, here you can write what? Assertion is the representation made by the management, okay, so which is embodied in the financial statement itself. There is no need to separately say that. That is called as assertion. Okay, now what are the assertions for class of transactions? Okay, now once you find out any, okay, balance in the P&L account, any balance, either it can be income or expense, when you find out the balance, okay, so what it says, all the transactions which are there in the P&L account are actually occurred. Okay, this is the first assertion. Management is trying to say to the users of the financial statements that whatever it is there in P&L account, those transactions are happened. If sale is showing 1 crore rupees, there may be many sale transactions. All those transactions have been happened and they are taken into P&L account. Okay, as a summary. Okay, that is called as occurrence. And okay, when I show some balance in sale, okay, all the transactions related to sales are being put in place now in the P&L account. Nothing is ignored, nothing is left, everything is completely taken. This is called completeness, and accurately we have taken. There is no, okay, there is no, okay, there is no leaving of any transaction, okay, and completely it is taken along with accuracy. When it is 100%, okay, when it is 100 rupees transaction, I have taken it as 100 rupees only. I did not take it as 90 or 110. Accurately I have taken. That is third point. And cut-off date. Okay, what is cut-off date? Cut-off is nothing but, okay, it is the date we divide 2 financial years. Generally it is 31st March. Generally it is 31st March. Okay, now the transactions which are happened on 31st March shall be taken in the current year. The transactions which are taken place in, okay, taken place in April 1st shall be taken to next financial year. Okay, if they are shown in the current year, if those transactions which are happened in, okay, on April 1st, if they are taken on 31st March, then profits for the current year may be manipulated. The position of the financials, the position of the company may be changed. Okay, for that reason, cut-off, okay, date is properly considered. Whatever the transactions happened in the current year, it have been taken to current year only. Whatever the transactions, okay, happened in the next year, those transactions have been taken to the next year only. This is called as what? Cut-off date. And last one, classification. Properly classified. Capital expenditures are taken in balance sheet. Revenue expenditures are taken in P&L account. Properly classified. There is no, okay, mistake from our side when we classify. This is what the management is trying to say to the users of the financial statements. Now as an auditor, what do you need to do? Okay, you need to check whether these are properly there or not, whether these assertions are valid or not, whether whatever it is said by the management is valid or not. Okay, in the similar way, for account balances, existence, rights and obligations, completeness, all the assets are taken into balance sheet. Okay, and valuation and allocation, everything is now discussed. Okay, now presentation and disclosures note to accounts. Okay, all the transactions which are disclosed in the balance sheet, disclosed in the notes to accounts have been occurred, rights and obligations in the name of the company, completeness, classification and accuracy and valuation. Okay, this is actually the combination of both 1 and 2, both COT and okay account balances. Okay, I hope you're all getting the point clear. Okay, now so as per 315 you need to actually assess the risk. Okay, what is the procedure for the same? Okay, first of all you need to identify the risk. First step is identification of risk. How to identify the risk? Just by understanding the entity and its internal controls and its environment. So after you identify the risk, you need to assess the risk, okay, whether it is high or low. Okay, see, assess the risk, okay, and evaluate whether it relates pervasively or not to the financial statements as a whole. Is it to be assessed at, okay, you need to evaluate the risk, whether is it high level or at low level. Okay, that is second point. Assess, okay, and evaluate whether it is more pervasive or not to the financial statements as a whole. Okay, and also you need to relate such risks which may be assessed at assertion level. Okay, now you need to try to evaluate whether those risks give rise to financial statement level or assertion level. This is point number 3. Come to point number D. Okay, come to point number D, that in case if it is assessed at assertion level, are there any multiple misstatements? Are there any multiple risk which may arise to multiple misstatements? Because there are some transactions, there is some risk which may be there in COT, and those risks are those risks may give rise to multiple misstatements. Then this may be assessed at high level. Okay, for that reason consider the likelihood of the misstatement. Okay, how many times it may be possible to happen? See, including possibility of multiple misstatements. Because why we are doing this last point? Because when there is likelihood of happening of misstatements multiple times, then the assessment may be given to financial statements level. For that purpose we need to check the likelihood of the misstatements, how many times it may happen. So point number 1, identify the risk. Okay, and the auditor now he needs to assess the risk, assess the identified risk and evaluate are they pervasive or not, and he needs to relate the identified risk that what can go wrong at assertion level and how many times it may happen. Consider the likelihood of the misstatements, how many times it may happen. See, possibility of multiple misstatements. Okay, what are the areas where the misstatements may happen? Okay, it is not only the sales. In the COT, sales, purchases, salaries, repairs and maintenance, everything got a misstatement. Okay, the risk is now related to every aspect of the COT, every aspect of COT. Then you tell me, are we required to assess the risk at high level or not? Yes, for that reason that fourth point is relevant. Okay, now and we know that risk assessment process, quickly you can go now. Okay, risk assessment procedures, how can we assess? Just by understanding the entity and its environment, including internal controls. Okay, and you can assess financial statement level at assertion level. What are the components? Inquiries you can make with management and others within the entity. So you can read all these points, simple only. I have already discussed. In fact, you can talk to whom? Management, legal counsel, internal auditors, everyone. With everyone you can just talk, to get the information of the entity. And then analytical processes you can use. You can compare the entity's figures with previous years or industry's figures. That is what I discussed. And next one, observation and inspection of various documents. Observation of the business operations, what the employees are doing. Okay, and inspection of the documents called as business strategies and policies, etc. Okay, and one more thing, how to get an understanding of the entity. Previously when I was in chapter number 2, once I left one point and I told you that time that I am going to cover this topic in chapter number 4, and that is now given here. Okay, what is the understanding you need to get about the entity or entity's business? Okay, what is the understanding? What do you need to know about the entity before you start assessing the risk or identifying the risk? Okay, now point number A. It is in which industry the entity is running, what are the regulatory requirements, what are the other external factors, including applicable financial reporting framework, which framework is applicable for the entity. This is what you need to understand first of all. And then nature of the entity, what comes under nature? The operations of the entity, are they in sales, are they in providing services, are they doing something else? That is what we need to understand. And then come to ownership and governance structures, who is actually owning the organization, what are the types of investments they are making in their balance sheet. You can just come to know. Then how it is structured and how it is financed. Okay, is it debt oriented company or is it equity oriented company or combination of both? Okay, and how the management is selecting the appropriate accounting policies. Okay, and if there are any changes for the organization's accounting policies, what are the reasons for the same? This is what we need to understand. Okay, and we need to get the knowledge of objectives and strategies of the organization. Okay, what are the business risks that may happen? Okay, now what is business risk? The risk itself suggests that whatever we planned for, if it is not achieving, that is called as risk. You planned for preparing 16 hours a day, but cell phone is the risk for you. You are only preparing what? For 4 hours. That is called, whatever you planned, if it is not achievable, that is called as risk. And whatever you plan for business, if it is not happening, profit making is not happening, then it is called as business risk. Why it is not happening? That is called as business risk, and that the auditor needs to assess what kind of business risk may be there for an organization, for the client. And he needs to measure and review the entity's financial performance also for last 1 or 2 years. This is how he needs to get the understanding of the entity. So very, very important question for CA Inter. For CA Final it may not be relevant, but CA Inter, this is an important question. So all the 5 points we need to write. Easy only. Relevant industry, its nature, selection of the accounting policies, which accounting policy they are following in method of while valuing the inventory, which method they are following, are there any changes for the same, etc. We need to understand. In these objectives and strategies, and measurement and review of the entity's financial performance. This is an important question. And there are some areas where the auditor needs special consideration. There are some areas. So whenever he is identifying the risks, on some risks he needs to focus more. Special consideration must be given to certain identified risks. That may be the risk of fraud. Because when there is fraud, there are high chances of risk of material misstatement, because it is intentional. When it is because of error, when it is not intentional, then risk of material misstatement may not be high. For that reason, if the risk of material misstatement is because of what existence of fraud, then it must be separately considered. More focus of the auditor must be there. This is point number 1. And then the risk which is relating to recent significant economic, accounting and other developments. Say 4 or 5 years back there was no Indian accounting standards which are applicable. Till that time only accounting standards are applicable. Now all of a sudden Indian accounting standards came into picture, and all the companies for whom these standards are applicable, those managements of those respective companies, they need to have the knowledge of Indian accounting standards. Along with that, in compliance with that Indian accounting standards, they need to prepare the financial statements, unlike earlier. Previously they used to prepare as per accounting standards, but the provisions of AS and Ind AS both are different now. Now first of all, this is the accounting developments what have taken place recently. For that reason, if management is not aware of the provisions of Indian accounting standards, and obviously the financial statements will be prepared not complying the Indian accounting standards, not complying the applicable accounting financial reporting framework, not in compliance of applicable financial reporting framework. This risk of material misstatement, which may be because of significant economic development, significant accounting developments, this risk shall be considered separately. Special audit consideration. Point number 3, when the transactions are complex in nature, then obviously special treatment shall be given by the auditor. And when the risk involves significant transactions with related parties, obviously special consideration, because there may be high chance of misstatements because of the transactions happened with related parties, because related parties, the transactions with related parties, those transactions can be easily manipulated. With those transactions, the profits of the organization can be easily manipulated. If the company is having the intention to reduce the net profits, obviously they can sell the goods at very low cost to the related persons, hence the profit will be reduced, income will be reduced, obviously the profit will also be reduced, to save the income, to save the income tax, in fact, that may happen. So easily the profits will be manipulated in case of transactions with related parties. For that reason, that risk which arises because of transactions of related parties shall be specially considered by the auditor. And there are some areas where degree of subjectivity is involved. Okay, what is degree of subjectivity? Okay, it is, what is subjectivity? Subjectivity is the opposite word of, okay, objectivity. What is objectivity? Having strong facts in the hands. There may be some cases where auditor may not be having that strong facts in the hands, but without having that, he shall conclude something. Say example, provision for doubtful debts. Okay, is it a finalized figure? Okay, there won't be any, okay, proper basis for the same. The degree of subjectivity is more involved. Degree of subjectivity. What is subjectivity? Based on personal experiences, personal knowledge, previous knowledge. Okay, he may come to a conclusion. But exactly he cannot say whether it is right or wrong, but degree of subjectivity is involved in that. When the degree of subjectivity is more, obviously risk of material misstatement will be more, and that risk shall be specially considered by the auditor. And then coming to the last point, whether the risk involves significant unusual transactions. Okay, unusual transactions low, when there is risk, that shall be specially, okay, treated by the auditor, which is an important question. Okay, with this, the first part of standard number 315 is over. Now let us now try to get an understanding of the internal control also. It is the important aspect in today's, okay, it is almost 45 minutes since I have started this discussion. Okay, another 30 minutes will be there on this internal control, 30 to 45 minutes. Okay, I cannot help. Okay, this level of depth we need to discuss, even if it is what, revision lecture, because okay, 10 to 15 marks are, okay, will be there in the examination from these areas. Hence I request you to provide 100% attention, though I am slowing, okay, going little slowly. Okay, little slow. Okay, you can just, okay, keep the video at 1.5 speed, and you can watch in case if you have, okay, proper knowledge on the same. Done. Okay, I hope you are all getting the point clear. Okay, now it is time 11:30 p.m. Okay, you must, okay, you must pay proper attention, because I am taking huge, okay, I am giving huge efforts at this point of time. Okay, because of your examinations coming near. Okay, so since there are only 7 to 8 days before examination, I just want to, okay, give you some 10 to 12 hours content to you, so that you may get more than 50. I guess, okay, with first 6 hours itself, you will be able to pass. With first 6 hours, you will be able to pass. And next 4 to 5 hours, you will be, okay, sometimes you may get exemption also. Okay, sometimes I can say you may get exemption also only after watching 10 to 12 hours. Okay, just to pass 6 hours is sufficient. In fact, not 6, in fact 7 hours is sufficient to pass in the examination. Okay, done. So let us now have a discussion on internal controls. Let me have some water. Okay, as I am working so hard for your examination, it is your duty to work so hard, okay, than me. Okay, pay 100% attention. And believe me, yesterday I told you something. My eyes may look sleepy, my face may look sleepy. Believe me, I am not sleeping. Okay, done. So what are the internal controls? Internal controls, just a minute. Internal controls are the, okay, it is the process. Internal control is the process designed, implemented, maintained. Okay, designed, implemented, maintained by whom? TCWG, management and other personnel. To provide reasonable assurance. Okay, which is implemented by TCWG or management, which will provide reasonable assurance about the entity's objectives with regard to, okay, the entity will be able to achieve following things only when proper internal controls are designed, implemented and maintained. And these are to be implemented by whom? TCWG, management or other personnel of the entity. Okay, what are the objectives of the internal control? Okay, what are the objectives? So once internal controls are properly there, Okay, the financial reporting process will be properly implemented. Accounting will be done properly. Once the accounting is done properly, after considering the internal controls, obviously reliability will be there. Reliability will be there. So internal controls are put in place to prevent, detect, correct the material misstatements. If there are no misstatements happened, obviously financial reporting, the accounting treatment will be proper. When the accounting treatment is proper, obviously reliability will be increased. Okay, that is the logic behind the same. Okay, the purpose of internal controls is prevention, detection, correction. If that happens, obviously financial reporting process will be fair enough. When the financial reporting process is fair, then obviously it is called as what? Reliability. Reliability will be achieved. Okay, reliability is the first word. And the entity's operations will be conducted smoothly, effectively and efficiently. What is effectively? Effectively, it is nothing but having quality. The operations are conducted with quality, with efficiency. The same level of quality you can achieve just within less time. That is called as efficiency. Operations of the entity will be conducted effectively and efficiently. This is the second point. Come to third point called as safeguarding of assets. Safeguarding of assets. Okay, so I already told you cash is an asset. Now with the internal control, if the internal controls are not there regarding the cash, will the cash be misused or not? Yes, sir. So the purpose of the internal control here is to safeguard the asset. Safeguard the asset. This is the objective which will be achieved when there are internal controls. And last one, internal controls will help the organization to comply with various laws and regulations. That is called as compliance of applicable laws and regulations. These are the 4 things that will be achieved by implementing and maintaining the internal controls. What are those 4? Let me highlight. What are those 4? Point number 1, reliability will be achieved. Reliability of the financial reporting. Point number 2, effectiveness and efficiency of the operation. Safeguarding of the asset. Point number 4, compliance of laws and regulations. Okay, so because when the internal controls are there, financial reporting process will be fair enough. Okay, all the transactions will be properly recorded, properly accounted. Once it is there, reliability will be increased. Okay, then this is the objective of the internal control. Again, the same question is repeated here. See, all the transactions are executed in accordance with management general and specific authorization. One beautiful point is the main point what you need to remember in internal control is authorization. Say for example, senior management. There is a trading company. There is a senior manager and there is sales personnel. Okay, now the customer will talk to whom? Sales personnel only. But the senior management people, they are the persons who actually prepare the financial statements. But the person who sells the goods is whom? Sales personnel. Now, as per the policy of the organization, the sales personnel, they need to they can give the discount of 10%. Imagine they can give the discount of 10%. If the product price is 100 rupees, the sales personnel can give 10% discount. If he wants to give more than 10%, some customers may be there, they may ask more than 10% discount. Then immediately straight away the sales personnel cannot give that more than 10% discount. At that point of time, he needs to go to the senior management. He needs to go to the higher authority. In fact, higher authority to get the permission to take authorization, to give the authorization. Now, the sales personnel needs to go to higher authority to get the permission, and then only he can give more than 10%. This is the internal control which is being put in place. If that internal control is not there, then the sales personnel will be selling the good at whatever the price he wants, and he may make some benefit out of that. To avoid those instances, what the internal control says, internal control is now trying to give the authorization to those transactions which need more than 10% discount. I hope you are all getting the point. This is the internal control which has been put in place by the management. That is called as authorization. For every transaction in an organization, authorization is mandatory. When you come to the institute and pay fees, there must be certain person who shall authorize after collecting the money. That receipt shall be authorized by someone. This is called as internal control. When employee comes to the organization, goes into the factory, he needs to sign there. This is the internal control. It shows whether he attends or not, whether he has attended or not the organization on that day. These are all called as internal controls. There may be several internal controls relating to many aspects of the financial statements or other than financial statements also. Okay, even at the factory gate, okay, whenever some vehicle comes in, they need to actually sign there. It is also an internal control. Okay, you shall not allow any vehicle to come in and go out. Okay, just like that they cannot come in, just like that they cannot go out. For that reason, they need to maintain visitors list, visitor vehicles, etc. They will maintain. In an apartment, they will maintain what? Visitors book. That is what internal control is all about. Okay, so these internal controls may be for financial statement items or other than financial statements item. Okay, because okay, having internal controls at factory gate, it may not affect the financial statements. Having internal controls relating to cash, it may affect the financial statements. Okay, for that reason, internal controls may affect what? Financial and other than financial items. But mostly we are related to what? Financial items only. Financial items only. Now I guess you are all getting the point clear. Okay, and authorization is the word which is very, very important for internal controls. Internal controls. Okay, now what did you understand till now? Internal controls may be there for P&L items, may be there for balance sheet items. It can be there for fixed assets. It can be there for current assets, inventories, purchase of inventory, sale of inventory. Okay, storage of the inventory. For everything, internal controls are there. To store the inventory, store in charge shall sign. He must give the authorization for the same to take out the inventory from the stores department, to bring the inventory to the stores department. Is this called as internal control or not? Yes, sir. Okay, so there may be hundreds of internal controls which may be there for the organization. Now as an auditor, first of all, before going to that concept, let me complete this one first of all. Okay, then we'll go and have a beautiful discussion on that also. Okay, what an auditor has to do relating to this internal controls. Okay, now let us go to point number 2. It is so simple. I just need to highlight few things. Okay, all the transactions, when the internal controls are properly there, properly authorized, okay, all the transactions will be promptly recorded. Correct amount will be there. Obviously, reliability will be increased, and all the transactions will be complying with the statutory requirements also. Okay, because the internal controls are designed in such a way that the transactions which are to be taken into financial statements, okay, shall be taken only after compliance with the laws. The internal controls will be there in such a way. Okay, for that reason we can highlight what? When the internal controls are there, statutory requirements are automatically complied, because those are designed in such a way. Okay, done. Next point. See. Okay, next point. Assets are safeguarded. Easy. When assets are safeguarded, they can be prevented from what? Unauthorized access or use or disposition. Okay. No one can come to the organization without having that authority to sell the assets. Okay. So that is third point. And last point, the recorded assets are compared with the existing assets at reasonable intervals. Okay. The assets which are there in the books of accounts shall be there physically also. That is what it is called as the difference between existing assets and recorded assets. Okay, in a reasonable intervals you need to go and check. Okay, done. What is the purpose? Purpose we know. This question is already over. Okay, reliability, effectiveness, safeguarding of assets. It is already over. Okay, now you tell me. Internal controls are implemented by the organization. Okay, internal controls are implemented by the organization. Okay, for the purpose of achieving something. Will there be risk? Will there be any limitations on the internal controls? The answer may be yes. Because however, how well the internal controls may be implemented, always there will be a chance to override the internal controls. Say for example, here I have all the rooms in this organization, all the rooms in this institute, okay, are properly monitored through CC cameras. This is the internal control which we put in place here. Okay, but can it be overridden? Yes, sir. Okay, yes, you can override this internal control just by keeping the switch off. When the switch is not on, then obviously the purpose of this CC camera will be lost. Okay, then the person or the senior management under whose authority the CC cameras are there, if they fail to operate well, if they fail to control the CC cameras, then obviously the prime purpose of the CC cameras will go wasted. Okay, for that reason there will be always limitations of internal controls. Okay, so first of all, what is happening? Owner may be different. See, in an organization, in a company form of business, owner may be different. Shareholder is the owner. Okay, board of directors are different. Senior management is different. Okay, lower level management who is actually doing the work is different. Okay, now owners will give the responsibility to board of directors. Board of directors will give some responsibility to senior management. Senior management will give the responsibility to lower level management. Now this lower level management, if they want to provide more than 10% discount, they need to go to senior management to take the permission. Okay, now senior management is the responsible person to give the permission. Now what if these two persons, okay, there is a collusion between these two persons, they agreed mutually, okay, they are sharing the benefit, which will give the loss to the organization. Obviously owners will be at loss. This may happen. This is the limitation of internal controls. Let us highlight some limitations of internal controls. Though the internal controls may be there, but sometimes they may fail to achieve the objectives. What may be the limitations? Point number 1. Okay, some internal controls may not be cost effective. Because in our organization there are 22 employees. Now teaching and non-teaching, 22 employees. Now you tell me one thing, for them, is it sufficient to keep the attendance register manually, or is it required to keep the biometric system which will work with either thumb impression or eye retina? Which one is sufficient? I guess attendance register which is manual in nature is sufficient. Imagine a case where there are 2000 employees in an organization. This manual system of maintaining attendance register will not serve the purpose. For that reason, they need to have what? They need to have biometric system. Now, for Vagdevi, where I am working now, where I am recording now, for this organization, this biometric system, is it cost effective? Though it may give proper results than manual attendance registers, but still it is not cost effective. Hence, it is better to maintain in the attendance register only. This may be the limitation. Point number 2. Point number 2. Internal controls will be designed for those transactions which will happen usually, for sale, purchases, etc. There may be sometimes unusual transactions that may take place. For them, internal controls may not be designed, may not be properly implemented. That is the second point. See, for usual transactions, internal controls are designed and implemented. For unusual transactions, the management itself is not knowing that type of transactions that may happen. For that reason, they fail to implement the internal control properly. Point number 3, because of the time constraint, I'm not giving detailed examples for every point. In the regular lectures, for each and every point, one example will be given. 1 or 2 examples will be given. Now, because of lack of time, we are going little slowly. Lack of examples, it is sufficient for your examination. That is what I am giving. Potential for human errors. Sometimes humans may human error may happen, so that the purpose of the internal control may not be achieved. And the person who is responsible to implement the internal control, he may abuse the authority, he may misutilize his authority. And there may be collusion with the parties outside the entities or employees with the organization, within the organization. Sometimes because of the changed environment of the organization, the internal controls may not be changed. Say for example, previously an organization was having only 100 employees. Then they used to have what? Attendance register in physical mode. Now the employees of the organization came to 1000. So is the environment changed? Yes, but the organization failed to implement that. okay, that internal controls to biometric system, they are still following what? Okay, they are still following what? Okay, manual system of taking attendance only. So not updating the internal control as per the changed environment, that may be the limitation. Point number F. This is sufficient. You can read the last point. Easy only. Okay, done. Okay, this question is given as homework. Simple question only. I don't want to waste such time on that. All the points were already discussed previously somewhere. Okay, materiality, risk, size of the entity, etc. You can just read. Okay. This is also simple. This is also given as homework only. Next, what are the components of the internal controls? Okay, let us now talk about this internal control. This question itself may take 1.5 hour time in our regular class. Okay, however, because of lack of time, we are going to complete this. Okay, the overview of this topic, it may come in the examination. Overview of the topic I can discuss, because in detail discussion I cannot make here, because it takes 1.5 hour itself. One class completely for this one question. It took me in the last session. Okay, last batch. Okay, for that reason, what are the components of internal controls? Internal control is actually implemented by whom? Implemented by management. It is implemented by management. Now, okay, what are the components of this internal controls? Management needs to create the control environment in the organization. Control environment must be there. What is called as control environment? Okay, management should always try to okay, bring the attitude, awareness and actions of those charged with governance, okay, in relation to entity's internal controls and importance of controls to the entity. So they need to bring the attitude, they need to bring the environment, okay, by having various discussions with employees, meetings with employees, create an honest culture in the organization. Okay, so that is called as controlled environment. Okay, this is the first point you need to understand. This is the first point you need to understand. Controlled environment must be always there. Coming to second point. Now, risk assessment process must be done by management themselves first of all. Because I already told you, inherent risk will be always there, right? Inherent risk. To reduce the impact of the inherent risk, they'll keep the controls. Now, before they keep the controls in place, first of all they need to assess the risk. So risk assessment process shall start from the side of the management first of all, and after doing that they need to implement proper controls to reduce the impact of the risk. Okay, that is the second point. How well the entity is assessing the risk, how well the process of risk assessment is there for the entity. This is the second point. Okay, entities risk assessment process. This is what? Entities risk assessment process. First point is control environment, second point is entities risk assessment process, and third point it is related to information systems. Okay, because internal controls may be there in financial items, non-financial items, but mostly auditor is concerned to internal controls which are related to financial items. And now we know all the financial transactions, recording of the journal entries, passing journal entries, recording in the ledger posting, trial balance, balance sheet, P&L account, everything will happen through the software, through the information systems only. This information system is nothing but what? A software. It is a system. Now the auditor needs to consider the system of accounting in relation to information systems, in relation to financial reporting, process, how well the systems are controlled. Okay, so there are general IT controls, IT controls, because through tally we prepare the financial statements, and for that tally we need to keep the password that is called as general IT control. So that password will prevent someone to come inside the organization to access tally to pass unauthorized entries. Okay, now this is also shall form part of what? Okay, shall form part of what? Internal control environment only. Okay, this is one of the components of internal control. And coming to last point, okay, last 2 points, control activities, okay, must be there relevant to the auditors. See, control activities are the policies and procedures that help to ensure that management directives are carried out, okay, pertinent to the following. See, now as an auditor, okay, you are now checking what? Whether the management is properly implementing the controls or not. And the management responsibility is to monitor the same, because they are the persons who, okay, designed the controls, implemented the controls. They are the persons who need to monitor the controls also. Okay, that shall also form part of, okay, components of internal controls. Now these are the 5 points. What are those? Control environment. Point number 2, entities risk assessment process. Point number 3, okay, point number 3, information systems, okay, controls related to financial reporting process. And point number 4, control activities, actual control activities. This is what actually we do, control activities. Point number 4, monitoring of controls, in detail you need to read. Okay, it is your work done. These are the 5 points. The same question is there in EIS also, same question, EIS also it is there. Okay, in fact CRCIM, we call it as CRCIM or CRICM also, CRISM. Okay, with this basic information of internal controls, I hope you understood everything. Okay, now let us jump to standard number, okay, 330 again. Okay, standard number 330. Let us write. Audit procedures are 2 types, RAP, FAP. In FAP there are 2 aspects, test of controls. We are almost at the end of the discussion. Okay, almost it is, okay, 1 hour 15 to 20 minutes. 1 hour 15 into yes. So TOC, TOD. Now TOD kaadu, it is what? SAP. SAP is again divided into TOD, but generally we call it as TOD only. Okay, another thing is another SAP, substantive analytical procedures. Now you tell me one thing. First of all, we did what? 315. We applied what? 315, and we assessed the risk at financial statements level and assertion level. So financial statements level, overall response. Assertion level, go to FAP. What is FAP? This is FAP. Okay, this is also covered under 330. Overall response is also covered under 330. Okay, now to give this assessment, auditor needs to get the understanding of the entity and its environment, including its internal controls. So what is internal control? You already know. The purpose, the objectives of the internal controls, you already know. Okay, so those internal controls, first of all, auditor needs to get an understanding, preliminary assessment of the internal controls. Okay, based on that we will give the risk assessment. Now you tell me one thing. Okay, after getting the preliminary knowledge of, okay, of operating effectiveness of the internal controls, okay, he'll conclude one thing. Okay, are the internal controls operating effectively or not? The answer may be yes or no. Keep this here. Let us go to next point called as FAP. As a part of FAP, auditor can use what? TOC, okay, or SAP, or combination of both. He may test the controls, he may test the, okay, details, or combination of both, test of controls and test of details. That is what he can do. Now you tell me, okay, which one should be applied first? This is the important question you need to answer. Okay, now my answer for this is, generally auditor will start with TOC. Let us try to have one beautiful example for that, and we'll try to understand the concept in detail. Done. So there is a policy of the organization. I already told you that. Okay, the sales personnel needs to go to get the authorization from senior management if he is going to sell the product at more than 10% discount. More than 10% discount. Okay, what is this? More than 10% discount. Okay, senior that sales personnel shall go and get the authorization from senior management. Okay, this is called as internal control. This authorization is called as internal. Authorization is called as internal control. Internal control. Now, as a part of risk assessment process, auditor applied analytical procedures, and auditor came to know that previously the sales for the organization is just comparing the current year figures with previous year figures. Okay, the net profit came down. The reasons for net profit, the reasons for decrease in the net profit is, okay, previously the sales was 1 crore rupees. Now the sale was only 60 lakhs. In the current year, the sale was only 60 lakhs. For that reason, they got net loss. Okay. Now the auditor is trying to get the reasons for the same, why the sales are reduced. Okay. He identified one risk that after observing, whatever the sales are happening, those sales are happened for, okay, more than the discount which has to be given as per the policy. It has to be only 10%, but the sale personnel is giving more discount. For that reason, sales came down to 60 lakhs. Okay. Now as an auditor, you got this doubt. You used what? As a part of RAP, you used analytical procedures. You compared, okay, and you observed, okay, in what way the sale transactions are being taken place. You observed, okay, you inquired with some persons, and you got a conclusion that there may be a risk of material misstatement in the area called as sales. Okay, because, okay, sales personnel is selling the good which is more than 10% discount. This is what you concluded. Now you came to know that there may be a risk in sales. This is what you concluded. Now there are 1,000 transactions of sales. Okay. Now you tell me, will you verify all 1,000 transactions, or there are only 100 transactions? There are only 100 transactions. Which are provided, which are sold at discount. And if you check those discounted transactions, whether they are properly authorized or not, if you check those controls, okay, then you don't need to verify all remaining, okay, all 1,000 transactions. If these controls are operated well, if the authorizations are properly taken, then the auditor is only required to verify, okay, few transactions out of 1,000 rather than verifying everything. You are now given with two options: verify 300 transactions of sales, verify 700 transactions of sales. These are the two options given to you. Now you verified what? Controls. If the controls are properly implemented, you checked all the 100 transactions which are happened at discount. And you came to a conclusion that you tested the control. You checked whether the authorization is properly given or not. You came to a conclusion here that all the discounted transactions are properly authorized. Yes, control is operating well. And after testing this, you came to a conclusion that controls are operated well. Now under these two options, which one will you select? When the controls are operated well, obviously substantive audit procedures, test of details, you may not do more. For that reason, you may select option number 1, because the controls are operated well. So how can you decide whether to verify 300 or 700? Okay, only after testing the controls. So it keeps the further audit procedures by way of test of details less. It keeps the auditor work less. In a smart way, he can do the audit. Okay, because of that reason, first of all, test the controls. If the controls are operated well, reduce the further audit procedures. Reduce the test of details. You don't need to verify all the sale invoices of 100 transactions. You just need to verify only 300, because the controls are already operated well. The risk will be now reduced. Okay, initially you assess the risk as high, but after testing the controls, the risk came down. And you are now you are now required to verify only 300 transactions in such circumstance. Now if you tell me if the answer is no here, obviously still the risk is high. Okay, after testing you came to know that discounts are not properly authorized. Okay, in that reason you may verify more number of transactions to know the magnitude, to know the level of misstatement, to what extent the sales are misstated. That is what you need to understand. For that reason you need to verify more number of transactions, with this example. Okay, you can understand the relevance of this topic. Okay, now you tell me. So in this chart, as a part of FAP, first you will do what? You will verify test of controls, and then you will go to what? SAP. So the results of TOC will affect the amount of SAP what the auditor does. Okay, whether to verify more or less, it depends on what? Results of TOC. Okay, now another beautiful question. When someone will use TOC, first of all, this is the MCQ question, when the TOC will be used in the progress of audit? This is the important question. Okay, when point number 1, if you want to go to TOC, first of all, preliminary assessment of internal controls we have done in standard number 315, and here you came to know whether they are operated well or not. Preliminary assessment only, you did not check. Okay, you observed and you got some CC cameras, you did not check it, but you got to know that there are some CC cameras which are there. Now as a part of TOC you need to check whether those CC cameras are working or not. This is the difference between preliminary assessment and what? Okay, test of controls. This may be the difference. Just to make you understand the point, I am taking this example. Okay, so preliminary assessment you got to know that yes, controls are there. Now as a part of TOC you need to check whether the controls are properly operated or not. So you will come to TOC, only the answer for preliminary assessment is yes. If the preliminary assessment is no, okay, if the preliminary results of preliminary assessment is no, then there is no point of testing the control at all. Okay, initially you tell me one thing. Okay, if you know that if you take coaching from CA Ravikiran Balla, if you fail, you know very well that you will fail when you take coaching from Ravikiran Balla. Initial preliminary assessment you made on these classes and you got to know that you will fail. Okay, then will you come and join with me to test whether you fail or not? No one will do that. So first of all, to come to TOC, first requirement is what? Okay, preliminary assessment of the controls must be yes. Preliminary assessment must give positive results. If it is yes, come to TOC. If it is no, don't come to TOC, directly jump to SAP. There is no point of testing controls at all. I guess you're all getting the point clear. This is the first reason why we test the controls. Okay, so test of controls, point number 1, when positive results in preliminary assessment, come to point number 2. There may be some cases where, okay, the auditor cannot 100% depend upon, it is not possible for the auditor to, okay, to do SAP. Say take one example of test of details they cannot do. Take some examples of banks. Take the example of online okay, organizations like Flipkart, okay, Amazon. There are huge transactions, high number of sale invoices, high number of transactions happen every day. For those companies, can you go and verify all the test of details, getting all the invoices? No, it is not possible. For them, it is better to depend more on TOC than SAP, than what? Test of details. Okay, that is the second reason. Okay, now second point, SAP alone. See, when will we test the controls? When SAP alone, okay, is not suitable for the purpose of audit. Okay, with this, okay, detailed discussion of internal control is over, and let us now quickly complete the rest of the topics here. So I just want to go to chapter number 3 to look into the material. Okay, and now I will be giving some questions as homework also, because you shall also read the same. Just by listening to the classes may not help you. Okay, if you listen to the class for 2 hours, spend another 1.5 hours immediately to get the knowledge. Sure shot you will pass. That is the level of depth I am teaching in this revision lecture. I guess you all, I hope you all like it. Okay, done. Yes. And we know that test of controls, substantive procedures, and when the test of controls will be there, when he expects in the preliminary assessment that controls are operating effectively. So this is the results of preliminary assessment. Okay, and then substantive procedures cannot provide sufficient appropriate audit evidence at assertion level. Okay, what is that? Banking companies example, insurance companies example you can take, and also online companies, online business companies you can take an example, because their substantive processes are not sufficient. Okay, they cannot provide the auditor with sufficient appropriate audit evidence. He cannot verify all the transactions. For that reason, TOC is benefit. TOC gives the benefit for them. Okay, now some serious discussion we need to do for 4 or 5 questions. Okay, let us complete quickly. Nature and extent of the test of controls. Okay, so now the auditor is trying to test the controls. To what extent he needs to do the control testing? Is he required to do more? Okay, is he required to test the controls more or not? It depends on what? See, in designing and performing the test of controls, the auditor shall perform other audit processes in combination with inquiry about operating effectiveness of the controls. Okay, he needs to inquire with someone. Regarding the operating effectiveness. And what is to be inquired? Okay, he needs to inquire how the controls were applied at relevant times. Okay, how the controls are applied, the consistency with which they are applied, and by whom and what means they were applied. Okay, this is the information we need to get, okay, to decide to test the controls more or not. Who applied, how they were applied, okay, the consistency with which they were applied. Now you tell me one thing, if the controls are not consistently applied, obviously the purpose will not be achieved. When there is no purpose achieved, the risk will be more. When the risk is more, obviously the work will be more for the auditor. Okay, that is the reason why you just need to inquire for the same to decide, okay, to know about the operating effectiveness of the controls. It includes what? How the controls are applied, and whether the controls are applied at relevant times or not, consistency with which they were applied, by whom and at what means they were applied, and the level of control testing, the level of test of controls, okay, depends upon okay, the operating effectiveness. Best example I will give: operating effectiveness of indirect controls. Let us continue with the example what I have given earlier. Okay, previously I told you what, if more than 10% discount if the sales personnel wants to give. Okay, now he needs to go and take the permission of the senior management. This is what the control is. Okay, that authorization is called as control. Authorization is the control here. Okay, now you just want to check this authorization. You just want to get those number of transactions which are happened at more than 10% discount. Okay, now in there you are checking what? Authorization. Now the effectiveness of this control, you can come to a conclusion that whether this control is operated effectively or not only when, because all these sales are happened through system itself. In the computer will do. When you tell me one thing, if the controls of this system is not properly designed, okay, this computer is not properly safeguarded, then obviously the internal control surrounding this system is not operated well. So unauthorized access can be given to the system. If this happens, they may manipulate the registers which are generated from this system. Okay, when the registers are manipulated, it may show all the transactions are authorized even though in fact they are not taken. Okay, now this control called as authorization, auditor can conclude whether this control is operated effectively or not only when the controls which are surrounding this system are operated well. The design of the of another control, okay, will say the operating effectiveness of another control. Okay, how well the indirect controls are operated, okay, on that the actual, okay, the actual internal controls will operate. Okay, the operating effectiveness of actual internal controls will depend upon, okay, what, the operating effectiveness indirect controls, operating effectiveness of indirect controls. This is the second point. Okay, read this point. Determine whether controls to be tested depend upon other controls. If so, whether is it necessary to, what is indirect control? That is the example I have given. Whether it is necessary to obtain audit evidence supporting the effective operation of those, okay, indirect controls. Now as an auditor, you need to get the audit evidence for indirect controls also. He needs to test, okay, actual control, indirect control. This is the second point. Okay, now matters to be considered in designing the extent of test of controls. Okay, extent of, to what extent we need to test the controls. Is it to be more or less? It depends on few factors. Okay, see, the frequency of the performance, the frequency of the performance of the controls by the entity during the period. The controls are applied frequently. When the controls are applied frequently, then the auditor may have to verify more controls, because the controls are applied more times. The auditor may need to verify the controls more. It depends upon the frequency of the performance of the control. Point number 2, the length of the time during the audit period that the auditor is relying on the operating effectiveness of the control. Okay, now the auditor tested the CC cameras. He have, okay, tested the control. Okay, now once if he tests every day, is he required to test the control? Every day is he required to, okay, check the CC cameras? No. Okay, because he is not required to test each and every day. Okay, once he tested the internal control, he may have some time to, okay, that is called threshold time. Okay, that is the period which he may not, okay, which he may not test the control again. Say example, if he verify the control now, okay, he may verify the control again only after 2 or 3 months. If the length of the time is more, obviously the extent of testing will be less. Extent of testing will be less. Extent of test of controls will be less. Or if the length of time is less in a financial year, for every, okay, 15 days if he is verifying, then it is called as more test of controls. If he is depending upon testing of controls for 3 months, okay, once, if he is verifying the test of controls for 3 months once, then in a financial year only 4 times he is verifying. Okay, this depends upon the extent of testing, depends upon what, length of the time. Okay, if his expected rate of deviation from the control, he designed the control, but the control is not actually operated as per the, okay, design, as per the design, and the auditor is expecting that. If his expectation is more in relation to deviation of the control, then obviously what will happen? Okay, then obviously test of controls will be more. See, extent of controls will be more. The rate of deviation, when the rate of deviation is more, risk of material misstatement will be more. ROMM will be more. When ROMM is more, the test of controls will be more. Okay. See, the auditor, next point, the auditor is mainly, he needs, okay, reliable and relevant audit evidence. He has to get the relevant and reliable audit evidence. That is what his purpose is. If that is the case, he needs to verify more controls. Okay, if he needs more persuasive audit evidence, best audit evidence he needs to get. For that reason, more controls he needs to test. Okay, this is the fourth point. And coming to fifth point, the extent to which the audit evidence is obtained from the test of other controls. Okay, this is the indirect controls point only. You can just read it. What is the timing of test of controls in a financial year? When the auditor needs to test the control? Is it at the beginning? Is it at the end of the audit? Is it at the middle of the audit? Okay, the answer is the auditor shall test the controls for a particular time or throughout the period for which the auditor intends to rely on this controls. At any point of time, he can test the control. Okay, now another important point, in a financial year starting from April to March. So in the middle, in the month of June, okay, he tested a control. He applied the test of controls and he got a conclusion. Okay, now will he depend upon the results of this test of control which is made in the month of June? Will he depend upon to the next 9 months during that year. Is that yes or no? Okay, answer is, see, when the auditor obtains the audit evidence about the operating effectiveness of the control during the interim period, the auditor shall obtain the audit evidence regarding significant changes to those controls subsequent to the interim period. See, in a timeline, this is April, March. In the month of June, you tested some controls. Okay, now as an auditor, you need to evaluate, you need to determine, is there any change in the internal control, significant change in the internal control in this period? Which period? After June, before March, in this period. If there are significant changes in the internal controls taken place in this period, obviously the auditor need to test the new controls which were implemented in this period. That is point number 1. Come to point number 2. Determine additional audit evidence to be obtained for remaining period. He needs to determine, is there any requirement to get the additional audit evidence for the remaining period. That is the second point. And one more important point is, once if in a financial year the controls are tested, next year also is he required to verify? He is the auditor for the same company again. Now once the controls are tested, again for the next year is he required to verify? The answer will be yes. See, the auditor shall verify the control, test the controls every year, even in the next year also, when there have been changes. When is he required to verify the control again in the next year? Only when there have been changes in the current period, changes in the internal controls in the current period. If there is no such change, if there is no such change happened, then control may be tested once in 3 years, for every third audit. If one control is tested now, in the next year he don't need to test, in the next year he don't need to test, in the third year he needs to test. Say for example, important point, controls related to fixed assets are tested in 2021. 2021 financial year tested. In the next year he don't need to test, and in the next year he needs to test. 22, 23 and 24 he needs to test in relation to controls which are related to what? Fixed assets. Other areas he needs to verify. So once the control is tested, he can test. If there are no significant changes, he can test once in every third audit. However, the auditor shall take care of every year he must cover different types of controls. If this year he focuses on fixed assets, maybe in the next year he may focus on what? Current assets. He may focus on what? Liabilities. He may focus on sales. He may focus on purchases. So he must take care that every year he must cover some controls. He shall not always cover all the controls in a single financial year. That is what he needs to take care of. This is this point. Coming to the next point. Consideration in determining appropriateness of using audit evidence about operating effectiveness of controls obtained in the previous audit. In the previous audit you got some evidence regarding the operating effectiveness of the controls. Now can you use that evidence in the current year? It depends on what factors. See, it depends on what factors. In the current year, the control environment got changed. The components of control environment I have told you. CRISM, control environment, risk assessment process, and information systems, control activities, monitoring of controls. Now you tell me, if these components got changed, then obviously previous year evidence may not be used in the current year. See, it depends on what? The effectiveness of control environment, the effectiveness entities, monitoring of controls, entities, risk assessment process. If everything is good, then go and use the evidence what you got in the previous year. If they got changed, don't use. So the factor is what? The effectiveness of this. Okay, done. So there may be the another factor may be what? General IT controls. General IT control. If the general IT controls are not well for an organization, okay, then you don't need to depend. You shall not depend upon previous year's audit evidence. Okay, do it separately in the current year. Okay, the risk arising out of characteristics of the control. There may be sometimes controls which are manual in nature, controls which are automatic, controls which are automatic. Okay, which one is more reliable? Generally, system oriented controls are more reliable. Okay, biometric system is more reliable than manual attendance registers. Okay, now it depends upon if you get the audit evidence in the previous year, okay, in relation to manual system, then the reliability will be less. In the current year, if there is biometric system, okay, do the test of control again in the current year. This is the second point. Okay, I guess we're all getting the point. The effectiveness of the control and application by the entity, nature of the deviation, and personnel changes. Okay, previously the person who implemented the person who implemented the internal control, they got now changed. The new personnel came into picture. How well he is performing the internal control, you don't know. As an auditor, you don't know that. For that reason, you need to test the control again in the current year. Okay, the previous year controls are not properly updated to the changed circumstances in the current year. Now test the control again in the current year. Okay, the risk of material misstatement is high. Okay, then again test the control in the current year. These are the factors which are relevant. What are the factors which necessitate the retesting of controls? Previously you tested, again you just want to test that. Okay, what may be the reason for the same? It may be because of what? Deficient control environment, deficient monitoring of controls. Okay, whether it is manual element of control or automatic control, personnel changes. This is what the previous question was. Deficiency in the general IT controls, changed circumstances, but there is no change in the control as per the changed circumstances. Okay, these are the important points. Okay, evaluating the operating effectiveness of the controls. This may be given as homework. This is given as homework. Believe me, I am covering everything. Some of the small topics are given, okay, as homework, which you need to cover up before going to examination. Okay, because I already ran out of the time. It is almost more than 1.5 hours. Okay. Okay, this is also not so significant. This is given as homework. I discussed everything except 2 small questions which are given as as homework for you. Okay, rest all the topics of internal controls except 2 which are there in chapter number 4. Okay, methods of collecting the information. Methods of collecting information. This is one of the significant question which I am going to cover in chapter number 4. In chapter number 4, again it may take 10 to 15 minutes. Let us now take small break for this session. Okay, it has been almost 1.5 hours. It is right time to take break. 1 hour 20 minutes, I guess. Okay, done. I hope I have done some good justice to this discussion of more than 1 hour. Okay, so please make use of it. Okay, I request you to sincerely listen to the class, read that material immediately. Okay, so that you will be passing the examination with heights, with some good marks. Okay, done. Thank you. Let us meet after the break. Done. Okay. Done. So welcome back after the class. We discussed till internal controls topic. Let me draw the chart again for the standard number 330. Okay, it is what we started with. Very beautiful chart. Okay, we started with audit procedures divided into 2 types: RAP. Second part is FAP. RAP and FAP. And again, FAP is divided into test of controls and substantive. Okay, substantive audit procedures. Substantive audit procedures. Substantive audit procedures. And again, these substantive audit procedures are divided into test of details or substantive substantive. Okay, substantive analytical procedures. Substantive analytical procedures. Okay, this is the chart we made, okay, before the break. Now this test of controls, for this test of controls the discussion has been already made. So everything was discussed, and RAP, everything was discussed. So standard number 315 was done, and along with that standard number 330 up to test of controls was done. Okay, controls may be implemented at, okay, different areas, assertion level. Okay, it can be at what? COT, account balance, and disclosures. In the similar way, test of details can be at, okay, COT, account balances, and disclosures. Test of details, verifying the transactions, verifying the documents. Okay, it is called as what? Test of details. For the purpose of identifying the misstatement, okay, we are just trying to verify the documents physically. Okay, so now you tell me, if you apply those at COT, okay, then it is called as what? What is COT? First of all, P&L account. What is AB? It is what? Okay, it is balance sheet items. Disclosures, what is it? It is notes to accounts. That P&L account is also called as vouching. Okay, verification of P&L accounts. Okay, applying test of details in the area called as P&L account is called as vouching. So area called as balance sheet is called as verification. This is the chart for the same. Okay, now auditor, after testing the controls, he'll be going to substantive audit procedures. I already told you one thing. The extent of substantive audit procedures will depend upon, okay, whether to verify more or less will depend upon results of test of controls. Now as a part of substantive audit procedures, there are two aspects which are ready before the auditor. Point number one, he can go with test of details, or point number two, he can go with substantive analytical procedures. Okay, when will we use this substantive analytical procedures? What is this substantive analytical procedures is all about? Okay, this is standard number 520. Okay, now before going into standard number 520, let us talk about test of details. Test of details is nothing but what? Inspecting the records or, okay, documents or books of accounts, etc. Okay, you are actually verifying the record and trying to identify the misstatement. So why the auditor needs to apply this SAP? For the purpose of detecting the material misstatements. For that purpose, he may inspect the books of accounts. Okay, now this is another aspect called as SA 520. Before going to this, okay, let us talk about something related to external confirmations also. External confirmation shall also form part of test of details only, like substantive audit procedures only. Okay, What is external confirmation? There are some balance in the financial statements which can be confirmed with outside parties. Say for example, there is a bank statement. So that bank account, okay, there is bank account in the books of accounts. Okay, the balance it is showing as debit balance, it is showing as 1 crore rupees. To confirm this, I can go to a bank. Okay, I can get the bank statement which can confirm the books of accounts balance. It is called as confirmation from the side of bank. Okay, or it can be what? It can be debtor balance, it can be creditor balance, etc. So when the financial statement items are, okay, confirmed with outside persons, it is called as external confirmation. This concept is there in standard number 505. Okay, in detail when I discuss standard number 505, we will be answering everything. Okay, for the time being, let us jump into the material. As a part of substantive procedures, see the substantive procedures. So as a part of substantive procedures, you can use what? Substantive analytical procedures. Okay, I have not explained you till now what is substantive analytical procedure. Or you can use what? Test of details, or the combination of both the substantive analytical procedures and the test of details. Anything you can go. Okay, for the time being, I did not explain you what substantive analytical procedures. That I am going to discuss in standard number 520. Okay, now next one. when to use this substantive analytical procedures. It is suitable when there are large volume of transactions. I'll explain the reason for the same. Okay, done. Next point. Okay, done. So a test of details also, when you test the details, obviously we'll have some some regard with what, some concern with what, sample size, because the documents may be using number. For that reason we may use what, sampling technique. Okay, now one important question. There are two questions in fact. External confirmation procedures as a substantive procedure. Okay, while the auditor trying to identify the material misstatement, he can use what as a part of substantive audit procedures. External confirmation may be used. Okay, in what areas external confirmation will be used? Bank balances, debtor balances. Okay, the inventory, the stock is there with third party, cold storages, etc. we are using for the purpose of storing our inventory. So for them, for verifying that inventory, we can have the external confirmation. Okay, now the title deeds of some of the assets of the organization is there with banks as security, then we can get the confirmation from financiers or lawyers where actual title deeds are with. Okay, next one, investments held for safe custody by third party. Okay, third party, account payables, amounts due to lenders, etc. These can be confirmed by using what? Using external confirmations. Okay, now whether to use this confirmation procedure or not, is this really helpful for the auditor, to come to a conclusion whether the misstatements are there in such type of accounts? Okay, now what factors will affect that? What factors will assist the auditor in determining whether to use the external confirmation? Is it better to use or not? Okay, it depends on what factors. Now auditor needs to evaluate few things. Okay, with whom the auditor is going to get the confirmation. Okay, now auditor needs to believe that the other person with whom we need to get the confirmation, he has to know that the confirmation party, the confirming party, has the knowledge of the subject matter. Without the third party having the knowledge of the same, how can the auditor use that external confirmation? Okay, so the external confirmation, the information shall be given by whom? The third party. If the third party is not having such knowledge, how can the auditor expect from him to provide the audit evidence? It is not possible. So first point, the first factor will be the confirming party's knowledge of the subject matter. Okay, what is going to be confirmed? What is the subject matter? The matter which the auditor is going to confirm with the third party. That is point number one. Come to point number two. The third party is having the knowledge, but he is not willing to support the auditor. He is not willing to respond, because the third party may be a busy person. Okay, the third party may be a busy person. He may not respond to the request given by the auditor. Auditor is asking something, but he may not respond. Okay, then auditor knows prior to issuing this external confirmation, using this external confirmation, that the other party may not be willing to respond, because the auditor knows the other party is so busy, he won't get time to respond at all. If that thing is known to the auditor well before using this external confirmation, then there is no point of using external confirmation as substantive audit procedures. Don't use external confirmation in such a case, because auditor knows that the third party is not willing, not able to respond. Okay, I guess you're all getting the point. Examples are given here, you can just read. Easy only. Okay, next one. Okay, even though the third party is willing to respond, and third party knows the information, but auditor knows that the objectivity of the intended confirming party is not there. What is that objectivity is all about? Whatever the third party shall say, whatever the third party says, he shall have the strong evidence for the same. So now the objectivity for the third party must be there. If that objectivity is not there, then the reliability of the information what he provides may be compromised. Okay, then there is no point of using that as audit evidence in our audit work. For that reason, auditor needs to evaluate whether the objectivity of the confirming party is there or not. If not, then the information which is given by him is less reliable. I guess you're all getting the point here. Okay, now next point, substantive procedures related to financial statements closing process. Okay, when financial statements are closing, then what kind of substantive procedures we can use. Okay, now the auditor shall include, okay, agreeing and reconciling the financial statements with underlying accounting records. So accounting records will match with financial records. That is what we need to verify as a part of test of details. What we are trying to verify, whatever the document shows, it must be there in financial statements. That matching only you are just getting. Okay, you will come to know the matching of what books of accounts and financial statements just by applying what substantive audit procedures as a part of the test of details. Okay, and examining material journal entries, okay, made during the year. See, examine material journal entries. So as a part of substantive audit procedure, what the auditor needs to do, he needs to check whether the books of accounts are matching with financial statements, and the auditor needs to check the important material journal entries. This is the thing he needs to do as a part of SAP, substantive audit procedures, test of details. Okay, done. This is not relevant. You can just ignore that. Request and presentation and disclosure, you can just read this. This also you can read. So with this, okay, documentation easy. Okay, with this I completed what? I completed substantive audit procedures divided into what? Substantive audit procedures divided into test of details, and second point is substantive analytical procedures. I'm yet to done with this standard number 520. Okay, substantive audit procedures. As a part of getting the audit evidence, are you able to use SAP or not? Okay, can the auditor use SAP or not to get the audit evidence? Yes, as a part of substantive audit procedures, to detect the misstatements, SAP can be used. What is SAP? Substantive analytical procedures. It is defined in standard number 520. So till now we discussed two aspects. Till now we listened to the word called analytical procedures in two areas. Point number one, we can use this procedure at the time of risk assessment under standard number 315. We can use this analytical procedure for the purpose of getting the audit evidence. Okay, during the progress of the audit also you can use what? Analytical procedure for the purpose of getting audit evidence. Okay, and that is defined in standard number 330. Okay, test of details and substantive analytical procedures. These substantive analytical procedures are actually defined where? 520. Actually defined where? 520. Now let us go to 520. Okay, it is defined in chapter number 8. Now I am directly jumping into chapter number 8, and next 30 minutes to 35 minutes, it is so significant. Okay, so many logics I am going to get out of, okay, that particular chapter called chapter number 8, I guess it is chapter number 8. Chapter number 7, chapter number 8. Chapter number 8, analytical procedures. Very important for examination purpose. Okay, definitely there will be a question from this. Okay, around 4 to 5 marks. 4 to 5 marks you will get the question from this area. Okay, analytical procedures. Now I am talking about what? Analytical procedures. Let me define what exactly this analytical procedure is all about. Okay, now analytical procedure. Analytical procedure is nothing but it is the study of relationship between financial
and non-financial items, or between financial and financial, or non-financial and financial. Okay, it can be anything. I'll give you examples. Okay, non-financial items of non-financial items. Okay, now what is this relationship? It can be ratios. Okay, now you tell me, this analytical procedure point you listened for the first time when I was discussing standard number 315. Okay, now in the after being to the entity client place, auditor asked the management to say the net profits or net profit ratio or gross profit ratio. Management said it is 10%. Okay, or management said it is 40%. Now the auditor compared this 40% with previous year gross profit ratio. Okay, he asked the management to tell him, okay, previous year gross profit ratio, where they told it as 10%. Now previously it was 10%. Now in the current year it is 40%. Why there has been a significant difference between this 10%? Okay, when the previous years is 10%, obviously in the current year it may be, okay, around 10%, like it can be 8% or it can be 12% or 14%. How it suddenly increases from 10 to 40? Okay, now the auditor came to a doubt that there may be a risk of material misstatement here, which may be there in the P&L account. For that reason only, gross profit ratio has been, okay, increased drastically to 40%. This is the risk of material misstatement. Okay, he assessed by applying what? Okay, analytical procedures. Okay, he just compared what? Current year figures with previous year, current year ratios with previous year ratios. This is what he can do at the beginning of the audit. Now, in the middle of the audit, also we can use such type of relationships between different items of the financial statement, Okay, now you tell me, okay, analytical procedures is study of relationship between items of financial statements, or it can be financial or non-financial also. Okay, so in what ways he can make this analysis? He can compare the entity information with prior period information. This is the first way. Okay, entity's current period gross profit is compared with previous period gross profit. Now coming to second aspect. Okay, it is not prior period comparison. It is what? It is the current period information results are compared with budgets. Okay, budgets are future oriented, right? Okay, budgets are now compared with what? Current year results. Okay, now you are trying to, okay, assess the risk of material misstatement. Okay, in such a way we can use in, okay, 315. Now in the current period, during the progress of the audit also, you can use what? Current period figures may be compared with the budgeted figures for the purpose of getting the audit evidence, to say whether it is right or wrong, to say whether current period figures are right or wrong. Okay, you can compare it with what? Budgeted figures. So future oriented. This is past, this is future. Also you can compare your results with, okay, entities results. Okay, can be compared with what? Can be compared with okay, industry results. Okay, entities gross profits are now compared with industry results, because as the company is running in the industry, say example it is automobile industry. Okay, the gross profit of different companies within the same automobile industry may be almost similar. For that reason, you can use what? You can compare your results with industry results. This is how you can use this analytical process in three ways. Okay, prior period information comparison, budgeted figure information comparison, and the budget information comparison, and last one, industry information comparison. Okay, I guess you're all getting the point clear. Okay, done. Let me jump into the material now. Okay, what is the meaning of analytical procedure? It is the term which evaluates the financial information through the analysis of relationship. Okay, gross profit ratio, is it the relationship between two items of, okay, P&L account or not, or trading account or not? Yes, gross profit ratio. It is gross profit to sales. This establishes the relationship between gross profit and the sale. Okay, I guess you're all getting the point. Okay, now among both financial and non-financial, what kind of relationship okay, may be there. Okay, just now we discussed what? Between two financial items, I discussed what? Relationship. Gross profit ratio. Okay, it is the relationship between what? It is the relationship between, okay, GP, gross profit, divided by sales. Divided by sales. It establishes the relationship between financial item. Below also there is in the denominator financial item only. So it establishes the relationship between financial item and a financial item. Okay. Coming to the second aspect, where if you want to know, okay, salaries cost per employee. If you want to know salaries cost per employee, what may be the formula? Total salaries cost divided by total number of employees. So in the numerator it is financial item, total payroll cost divided by, okay, number of employees, it is non-financial information. Non-financial information, it won't be there in the balance sheet. Okay, non-financial information. You can now establish the relationship between what? Financial and non-financial. Okay, if you want to learn the relationship between both non-financial and non-financial, NFI and NFI, okay, labor turnover ratio. Every year how many employees are going out, that percentage you need to calculate. Okay, then for that you need to have the formula between number of employees going out, okay, by existing number of employees. Okay, this is called as non-financial to non-financial, NFI to NFI. Okay, these type of ratios you can get, these type of relationships you can develop between financial and financial, financial and non-financial, and non-financial and non-financial also. This can be used by the auditor, okay, as a substantive audit procedure. Okay, for the purpose of, okay, knowing whether there is any misstatement or not. Okay, it gives you the overall picture, in fact. Okay, it gives you the overall picture. It gives you the overall picture only. Exact, okay, misstatement you cannot identify. Exact misstatement you can identify only when you test the details. When you just compare overall pictures, gross profit ratio to gross profit ratio of previous year, can you say 100%, okay, whether the misstatement is in existence or not? However, okay, using substantive audit analytical procedures, okay, it saves lot of time for the auditor. It saves lot of time for the auditor. Say, imagine, let us take one small example. Okay, in the current year, salaries cost was 1 crore. Now, okay, salaries cost was 1 crore rupees. There are almost 1000 employees. Every month they pay the salaries. Okay, now to verify all this 1 crore rupees expenditure, okay, it may not be required by the auditor to check each and every transaction, each and every salary payment to every employee. What he can do, okay, if it is possible, he can compare with previous year's figures. Okay, if the previous year figure is 90%, then obviously with some hike as per the policy of the organization, okay, say example, previous year it is 90 lakhs, now it may come to 1 crore rupees because of what? Okay, because of increase in the salaries as per the policy of the organization. So now almost this 1 crore is matching with what? 90 lakhs. Okay, after making some adjustments to the increase of the salaries. Okay, now you can come to a conclusion that there may not be misstatement in the salaries. For that reason, okay, I can reduce only few salary payments which are made to few employees. That is sufficient. Okay. So better to use analytical procedures only on those items which can be easily predicted. Last year sales, okay, current year sales 1 crore rupees, last year sales almost 90 lakhs are there. So current year, okay, it may be around 90 lakhs only with some increase of 10 to 20%. Okay, now as an auditor you can use what? This analytical procedure to check whether the current year sales figure 1 crore is right or wrong. You are just comparing with the previous year sales and you are making some adjustments for it. Okay, that is how you are going to verify sales, not in details you are going. Okay, or you may go only to some extent, only few transactions of the sales may be verified, because already you got to a conclusion that, okay, there are only less misstatements because, okay, these two are matching, previous year figures and current year figures are almost matching. There may not be a big misstatement here in this case. This is how the auditor thinks
when he applies the substantive audit procedures, and as a part of substantive audit procedures, whether to use test of details or whether to use substantive analytical procedures, it depends on the auditor's professional judgment. Okay, firstly, if it is possible, he'll try to use what? Substantive analytical procedures to come to a basic conclusion, and then he applies what? Okay, a little test of details also in that areas. I guess you're all getting the point. Now let us discuss the sequence of sequence or steps involved in analytical procedures. Okay, there are 4 steps. Once we are done with these 4 steps, this chapter will be over. Okay, now let us jump into the material. Now you will get the clarity. Okay, when I show you the material, it gives you the clarity. See, analytical processes include comparison of previous period, then budgets, anticipated results, future oriented results, and similar industry information. Okay, also it can be relationship between what? Financial and non-financial. Examples are given here. Next one, and timing of the analytical procedure. See, this is standard number 520. This standard number 520. The objective of this standard is to get relevant and reliable audit evidence using substantive analytical procedures. Now you can observe one important point. They are not talking about SAAE. They are not talking about sufficient and appropriate audit evidence. Okay, they said relevant and reliable audit evidence, and for the purpose of forming an audit opinion, you need to have what? Sufficient and appropriate. It is not relevant and reliable. Okay, it is not sufficient. This is required. Okay, this is required. So just by applying substantive analytical procedure, the auditor cannot get, by overall checking, okay, the relationship between items of financial statements, he cannot get sufficient and appropriate audit evidence. He can only get what? Relevant and reliable audit evidence. I guess you're all getting the point. Okay, and the objective of the auditor in this, okay, standard is to design and perform the analytical procedures near to the end of the audit also. So we have learned something called as, at the beginning of the audit we applied, in the middle of the audit you applied as a part of substantive audit procedures. Now in the last case, okay, the analytical procedures may be applied near end of the audit also. The purpose of that is, okay, see, that assist, the purpose is that assist the auditor, okay, when performing overall conclusions as to whether the financial statements are consistent with the auditor understanding of the entity. Initially, okay, he understood the entity by applying certain analytical procedures. Now at the end of the audit also he applied the same thing, whether the same are matching or not, whether the auditor's understanding of the entity is proper or not. To evaluate that, he applies the analytical process even at the end of the audit. Okay, even at the end of the audit. See, the timing of the analytical procedures. Planning phase, studied in standard number 315. Testing phase, studied under standard number 520. Also in standard number 330. Okay, now, so in fact it is 330. The definition and all, it is there in 520. How to implement and all, it is there in 520. And even at the end of the audit also, we need to apply the analytical process. What is the purpose for the same? To know whether the auditor's understanding is consistent with the books of accounts or not, understanding of the business is proper or not. Okay, now, so in the planning phase, for what purpose it is used? To get an understanding of the client's business, okay, to assess the risk, and to determine further audit procedures. See, timing, extent of further audit procedures. Testing phase, as a part of substantive audit procedures, you can use what? Okay, analytical procedures to get relevant and reliable audit evidence. It won't give you what? Sufficient and appropriate. It gives you only relevant and reliable. So based on this, you cannot form an opinion. So definitely as an auditor, to form an opinion, you need to have sufficient and appropriate audit evidence. You will get that only, okay, you cannot form sufficient and appropriate audit evidence just by using, okay, analytical procedures, just by using substantive analytical procedures. So for that reason, he must always use, along with substantive audit procedures, test of details also to form an opinion. So in its isolation, SAP won't be there. So only on SAP, only on analytical procedures can the auditor depend to form an opinion. No, answer is no. Along with that, TOD is also required. Only for few circumstances, few Okay, items of financial statements, he can depend upon what? Okay, SCAP. So for its entire financial statements, can he use, in the verification of entire financial statements, can he use only substantive analytical procedures? No, he cannot use. With this, I will be going into the various steps we use. Okay, various steps the auditor uses while applying the analytical procedures. Okay, I guess you are all getting the point now. So whether to use the analytical procedures or not, it is to be decided by whom? It is to be decided by the auditor. Now my question is, okay, it depends on what factors? It depends on what factors? See, depending upon the circumstances, the auditor may determine that, okay, determine that performing substantive analytical procedures is sufficient, okay, to reduce the audit risk to acceptable low level. Okay, performing analytical procedures is sufficient. This is the conclusion the auditor made, and once he is ready to depend upon analytical procedures, then he can apply what? Standard number 520. Okay, or the auditor may decide what? To test the details. The auditor may decide what? The combination of substantive analytical process in the test of details. Okay, this is the options what the auditor is having. Out of that, my chapter is relating to substantive analytical procedures, usage of analytical procedures by the auditor. Usage of analytical procedures by the auditor. See, use of substantive analytical procedure requires consideration of the following factors. Whether to use or not, it depends upon certain factors. See, to apply analytical procedures, first of all, the auditor needs to have in his hands, okay, the data of industry, the previous year's data or budgeted data, everything he needs to have. Okay, if he has the data, then it will be possible to use analytical procedures. Now you tell me, if the data is not available, okay, can he use analytical procedures as a part of substantive audit procedures? Answer is no. So it depends on availability of the data. Without the data available, can he use analytical procedures? Answer is no. Point number two, the data must be able to be disaggregated. This point is very, very important. Okay, now you are trying to say, for example, okay, in an industry there are two organizations. One organization is your client. Now you just want to compare it with industry figures. Okay, you need some data. You got the P&L account of another company in the same industry. Now you just want to compare your expenditure with their expenditure. Okay, now you tell me, you got the figures in way of, okay, by way of purchases. There are many materials they purchased, and overall purchase expenditure, it is what? 1 crore rupees. Now in this purchase there are many raw materials. Raw material 1, 2, 3, 4, 5 types of raw materials are required for this type of business. Okay, now you have in your hands the details of what? All the 5 raw materials, purchase of 1, 2, 3, 4, 5 raw materials. All the details are given here. Now if you want to use the analytical procedures properly, okay, it is better when the data what you are comparing with, okay, is able to be disaggregated. When this purchases figure, it can be disaggregated, separated into various levels. Okay, say example, if it can be divided into 1, 2, 3, 4, 5, then auditor will be able to compare this 1 with 1, 2 with 2, 3, 3, 4, 4 and 5, 5. Okay, then it gives you better results, right? Okay, so what I am trying to say, if the data which is available, if it is able to be disaggregated more, then it gives you, okay, better results when you use analytical procedures. That is called as disaggregation of the information. Okay, the best example I can give for this disaggregation, when the degree of disaggregation is more, then it is better to use analytical procedures because it gives better results. And next point, account type. So all this account type and predictability, okay, this point number 3 and 5, they match with each other. Okay, now account type, say for example, in the balance sheet, in the P&L account, there are two things: balance sheet, P&L account. Okay, so there are some items called as sales, purchases, etc. Okay, sales, purchases, etc. There is another item called as what? There is another item called as, okay, research and development expenditure. Research and development expenditure. Now you tell me, there are some items of the P&L account which can be easily predictable. Okay, which can be easily predictable. So in the financial year, the sales are 1 crore rupees. Maybe in the next year it may go to 90 lakhs or 1 crore 10 lakhs. Okay, it may happen. But the expenditures like research and development, okay, so initially the company may incur such expenditures in huge in size, but later after 1 or 2 years, this expenditure will be nominal. So you cannot predict research and development exactly for the next year. So the predictability of such kind of items in the P&L account is less. Okay, but the predictability for such items, okay, which contain high number of transactions with small values, that can be predicted well. So now the auditor, in order to use the analytical procedures, he needs to decide, okay, on which account he needs to apply the analytical procedures. Here in this example, research and development he cannot use analytical procedures, but sales and purchases he can use the analytical procedures. Okay, now he needs to decide which account type I am going to verify, so that whether I can use the analytical procedures or not. I hope you are all getting the point clear. This is account type and predictability. Both these things you can, okay, read together. Next point, source. Some class of transactions tend to be more predictable because they consist of numerous similar transactions. This is what I discussed till now. Whereas the transactions recorded by non-routine and estimations, say research and development, are often subject to management judgments and more difficult to predict. All the 3 points are same. And the nature of the assertion, what the auditor is trying to verify. Okay, I gave you some examples of assertions. It is completeness, or it is valuation. I'll take 2 examples. Valuation is one of the assertions, and point number 2, okay, ownership. Now the auditor is trying to verify valuation assertion, whether the assets are properly valued or not, whether the sales are properly valued or not, completely valued or not. This is what you are trying to verify. Now, is it better to use analytical procedures in valuation assertion or ownership assertion? While you verify the ownership assertion, you cannot use analytical procedure. You cannot compare. Okay, you cannot compare, because the ownership can be known only by applying inspection. That is the procedure you need to check. Inspection you need to do, okay, of the title deeds of any land or building, of any invoice of the asset. Okay, however, for valuation purpose, see, sales previously 90 lakhs, now it is 1 crore rupees. This is the value rate. Okay, to check the valuation assertion, you can use what? Analytical procedures. For that reason, it is nature of assertion. Okay, so what assertion you are going to verify, it depends. Okay, it gives you the answer for what, whether to use analytical procedures or not. This is step number 1. What is step number 1? Determine the suitability of particulars. Okay, the suitability, whether to use analytical procedure or not. If it is suitable, then go for the second aspect. Okay, to go for the second aspect, that is called as evaluate the reliability of the data. Very, very important. Okay. So for the purpose of comparison, you need to have the data. Okay, that data you got. Now, as a second step, you need to evaluate whether the data is reliable or not. If the data is not reliable, then SAP gives you no better results. Then don't use SAP. The second step is what? Okay, reliability. What are the factors which affect the reliability? Okay, the reliability of the data depends upon from where you got the data. Is it, okay, from the independent outside sources? Okay, or is it prepared by the management for their own sake? Okay, which one is more reliable? When the data what you got from the industry, okay, from outside independent agencies, then it will be more reliable. So first factor will be sources of information available. Okay, from where the data may be available, from where the auditor may get the data. This is first point. And second point, the reliability of the data will be more when okay, the information is comparable. When the information is comparable. Okay, in an industry, let me take some example. Okay, in an industry, automobile industry. Okay, in the automobile industry, there may be 2 things. One, two-wheeler, second one is three-wheeler. Now, Your client is two-wheeler company, and if you want to compare your information with the industry information, you need to search for another two-wheeler company, but not what three-wheeler company, because both are not comparable. For that reason, whatever the information you get, that information must be comparable in nature. When it is comparable, obviously reliability will be there. Then you can use SAP well. So that is second point, best example I can give. Okay, point number 3. Okay, whether the information, the nature and relevance of the information, see, you are ready to compare your results with the budgeted figures. Okay, if the budgets are not properly prepared, not realistic. Okay, not realistic preparation of budgets have been taken place. Okay, budgets are prepared based on goals to be achieved. It is not prepared realistically. Okay, then what is to be considered by the auditor? If the budgets are not prepared properly, then it is not possible to compare our results with the budgeted figures. Okay, nature and relevance of the information available. And see here the example is also given. Okay, the information what he uses, okay, if that information is not properly controlled, okay, that preparation of such information is not properly controlled, okay, then better not to use the analytical process. These are the factors which can influence what? Okay, the reliability of the audit. I guess, okay, point number 2 is also fine for you. Okay, what is point number 1? Whether to use SAP or not. Determine whether to use SAP or not. Point number 2, determine the reliability of data. Once these two are over, come to step number 3. Based on the data available, which is reliable in nature, okay, now the auditor needs to develop what? An expectation. See, previously gross profit was 10%. Now, based on the new circumstances, auditor needs to develop an expectation that what can be the current period's gross profit. Is it can be 12% or 14% or 15%. That is what he needs to make an estimation. Okay, he needs to develop an expectation of the of the recorded values. Develop an expectation of recorded values. Okay, see, this is the development what he makes. See, using the data, the auditor needs to develop what? Expectations. What it can be, okay, how much it should be. This is the expectation he needs to develop. Okay, and that expectation, okay, shall be compared with actual figures. Okay, now previously it was 10%. Now, by applying his experience, the auditor came to a conclusion that it should be around what? 15%. This is the development of expectation. Now this 15% shall be compared with actual gross profit. Actual gross profit may be less than 15, more than 15. It can be 10%, it can be 20%, or it can be exactly 15%. Now he is doing what? He is comparing the development of expected values along with actual exact values. Okay, now this is third point, and this development of expectation shall be done carefully by the auditor, because it must be developed in such a way that it will be easy to identify the misstatements. See, if it is 15%, then the actual value is also 15%, then there won't be any misstatement. Auditor can conclude in such a way. Okay, this expectation shall be so accurate. This expectation of this development of expectation of recorded value shall be so significant, because it is the amount, it is the percentage we are going to use for the purpose of identification of misstatements. See, if it is 15%, the actual is 20%. Then auditor will come to a conclusion that there may be a misstatement which is in existence. Okay, for that reason, the development of this expectation, while he develops the same, he needs to be more careful. Okay, see, develop the expectation of recorded amounts or ratios, and evaluate whether the expectation is sufficiently precise. To identify the misstatement. It must be developed in such a way it will be able to identify the material misstatement. Okay, now what are the matters which are relevant for auditor's evaluation? Whether the expectation can be developed sufficiently precise to identify a misstatement. Okay, when it can be said that expectation is properly developed, which is able to identify the misstatement. This is the next question. Okay, see, it depends on following factors. the accuracy with which the expected results of the substantive analytical process can be predicted. Now you tell me, I already told you one thing, okay, gross profits or sales, purchases, gross profits, are they this is option number one. Option number one, gross profit. Option number two, research and development. Okay, out of these two, which one will be more accurately predicted? Gross profits will be more accurately predicted. Okay, so it is, the accuracy will be more in case of such type of, okay, financial items, such type of accounts, and hence the auditor also will be able to, okay, develop the expectation well in such areas, expectations well in such areas, so that he will be able to identify the misstatements well. So point number one, first factor will be the accuracy with which the expected results will be predicted. Point number two, the degree to which the information can be disaggregated. This you know, if the information is able to be disaggregated well, obviously, okay, development also for that will be good. Development of that percentage will also be good. Okay, I hope you're all getting the point. Come to point number three, availability of the information. If the information is not available, then how can he develop the expectation? How can he say, okay, how can, see, in the previous year it was 12%, 10%. To say it should be 15% in the current year based on the revised circumstances, he needs to have the, okay, availability of the data. Okay, if the data is not available, how can he develop the expectation so that he can identify the misstatement? It is not possible. For that reason, these are the 3 points which you need to remember. Accuracy with which the expectations can be developed, the degree to which the information can be disaggregated, and the availability of the information. If these 3 are not there, then the development of the expectation he cannot make well. And once, okay, it is done, come to step number 3. Now you tell me one thing, okay, previously it was 10%. Okay, now he expected it is 15%. Okay, is there any requirement that actual figures also shall be exactly 15%? No, it may not be the case, because the actual results may be around 15%. It can be 14 or 16, it can be 12, like that. Okay, now in step number 4, he needs to determine, okay, what may be the accepted difference between accepted, okay, expected values and the actual values. What may be the acceptable difference? Because if the acceptable difference is 1%, the acceptable difference is 1%, expected value is 15, okay, actual gross profit is 14, the allowable difference is only 1%, then there is no point. The auditor stops the audit there. Okay, there is no further investigation of the misstatements is not required. There is no further, okay, there is no further investigation is required. Now you tell me, okay, the acceptable difference is 1%, but, okay, the acceptable difference is 1%, but actual gross profit came to 25%. 25%. The acceptable difference is only 1, but the actual difference is what? Okay, 10%. Regarding this, is there any requirement of the auditor to investigate further for this huge difference? Yes, he needs to apply further audit procedures, investigate more relating to this huge difference. These are the 4 steps. Step number 1, whether to use SAP or not. Step number 2, reliability of the data. Step number 3, develop an expectation. Step number 4, okay, see, step number 4, determine amount of any difference. Okay, this is acceptable difference. Determine amount of any difference of recorded amounts from expected values. Okay, that is acceptable without further investigation. So if it is within the acceptable difference, then there is no further investigation. If it is outside the acceptable difference, then go and investigate further. Okay, then these are simple. Trend analysis. What are the techniques? Trend analysis, whether it is increasing or not. Previously it was 10%. From last 5 years, the gross profit has been increasing. It started with, okay, 5%, then 7, then 9, then 10. Okay, in the next year it may be 12. So that is called as trend analysis. And ratio analysis you can use. All these are simple points. You can read it on your own. This is techniques available for SAP. All the major crux of this chapter is over now. Okay, now investigating results of analytical procedures. Okay, after you do the analytical processes, you came to a conclusion whether to investigate or not. So what will form part of investigation? What exactly as a part of investigation the auditor needs to do? Okay, he needs to inquire with the management for getting more audit evidence. to get the reasons for high increase in the gross profit in my example. 10 to 25. Why is it happening? Okay, why is it happened? Why from 10% it has been increased to 20%? Can you explain the reasons? This is what he can inquire with management, and he can also perform other audit procedures as necessary in the circumstances. Okay, these are the investigations he can do: inquiry and performing other audit procedures to get the answer. Okay, and then our analytical procedures can be, okay, that assist when forming an overall conclusion. See, near end of the audit, why are we applying analytical procedures? Okay, to know overall conclusion, okay, whether the financial statements are consistent with the auditor's understanding of the entity. This is what we discussed in the beginning itself. Okay, and one last point is there, that is given as homework. Okay, that is given as homework because, okay, it is so simple. I can explain also. For public sector organizations, okay, this ratio analysis may not work, this analytical process may not work, because, okay, when you identify a private company, when you identify the trend analysis, make the trend analysis, okay, their focus will be more on making profits. For that reason, okay, they may have a increasing trend or decreasing trend. If the last year, if there is if there was 10% gross profit, okay, current year they always try to implement that. But in case of public sector undertakings, their focus is more on what? Okay, their focus is more on service rather than making profits. So in the current year, there may not be increase in the profit in the public sector undertakings. Okay, because their focus is more on what? Providing service, not making profits. Okay, with this basic background, you can complete these 3 points. Okay, I hope you're all getting the point here. Okay, with this I just want to wind up chapter number 8 also. Okay, we are almost done with chapter number 3, chapter number 4 and chapter number 8 also. Chapter number 3, there are some standards which are still pending. Okay, that is standard number 500 completely in detail we have not seen, relevant portions we have seen, and still there are 2 questions which I need to, okay, complete in standard number 500. 501, it is so simple, I'll discuss in the next session. 501 and 501, these are the 3 aspects which I'll discuss in the first part. Okay, these 3 areas, it may take another, okay, 20-25 minutes or 30 minutes to complete these 3, and after that, okay, in the second part of the revision, okay, next part of the revision, I'll complete remaining standards called as 560, 550, 570. As a standards part, I'll complete them. So 580, these are the 4 standards. Okay, later we'll complete this. So for the time being, everything in chapter number 3 is over except these 4. Okay, and chapter number 3 is over, and chapter number 4, there are only 2 questions. Okay, how to collect the information. Okay, that is, there are 4 points to be discussed, that I'll discuss later. Except that, remaining everything is done. Chapter number 1, 2, 3, 4. Okay, 4. And in the coming session I'll be discussing, okay, fraud also, chapter number 5, and chapter number 8 is also over. Okay, with that I just want to wind up this session now. Okay, in the next session we'll be continuing with fraud. After that I'll come to this 500, 501, 505 also. Done. So thank you. Okay, done. Now, after the exhaustive discussion of chapter number 3 and chapter number 4 for a long time, okay, let us go to chapter number 5. It is so easy, and there won't be any examination question paper without this question, without this chapter, without a question from this chapter, in fact. Okay, so now let us try to understand chapter number 5, starting with what the name of the standard itself says, what? Fraud and responsibilities of the auditor in relation to fraud. Okay. Now fraud, that is the aspect we need to study. So when we listen to the word called fraud, always remember 3 things. There is one standard called standard number 240. Okay, and other than this standard, there are other 2 aspects which are related to fraud. That is, Companies Act 2013 143 subsection number 12 also talks about fraud only. Okay, and then CARO 2020 will also talk about what? Fraud itself. Okay, CARO 2020, okay, it is clause number 11. So paragraph number 3, para 3 clause number 11. Previously in CARO 2016 it was used to be in clause number 10, but however now from this attempt CARO 2020 is applicable, and in that paragraph number 3 clause number 11 talks about fraud. Now in this session we are going to cover up all these things along with some content also, additional content also. Let us it may take around 45 minutes to complete, around 35 to 45 minutes to complete this chapter. It is simple chapter, easy only, and it is very very important for examination purpose, and there is there is no examination question paper without a question from this chapter. And hence I need 100% attention from your side for the next 45 minutes. Done. It is not highly a technical content is there. There is no technical content. Just like that we can go and we can complete it easily. Now some new words may come into the picture, and those terminologies are sufficient. Other than that, nothing is not so important, not so difficult, in fact. Done. So with this introduction, I just want to start with fraud. Let us talk about fraud. What is fraud? Fraud is an intentional activity. What is fraud? Fraud is an intentional activity or act which may be done by those charged with governance or senior management, or lower level management like employees, or it can be any person on the company, on the organization. It is an intentional activity which may be done by any person on the organization. For the purpose of what? For the purpose of getting illegal advantage. This is the purpose of the fraud. So when someone asks you to define fraud is in simple terms, fraud is an intentional activity, unlike error is an unintentional activity. Now fraud is an intentional activity which may be done by any person. Who comes under this any person? Employees, management, or any other person on the company, on the organization, for the purpose of getting illegal advantage. Now here we can simply conclude one thing called as intentional activity. There will be a purpose for committing the fraud. See, where for example, if the management considers to show themselves, to show the company as a company which is best performing in the industry, they need to do the business, they need to show the financial results to the public. But instead of that, the management, what they are trying to do, they are trying to manipulate the books of accounts, they are trying to show the fake financial statements. What they are trying to project, they are trying to project that the company is performing too well in the industry. That is what the purpose. They want to show themselves. They want to show the company as the best performing company in the industry. That may be the reason. For that reason, what they are trying to do, they are trying to manipulate the books of accounts. They are trying to fake the financial statements, misstate the financial statements. They are now trying to show the over performance. They are trying to show overvaluation of the assets, by committing the misstatement. So fraud may be happened by way of fraudulent financial reporting. They are manipulating the books of accounts. They are showing the financial statements, which are completely misstated for the purpose of getting the advantage. This is called as fraud in relation to fraudulent financial reporting. The other side of this fraud may be the employees of the organization, they have that ability to misuse the assets of the organization. There may be some cases where the cashier may misuse the availability of the cash, or the inventories may be misplaced by the employees, or the assets may be misused by the organization. This is called as misappropriation. Misappropriation of what? Misappropriation of assets. Okay, fraudulent financial reporting, and second one is misappropriation of assets. Okay, now let us understand how someone can commit the fraudulent, okay, financial reporting. So before going into that, okay, what may be the reasons for this? What may be reasons for this fraudulent financial reporting? What is this called as? Okay, fraudulent financial reporting may be because of, okay, incentive or pressure on the employees of the organization. Point number 2, okay, incentive or pressure. Last one is attitude or rationalization. Okay, rationalization. And middle one is opportunity. Okay, these are the three instances where one can commit the fraudulent financial reporting. Also other side, okay, the same scenes will be repeated, the same words will be repeated. Incentive or pressure. Okay, the reasons for committing this fraud: incentive or pressure. Point number 2, opportunity. And point number 3, okay, attitude or rationalization. Let us try to understand these concepts called as incentive or pressure, and opportunity, and attitude or rationalization. So what is called as incentive or pressure? So management who are preparing the financial statements, okay, they are under pressure to achieve some targets. Okay, they are under pressure to show some profits of the organization. Okay, there may be a problem of, okay, of showing which is not actually there in the organization. Okay, they are under pressure from higher management or those charged with governance. They are okay, been awarded with the employment to achieve certain targets. For that reason, okay, instead of achieving the targets, okay, in reality what they are trying to do, okay, they are trying to fake the financial statements. They are trying to show the P&L account upside. Okay, that may be the reason, incentive or pressure. So basically the employee is a good person, okay, but pressures make him bad in this first instance, incentive or pressure. Coming to point number 2, it is an opportunity. See, okay, there is an organization in which the employees are, okay, basically they are good persons. However, whenever they find an opportunity, they won't leave it. Okay, they commit frauds. Basically they are good, but opportunities make them bad. This is the second, okay, point you need to understand. Okay, later there is one question called fraud risk factors in relation to, okay, pressures, in relation to opportunities, and in relation to attitude or rationalization. This is the first question. Okay, I am just trying to, okay, this is 1 2 3 4 5 6. These are the 6 questions we are, okay, required to complete. Out of that, I will try to cover up in the classroom itself first 3 questions, and the second 3 questions are so simple, it will be given as homework. Okay, so just 15 to 20 minutes you need to spend on this to complete this homework. Okay, for that reason, first of all, I am explaining the meanings of this incentive or pressure or opportunity or attitude or rationalization. Point number 1, he is a good person, but pressures make him bad. In the second instance also, okay, the employee basically is a good person, but opportunities make him bad. Whenever he finds the opportunity, he cannot stop himself to commit the fraud. This may be the second reason. Okay, point number 3, attitude or rationalization. In the last instance, the employee was born to commit the fraud. Okay, his attitude, okay, is in such a way that he always commits the fraud. It shows his intention to commit the fraud, and he will be always ready to explain the things. Okay, even after committing fraud, okay, he always try to rationalize, okay, the activity. What is called as rationalization? The ability to cover up the instance, whatever happened, the ability to cover up the fraud. Okay, he always find the reasons to cover up the wrong activity which was done by him. Okay, that is called as attitude and rationalization. So however, okay, I guess you are all getting the point clear, and the same will be repeated for misappropriation of assets also. Okay, let us now go to the material, jump into the material to see fraudulent financial reporting, and then we'll need to see the misappropriation of assets. Okay, now let us go to the material. So let me highlight few things. Okay, see, it is an intentional act done by management, those charged with governance employees to get illegal advantage, and then after that it may be committed. Okay, it may be the misstatements in the organization may be because of fraud in 2 ways. fraudulent financial reporting and misappropriation of assets. Okay, and the misstatements may arise by way of fraud or error. However, we are concerned in this chapter with what? Fraud, because it is intentional and error is unintentional. The risk of material misstatement will be high in case of fraud, in case of error, in case of fraud only. Okay, now what are the characteristics of fraud? Incentive or pressure, perceived opportunity, and rationalization of the act. What is rationalization? The ability to cover up the the ability to cover up the wrong thing which has happened by the which was done by the employee. Okay, this is rationalization of the act. Now different ways to commit the fraud. This is so simple question. Okay, how can you commit the fraud in relation to financial reporting? Okay, simply saying, it is what? It is manipulation of the books of accounts, falsification, alteration of the accounting records and supporting documentation. Fake documents they are creating for the purpose of doing accounting. Okay, for the purpose of reducing the purchases, increasing the sales, whatever it can be. Okay, their intention is to manipulate the financial statements, manipulate the financial position of the company, performance of the company through its P&L accounts and the balance sheets. Okay, next important point, misrepresentation or intentional misrepresentation or intentional omission. Okay, so intentional omission they are doing. There are certain transactions which are intentionally not taken into the books of accounts. This may be this is how we do the fraudulent financial reporting. Point number 3, intentional misapplication of the accounting principles. Okay, intentionally they are misapplying. So intentionally, capital expenditures are taken into P&L account, and P&L expenditures are taken into taken as capital expenditures taken into balance sheet. Okay, this may be the reason. And the different ways to commit the fraudulent financial reporting, and we know that. Okay, recording fictitious journal entries, particularly close to the end of the year. Okay, only in the month of March, last 10 days they are passing more expenditures for the purpose of keeping the profits down, for the purpose of avoiding the taxes, or in the last 10 days of the March month, close of the year. Okay, they are trying to keep the sales as high to show better performance of the company. That may happen. So particularly close to the end of the accounting period, they manipulate the operating results. Okay, and in different ways to commit the fraudulent financial reporting. When there is a organization which is mainly dependent upon judgments and estimations, then they have that opportunity to commit the fraud, because they do not have conclusive audit evidence for that. Okay, auditor cannot get the conclusive audit evidence regarding the significant estimations or judgments. For that reason, see, inappropriately adjusting the assumptions, changing judgments used to estimate the account balances. Next one, omitting, advancing. Okay, they are not even taking the transaction in the books of accounts, or they are taking the transaction well before to the date on which they have to record that. Okay, advancing income recognition as per AS9, they have to recognize recognize in the next year, but as per AS9 they have to recognize in the next year. But what they are doing now, they are recognizing the income in the current year itself. This is called advancing. Sometimes they may delay the recognition. Okay, omitting, advancing, delaying the recognition of events or transactions that may happen in the reporting period. Okay, there are some rules for recognition of income, right, as per standard number AS9. Okay, AS9, accounting standard 9. So recognition of dividend, recognition of income, recognition of sale income. Okay, all these things will have certain rules. Irrespective of following those rules, they are doing the accounting as per the requirement they are doing. See, that may be the way to commit the fraudulent financial reporting. Okay, concealing, not disclosing the facts that could affect the amounts recorded in the financial statements. Intentionally they are not showing. Intentionally they are not keeping any provisions as per standard number 29. They are not disclosing anything in the books of accounts by way of contingent liabilities. There are some court cases which are pending on the company. Intentionally they are not accounting for, they are not disclosing in the financial statements, they are not taking the provision in the balance sheet or P&L account. I hope you're all getting the point. Okay, next one, intentionally they are engaging in complex transactions. Okay, they are structured to misrepresent the financial position and financial performance of the entity. They are intentionally altering the records and terms related to significant and unusual transactions. Easy point only. Different ways to manipulate the accounts. See, all these are already done. So previously whatever we discussed till now, see, this point and next point both are same. And now Now, what is the purpose for which it is been manipulated? What may be the reason for the same? Okay, the first and foremost thing, to avoid income tax. Okay, to avoid income tax. Okay, to avoid the payment of dividends. When there is loss for the organization may not pay the dividends to the owners. Okay, for that reason they may manipulate the books of accounts for declaring dividend where there are insufficient profits. Okay, that may be the reason. And third point is also related to dividend only, and to take higher managerial remuneration. And we learned that in section number 197 in the accounting subject. Okay, managerial remuneration. Okay, company financial statements chapter low, we have learned that. Okay, even I taught that. Okay, done. So as per section number 197, okay, managerial remuneration may be paid based on percentages on net profits. If the net profits are shown more by the management, okay, see, by the board of directors, obviously they'll get huge remuneration. Okay, based on that, what is happening, for the purpose of receiving higher remuneration, okay, books of accounts may be manipulated. Okay, now come to misappropriation of the assets. Okay, come to the first point, it is embezzling the receipts. What is embezzlement? Okay, it is misappropriation of the assets or theft of the assets. When someone, okay, when some person is given with the authority to keep it safe, keep the cash safe, if he misuses, it is called as what? Okay, embezzling the receipts, stealing the physical assets, and causing the entity to pay for the goods and services which are not received. See, they are, okay, forming some fake entries, fake expenditures, where the expenditure is not been incurred by the organization, but payments are made. They are causing the entity to pay for goods and services which are not received at all. Okay, and then using of entity's assets for personal use. Okay, next one, defalcation of the cash. Okay, defalcation of cash. How can you defalcate the cash? Okay, you are okay, showing more cash payments. Okay, see, fictitious vouchers you are creating. Okay, in fact the expenditure is not being done, but you are paying. Okay, and you are showing in the books of accounts as payment. Okay, that amount is being utilized by you. Okay, done. Point number 2, making payments against the vouchers, amounts whereof have been inflated. You paid only 100 rupees, but you are writing in the books of accounts as 200 rupees. 100 rupees to that person, 100 rupees to your pocket. This may be the second, okay, reason. Third point, manipulating the totals of wages in the names of dummy. Generally in a construction companies, okay, n number of labor will work, right? Okay, every day daily wages shall be paid to them. Okay, what this management is trying to do, there are 100 persons working regularly, but they are showing as 200 persons. They are making payments to dummy employees, dummy labor. Okay, this may be the case where misuse of the cash may happen. And last one, overcasting for petty cash expenditure. Small expenditures are incurred by the organization, but they are showing it as huge amounts. Inflation in the petty cash expenditure and suppressing the cash receipts. Okay, what they are trying to do, payments are made more than what actually happened, or what they can do, they can suppress the cash receipts also. Okay, actually the cash is being received by the organization, but in the books of accounts they won't show that. How it may happen? It may happen in the way of teaming and lading. This is one of the kinds of the fraud. What is teaming and lading? Okay, say, just let us take some small example. There are debtors for the organization. Okay, so what is the entry for credit sale? It's what? Debtor 1 to, say for example, there is Mr. X, debtor number 1, okay, to sale. So it is happened on 1/1/2022. Okay, in the next month 1/2/2022, okay, he is given with 1 month credit period. In 1/1/2022, there is another debtor which came into the books of accounts called debtor number 2. The same entry will be passed again. Okay, both are for 10 lakh rupees. Now after 1 month, debtor 1 will pay the money. So now after this transaction is happened, that is on 1/1/2022, okay, who made the payment? Cash to okay, debtor. This is the right accounting, right? Debtor number 1. This is the right accounting, what the employee has to do. Okay, but instead of writing this cash which is received in the organization, they won't keep this entry. entry at all. Okay, and within few days this debtor number 2 will also pay the money. Then there may be another entry for that. Okay, another entry for that, cash to debtor 2. Debtor 2 they need to pass. Debtor 2 they need to pass. Okay, they won't pass this. Okay, or they'll pass this, instead of writing 2 they will write 1 only. Okay, the second debtor's payment will be adjusted to first debtor. What is happening every time? Whatever the money which is paid by the first debtor will be misutilized by the employee. Okay, whenever the second debtor pays the money, that will be adjusted to first debtor. So always the money which is paid by the debtor number 1, it will be misutilized by the employee who is sitting place. Okay, who is having that authority. Okay, this is called as steaming and lading. Okay, one debtor payment is adjusted with another debtor's receivables. Okay, done. I have explained you in detail along with this accounting entries. Okay, let us go to the next aspect. Steaming and lading you can do. Okay, next one. You have actually received the cash. Okay, whenever you sell the goods, but you are not making the accounting entries, you are not writing the entries for the same. Cash is been not recorded as receipt. Okay, or you can do what? You are writing some debtors as you are writing of the debtor balances, but instead you are receiving the money from the debtors. Okay, you have taken something in the bad debts, but you are actually collecting the money. In the books of accounts you are showing it as bad debt, but in fact in reality you are taking the money from them. That may happen. Okay, and miscellaneous receipts, you are not accounting for the miscellaneous receipts, right? Sale of newspapers, sale of scrap, etc. will be there, right? That accounting entry you are not passing at all. Okay, you are misutilizing the money what you can realize from sale of scrap. Okay, some assets are completely written down, they are taken to the zero value, but they have some realizable value, right? Okay, scrap value, okay, that is not been recorded in the books of accounts. This may take place. And point number 3, casting wrong totals in the cash book. Okay, this may be the ways in which you can conduct what? Misappropriation of assets. Now let us go to standard number 240. Okay, standard number 240, it talks about responsibility of the auditor in relation to fraud. Okay, it is the primary responsibility of the management. The primary responsibility lies with management or those charged with governance in order to identify the fraud which has been happening in the organization. The first responsibility is there with whom? Okay, management only. They have to identify the frauds which have been taken place in the organization. Okay, see, the primary responsibility rests with whom? TCWG and management. To ensure prevention of fraud, management must have a commitment to create a culture of honesty. Okay, they need to maintain the controlled environment. Next one. Owing to the inherent limitations of audit, okay, how well the audit may be conducted by the auditor, always there is a chance of fraud. Okay, always there is a chance of non-identification of fraud, non-identification of material misstatement, which may not be reported by the auditor. Okay, because of existence of inherent limitations. We know that. Okay, however, can the auditor escape from his liability when he fails to identify the fraud? Okay, see, there is one beautiful question on this. Let us go there and we'll come back here. See, auditor's responsibility for failure to detect the fraud. So he has done the audit in the financial year, he has not identified any fraud. Okay, now he has given the audit report which is unmodified in nature, clean report he has given. Now in the next year the fraud is been identified which has happened in the previous year. Identification of fraud which has happened in the previous year, and such identification is happened in the next year. This is what the situation is. Now, can the authorities make the auditor who has done the audit in the previous year liable for the same, for his inappropriate opinion? Okay. Now, generally there won't be any liability on that auditor if he proves with his working papers that audit was conducted not negligently. Okay, audit was conducted as per standards on auditing. Okay, as per the guidelines, as per the standards. Okay, if he can prove that, then obviously he will be saved from the liabilities. Okay, see, if a fraud has been detected after completion of the audit, Okay, completion of the audit, and some material misstatements have not been reported by the auditor in the previous year. The same itself cannot mean that auditor did not perform his duties properly. But however, he shall prove that if the auditor can prove with the help of his papers, documents, okay, that he has followed the adequate procedures, he cannot be held responsible for the same. Okay, this is the point you need to understand. This is the responsibility of the auditor. However, he shall not act negligently. Okay, due diligence he must take care when he performs the audit. That is what my conclusion is. So now you tell me, risk of error, okay, risk of material misstatement because of error is higher or because of fraud is higher? Okay, it is risk of material misstatement because of fraud. Okay, now auditor's duty is to prevent and detect the fraud. So this is the question we are going to study now. It is so simple. Okay, now auditor is responsible to obtain reasonable assurance that financial statements are free from material misstatement, whether due to fraud or error. However, for the purpose of getting the reasonable assurance, okay, he needs to exercise the professional skepticism. First point, exercise professional skepticism. Okay, and he needs to remain alert. See, auditor should recognize the possibility of the material misstatement due to fraud that could exist. Okay, irrespective of his past experience. From previously from last 4 years he was doing the audit of the same. Now in the current year, can he depend upon the previous experience what he got? Previously from last 3 years there was no fraud identified. Can he imagine the current year also there won't be any fraud? No, he cannot imagine. Okay, he needs to get the evidence for the same. He needs to be alert of existence of fraud in the current year itself. Okay, current year also. Okay, next one. Unless doubtful situations are present, the auditor may accept the records and documents as genuine. If the doubtful situation exists, then he needs to be alert more and he needs to take care of that. Next one. If conditions cause the auditor to believe that document may not be authentic, okay, then auditor shall investigate further. If he has doubt, investigate further. Okay, and he needs to do one thing. So, okay, there are different audit procedures, right? Whenever he applies one audit procedure, he is getting one audit evidence, and this is in contradiction with the inquiries what he made by the management. Okay, what he made with the management. So, whatever the audit evidence I get from inquiry from the management, it is not matching with the audit evidence which I get from the inspection of documents. Okay, when there is contradiction, then auditor needs to keep in mind that, okay, see this, auditor shall investigate the inconsistencies, because he may have the doubts relating to, okay, regarding the integrity of the management. When you verify, see, when I ask the management, are the physical assets verified by you physically? This is what I asked. Yes, they said yes, we verified. Are there any, okay, discrepancies happened? This is what I asked with management. They said no. Okay, so just as a test basis, I went to verify few assets. Now there are some discrepancies which I identified. Now this is the audit evidence I got, which is not matching with the audit evidence what I got from inquiry. When there are some inconsistencies, then auditor needs to be alert and investigate further. Okay, and he has to, okay, have an opinion on, okay, or his concerns on integrity of the management also, honesty of the management also, because the audit evidence are not matching. Okay, next one. Okay, this you can read, simple point. This also, when he identifies a misstatement, he needs to remain alert whether this misstatement is because of fraud or error, because if it is because of fraud, then obviously RMM shall be assessed as high. For that reason, he needs to keep alert. Okay, now after the fraud is been identified, the auditor should communicate the same with whom? Those charged with governance. In some circumstances, okay, there may be a case where auditor is required to communicate that matter to higher authorities, not okay, higher regulatory authorities. Say for example, as per section number 143 of Companies Act 2013, section number 143 subsection number 12, the auditor may report the fraud to central government directly. Okay, the first point, the auditor needs to report to TCJ validity. There may be some cases where the auditor may require to report to regulatory authorities also, income tax authorities also. Sometimes it may happen. Okay, next, when the auditor is unable to complete the engagement, whatever he is doing, he is identifying the fraud. Okay, everything in the organization is because of fraud only. If such situation is in existence, then if the auditor concludes that it is not possible to continue performing the audit as a result of fraud, as a result of multiple misstatements arised because of fraud, okay, then auditor shall, okay, consider the professional and legal responsibilities applicable in that circumstance, okay, whether to report such persons who have appointed him or not, okay, whether to report them or not, he needs to check. Professional obligation, because you are appointed by the, okay, shareholders. Now you have that responsibility to intimate them, okay, and if it is possible, go and withdraw from the engagement. But before you withdraw from the engagement, you need to talk to the management, you need to talk to those charged with governance, and, okay, say the reasons for the same. And you need to also determine the, okay, professional obligation on your side to intimate the reasons for withdrawal of the engagement to the persons whom, okay, to the persons who have appointed you, or some regulatory authorities. This is the last point which is important for examination point of view. Okay, done. So let us now go to, this is over. Let us now go to fraud risk factors. Okay, so it is fraudulent financial reporting, and the second aspect is what? Okay, second aspect is misappropriation of assets. Now we are trying to understand fraudulent financial reporting. Okay, incentives or pressures. I already told you. Okay, done. I already told you one thing. Okay, there are different fraudulent risk factors for incentives and pressures, or opportunities, or attitudes, or rationalization. I told you what? Incentive or pressure. The person is good person, but pressures make him what? Bad. Okay, what kind of pressures may be there to commit the fraud? Okay, see, there is high degree of competition in the market. To compete with the competitors, what they are trying to do, they are manipulating the books of accounts. They are faking the financial statements to match with the competitors. Point number 2. Okay, there are rapid changes in the technology. So whatever the money we invested, okay, it will be gone wasted when the technology got changed. In such circumstances, okay, to show the profits, what they can do, they can manipulate the books of accounts. Second point, rapid changes in the technology or product obsolescence. What is obsolescence? Out of fashion. Okay, next one, significant declines in the customer demand. Okay, our products are not being sold in the market, but still you want to show there are some profits. How can you do? You can just manipulate the books of accounts. You are continuously getting the operating losses, and there is a threat of bankruptcy, okay, threat of closing the business. To avoid such situation, okay, even when you get the operating losses, you are showing in the books of accounts as profits. Okay, that may be the another reason. You are getting continuously negative cash flows. Okay, and there is some new accounting statutory or regulatory requirement. Immediately in the from next month onwards, you need to comply with that. If not, there will be huge penalties on the company. Then, okay, then what they'll do? Okay, they'll just misstate the financial statements. Because of the pressure only they are doing that. Because of what pressure? To comply with the new requirements. What they are trying to do? They are trying to do the, okay, misstatements in the financial statements. Okay, done. And coming to second point, it is opportunity. By nature, he is a good person, but whenever he finds any opportunity, he cannot stop himself for committing the fraud. What may be the reason? What kind of opportunities may be there? Okay, the nature of the organization is such a way that, okay, there are many related parties which are there for the organization, subsidiary companies, associate companies, joint ventures, etc. So when there are related party relationships which are in existence, then there is a possibility of happening the related party transactions. When there is related party transactions, obviously easily you can conduct the fraud. That is the first point. Significant related party relationships and transactions in the ordinary course of business. Okay, and this company is having that domination which can dictate the terms within the industry. Then, okay, they can abuse the dominant position. They can commit the fraud. Point number 2, strong financial presence. Okay, point number 3, where there are some, okay, some accounts which needs to be valued depending upon some judgments and estimations, and regarding those accounts there may be high chance of committing the fraud because there is no conclusive audit evidence for that. Point number 3, asset, liabilities, revenues, expenditures based on what? Significant estimates or subjective judgments. Okay, and significant, unusual, highly complex transactions, especially close to the end of the period. Okay, that is substance over form questions, whether to take in this year or to take in the next year. This is a confusion which is been there. Now this fraudster, what he is trying to get, okay, he is trying to get the advantage from that question, from such type of questions called substance over form questions. Okay, so now, okay, he acts as per the requirement. If he wants to keep the profits as high, then he'll record the income in the current year itself. Okay, this is what he can do. This is the opportunity what he'll get. And next point, significant bank accounts which are operated in the tax havens, that is other countries where the taxes are not there. You will be entering into the transactions with such, okay, organizations which are incorporated in tax havens for the purpose of, okay, avoiding the taxes. Okay, that may happen. Now what is called as rationalization or attitude? Okay, the employee was born to commit fraud. Okay, always his intent is to commit the fraud. He won't search for the opportunity. He commits the fraud and he explains that there is nothing happened. Okay, that is what is called as rationalization, the ability to cover up, the ability to justify. Okay, now what will happen in this? The attitude or rationalization. Okay, what may be the reason for the same? The organization's environment is in such a way that easily you can commit the fraud. Then attitude of the employees who are there in the organization will be always in such a way. Okay, it will be always in such a way. That is called as first point. See, organizations, okay, ethical standards, values are not effective. Okay, and non-financial management, excessive participation in selection of the accounting policies. Okay, accounting policies shall be shall be selected by the finance personnel. Okay, but those are now selected by non-finance people. They do not have the knowledge on the same. Okay, just like that they come. Okay, the intention is to what? Manipulate the books of accounts. They select the wrong accounting policies or wrong accounting estimates. Okay, and what may be the other reason? As an auditor, if he knows, see, known history of the violation of the security laws, okay, it may help the auditor to decide, okay, will there be any risk of fraud or not, because known history of the organization says, okay, says the senior management or those charged with governance alleging fraud and violating the laws. The excessive interest of the management to maintain and increasing the entity stock price and earnings. Okay, the management is not willing to correct the weaknesses in the internal controls. Okay, and just like that they are giving the loans to the creditors. Just like that they are giving loans to, okay, not creditors. Okay, they are giving loans to the borrowers. Okay, without taking any security. This may be the example for the same. Low morale in the senior, no values in the senior management. No values in the senior management. These you can, okay, the owner is not trying to differentiate between personal expenditure and the business expenditure. Okay, these are the examples. You can just remember 5 to 6 you can write. Okay, so now it is your work to complete. Misappropriation of assets, incentive or pressure, opportunity, all are simple only, small only, 1 2 3 1 2 3 4 etc. Okay, point number 3, rationalization. These are the questions which are given as homework to you. I expect you to complete as soon as possible. Okay, you can spend around 15 minutes to complete the same. Next one, what are the events or conditions which increase the risk of fraud? Now as an auditor, you are working in the organization. Okay, you encountered with certain conditions. Okay, something happened to my throat. Continuously talking from last many years, for that reason I got some throat problem. Okay. Done. Conditions or events which increase the risk of fraud. So when the auditor goes to the organizations, he may encounter with certain instances where it shows the existence of fraud. What conditions may exist which help the auditor to decide whether to conclude whether the existence of fraud is there or not? Okay, that is what we are going to learn now. Okay, when he starts verifying the accounting records, okay, he identified there are some transactions which are not recorded. Okay, even it is recorded, it is not complete. Even it is complete, it is not recorded on timely basis. Even if it is recorded, it is not, okay, it is improperly recorded. and whatever the transactions are entered into the books of accounts, those transactions are unsupported with the documents. Invoices are not there for sales, invoices are not there for purchases. And last minute adjustments are more in the financial year, last minute adjustments to manipulate the financial results. This he identified. Then it may be because of what? Fraud. Point number 2, conflicting the missing evidences. See, missing documents. Documents which have been altered. Only the Xerox copies are given, original copies are not shown. Obviously there may be a chance of fraud. See, unexplained items on reconciliations. There are many reconciled figures where the management failed to explain the same. See, consistent response from the management. I already told you this. The two evidences what the auditor gets is not matching, inconsistencies. And point number 5, unusual discrepancies between entities records and the confirmation replies. In the entities records, debtors are showing 1 crore, but the confirmation request shows it is 50 lakh rupees. Is there any mismatch? Yes, sir. These things, when it is in existence, then obviously auditor can conclude that there may be some fraud which may be in existence. Risk of material misstatement is high. Unusual relationship between auditor and the management. Management is pressurizing the auditor to complete the audit within no time. Undue time pressure imposed by the management to resolve complex issues. Unusual delays in providing the records which are asked by the auditor. Even though the weakness in the internal control is identified, they are not willing to rectify the same. Unwillingness of the management to improve themselves and others. Unwillingness of the management to permit the auditor to meet the dose charge with governance. Higher authorities, so the auditor shall not meet. This is what the condition is put in place by the management. They are restricting the auditor to talk to dose charge with governance. Who are those charged with governance? Those are the persons who actually having the power to direct the company, just like board of directors in fact. Next one, accounting policies that may appear to be variance in the industry norms. Whatever the industry is following, the company is not following. They are having their own accounting policy just to manipulate books of accounts. It may be because of fraud. Frequent changes in the accounting estimates. There is no strong basis for accounting estimates. Basis they are not having to estimate the accounting results. These are the events or conditions which help the auditor to identify the fraud. Now let us from this we have completed essay 240, and now I am going into section number 143, subsection number 12. See, this is the reporting requirement of fraud. The auditor has to report the fraud to central government or board of directors or audit committee whenever he identifies the fraud. See, if the auditor of a company in the course of performance of his duties. So first point, the auditor is performing the duty, he is conducting the audit. During that course, he has the strong reasons to believe that there is an offense of fraud which involved such amount or amounts as may be prescribed. It is 1 crore or more. It is 1 crore or more. If he identifies the fraud which is valuing 1 crore or more, and that fraud is being or has been committed, so it is happening or it has been already done. In the company by its officers or employees, the auditor shall report the matter to central government within such time and in such manner as may be prescribed. Now, if I am not wrong, this is what they are trying to say. Auditor, while he is performing the audit, while he is doing the audit, if he identifies, if he has reason to believe the existence of fraud on the company by whom? Officer or employees of the company. Then what he needs to do, if such fraud involves the amount of 1 crore or more, or less than 1 crore, so amount of frauds are divided into 2, 1 crore or more or less than 1 crore. In these two instances, what the auditor needs to do, if the amount of fraud involved is more than 1 crore or 1 crore, then obviously the auditor needs to report to whom? First of all, he needs to report to board of directors, or in case if the company is having the audit committee, he needs to report to audit committee. Within 2 days of getting the knowledge of the fraud. And these persons, see, this is the rule we are actually doing. Rule number 13. Okay, rule number 13. Next, within 2 days, we need to report to board of directors. Okay, they need to reply to the auditor within 15 days. They need to reply to the auditor within 15 days regarding that reporting. Okay, regarding the reasons for the same, etc. They need to respond. They need to comment upon, okay, the things which are being informed by the auditor, okay, within 15 days. If they fail to, okay, if they give the report if they give their response within 15 days, okay, within 15 days here, then within 45 days, response given, response not given. Who has to respond? Management or these persons shall respond, okay, not given. If the response is given, then the auditor shall within 45 days of getting the response, okay, he needs to report to central government. What is to be reported? Okay, what is to be reported? Point number 1, the report which is been sent to the board of directors, report given to board of directors, okay, and along with that comments from them, both shall be reported to whom? Central government within 45 days. Okay, if the response is not given, then within 45 days, okay, what he needs to do? He needs to send to the central government, okay, the report what he have already sent to whom? Okay, board of directors. Report given to whom? Given to board of directors. That has to be sent to central government now. And the fact that, okay, management has not responded for the same, there is no comments which are received from management side, that is the fact they need to show. They need to write fact that there is no response. From whose side? Okay, from board of directors or audit committee side. This is what we need to report to whom? Central government. When? Okay, when it is the fraud involving 1 crore or more. If it is less than 1 crore, then point number 1, they don't need to report to central government. So immediately they need to report to whom? The first point is same. They need to report to whom? Board of directors. And from second point, okay, the central government reporting won't be there. However, once it is reported to the board of directors, okay, what is to be reported? What is to be reported to the board of directors? Okay, nature of the fraud. The auditor needs to write nature of the fraud, amount involved in the fraud. It is less than 1 crore. What is the amount? Okay, amount involved in the fraud. Okay, and parties involved in the fraud. Parties involved. Okay, all these things shall be reported to whom? Board of directors or audit committee. Now you tell me, after that, the board of directors are held responsible to, okay, report this fraud in board's report, which is to be prepared as per section number 134. In the board's report, they need to write. There are 16 points. Out of 16 points, 1 point is, okay, what? Fraud reported by the auditor. In this, they need to show all the 3 points what here I have written, and in addition to that, they need to write another 4th point also. In addition to 1, 2, 3, they need to write 4th point also, the remedial actions what they have taken. Remedial action what the board of directors have taken on such reported frauds. Okay, remedial action that has to be reported in the board's report. Okay, I guess you are all getting the point. This is there in section number 143, subsection number 12. Okay, done. 1 crore or more or less than 1 crore. If it is not there, then the penalty is given here. You can just, okay, try to read. Simple only. No. The next concept is CARO 2020. See, here it shall be changed to CARO 2020. So all these are not relevant. And at the end of this session, I will try to highlight the difference between CARO 2020 and 143 subsection number 12 also. Okay, because it is very much important for this examination. There will be 100% question from this area. Okay, remember this in mind and prepare very well. Okay, now try to write whatever I dictate. Okay, CARO 2020 I am saying now. CARO 2020, para, which para? Para number 3. Okay, para number 3. Which clause? Clause number 11 related to reporting of fraud. Okay, point number 1. The auditor has to report. Quickly you need to write report whether the fraud Caro 2020 clause number 11. The auditor has to report whether any fraud by the company, understand the word called as by the company, okay, or on the company, by the company or on the company. It is significantly different from 143 subsection number 12, because it says it is against the company by officer or employee. Okay, officer or employee. It has been happened or it is been happened. Okay, it is been happening. It can be anything. But here see whether the fraud is by the company or on the company. Okay, which has been noticed. Okay, which has been noticed. Okay, or reported. Noticed or reported. That is nothing but this fraud happening is already known to the management. It has been already happened, noticed and reported. Okay, if such cases exist, then the auditor needs to see. If yes, then the auditor needs to report. Then report what is to be reported. Report point number 1, nature of the fraud. Point number 2, amount involved. This is there in Caro 2000. Okay, 20, clause number 11, subclause number A. This is subclause number A. Subclause number B is also important, where it talks about section number 143 subsection number 12 only. Okay, what it says? Okay, right here, whether any report under 143 subsection number 12 is filed with central government in form number ADT 4 under rule number 13. That is what we discussed till now. Okay, so the report shall be made to the central government in form number ADT 4. Okay, in this Caro 2020, as an auditor, you need to report in that financial year, is there any such kind of report to central government which is filed in ADT 4? If it is yes, okay, right there. Okay, if such kind of report is filed with central government, this is point number B. Okay, filed with central government. Okay, come to subclause number C. There is a concept of whistleblowing. Okay, in an organization, when any employee identifies the existence of any fraud, okay, he is now given with an option to go to the higher authorities. Okay, keep the complaint before them. This is called whistleblowing. Okay, and the higher authorities need to take care that the person whose name, the person who is actually escalating the matter to higher authorities, his name will be kept secretly. Okay, they won't disclose the name of this employee who is actually reporting. Okay, that is called whistleblowing mechanism. Okay, if any such kind of complaints are received during the year, then how the auditor addresses the same, that is what he needs to report in the subclause number 3. See right there, whether the auditor has considered whistleblower complaints if any received during the year by the company, 100% this will come in the exam. Okay, during the year by the company. Okay, with that, okay, I just want to wind up the session on chapter number 5. Okay, fraud. Only one thing which is given as homework, that is fraud risk factors relating to misappropriation of assets. Easy points. Okay, just English to Telugu translation you need to remember. That's it. Okay, done. Okay, with this I just want to wind up the session.